Hello, hi everyone. So here I am going to start CA Inter Group 2 Financial Management. So myself CA CMA Ravi Kumar. So FM is a very interesting subject and it is easy to score 40 marks out of a 50 marks. Okay. So first of all I am going to discuss paper pattern and then I will be starting time value for money. So after discussing time value for money, then I will start scope and object of a financial management. Okay. So CA Inter Group 2 Financial Management. In old syllabus, the financial management weightage was 60 marks because we have a economics for finance in syllabus. Total weightage of a financial management was 60 marks. So what are the chapters we have? Scope and object of a financial management, types of financing, financial analysis and planning, that is ratio analysis, cost of a capital, financing decisions, so that is capital structures, financing decisions leverages, investment decisions, dividend decisions and management of a working capital. These are the chapters and the weightage was total 60 marks. Okay, and the paper pattern was simple. Question 1 compulsory, so that is 20 marks. Each question they used to ask 5 marks. 20 marks contains 4 5 marks questions, and thereafter 4 questions out of a 5 questions, and each question carries 10 marks. So the overall 20 plus 4 into 10 60 marks was the weightage. So this is the weightage analysis of the old syllabus papers. And next, new syllabus. You know that new syllabus paper pattern is different. Question number 1 is compulsory. Question number 1 is compulsory, 3 into 5 marks, and 2 questions out of remaining 3, 10 marks each. So overall 35 marks, because another 15 marks they will be asking a multiple choice questions. So you will get FM 15 marks MCQs and strategic management 15 marks MCQs, multiple choice questions. Overall 30 marks multiple choice questions, and FM descriptive part weightage is 35 marks. How they are going to ask? Question number 1, so 3 questions of 5 marks each, and another 3 questions they will be asking, but 2 questions we have to write only 2 questions out of remaining 3. Each question carries 10 marks. The overall weightage of a financial management is 50 marks. And the other part of our subject is strategic management. So the syllabus is same, no change in syllabus, FM. The only difference is paper pattern and the weightage. Earlier it was 60 marks, now it is only 50 marks. And the paper pattern, there is a difference in paper pattern. Now they are asking multiple choice questions. Clear? So these are the topics, and why we are discussing these topics and all I will be explaining now. But before moving on to that, so this is an exam oriented batch. In this exam oriented batch I will be explaining the concepts. I will be covering entire concepts which are relevant for examination, and also what questions. Sir, what is the difference between the regular batch and exam oriented batch? In regular batch we teach concepts and we are going to discuss each and every question, each and every study material question, and also past examination question. But whereas in exam oriented batch, so we are going to teach all the concepts which are relevant for examination. Concept explanation is same for both regular batch and exam oriented batch, but the only difference is number of problems we discuss in a class. Okay, so here we discuss limited number of questions which will help you to clear the examination, and your homework will be given. A set of questions will be given to you. You have to practice on your own. Okay, but conceptual clarity for both regular class and exam oriented class will be same, no difference in that. And I will be uploading the entire exam oriented batch of a financial management on YouTube, and this YouTube channel, it was created exclusively for CA classes. And for remaining subjects, exam oriented batch like strategic management, auditing, and cost and management accounting, you have to attend live classes in our BCCA app. You have to buy the course and you can attend live classes in our BCCA app. Okay, but for the time being, we are uploading the entire financial management exam oriented batch on YouTube. Okay, this class is more than enough to clear your examination. Okay, and one more difference between the regular batch and UO batch is, in regular batch we teach concept so twice in a class to make you retain, but whereas in exam oriented class we will be teaching the concept only once. But I will be explaining each and every concept from the basics. I will be coming from the time value of a money. Even though you have covered the time value for money concept, that is mathematics of finance at CA foundation level, still I am going to discuss for my satisfaction, because without having a proper understanding of time value for money, you cannot learn financial management and advanced financial management in CA final. Clear? Now, without wasting time, let us start the syllabus. What is syllabus and why we are learning? So what is financial management and why we are learning these topics? Simple. If anybody wants to start a business, the first step is to estimate investment. First step, any business. For suppose if you want to start a business, the first step is estimation of an investment, and the second step is deciding where to invest, like how much amount we should invest in fixed assets and current assets. And next step is from where to procure money. Simple common sense. So FM is more of a common sense. So first step is business, decide your business, estimate your investment. Second, how much to invest in fixed assets and current assets. And third one is how to procure money. These are the steps. So that's why the financial management is concerned about procurement of money and effective utilization of money. Before learning any subject, first you should know the objective of learning, objective of the subject. So financial accounting purpose is to what? Mainly recording. For suppose asset is purchased, you pass journal entry and you will be recording the transaction. For suppose cost and management accounting. So what is the object of cost and management accounting? Simple, determination of a selling price. If any business, it might produce a product, it might provide services. Services price has to be decided, product price has to be decided. So how the price is determined, that we learn in cost accounting or a cost and management accounting. Likewise, what is the purpose of FM? Financial management. The purpose is procurement of fund, two aspects, simple, procurement of money and effective utilization of money, how to utilize the money effectively. So simple. So which discipline is more important in an organization? When you compare accounts, cost accounting and financial management, the most important discipline is financial management. These days the critical job, very important job is procuring money and utilizing the money. Okay, first FM, then cost accounting starts, and later on finance, and where accounting ends, there audit begins. Okay, so if you see the syllabus also, scope and object of a financial management. So this is nothing but an introduction to financial management. In this topic we are going to learn the introduction. What is the object of a financial management? Why we are learning this subject? Second, types of a financing. This types of financing is completely theory topic. This comes under procurement of a fund side. To procure money, first we should know how many sources for procuring money are there. So that's why we are going to learn types of a financing. So okay, we should go through the current affairs as well. So time to time new financial instruments will be coming in the market, as a CFO, Chief Financial Officer, you have to learn so types of procuring the finance. So that's why second chapter, procurement of money. Third one, financial analysis and planning, that is ratio analysis. So ratio analysis is for analyzing the financial statements. So it is not a procurement of fund or a effective utilization of a fund. The purpose of learning ratio analysis is we should know how to analyze the financial statements. So that's why we are learning ratio analysis chapter. Okay, and see the weightage of these chapters. Scope and object of financial management weightage is 4 marks to 2 marks, 2 marks to 4 marks. So that is completely theory topic. First chapter is completely theory. Second chapter, types of financing, the weightage is 2 marks to 4 marks. Again, the weightage of this chapter is 2 to 4 marks, completely theory. Types of financing will be coming under procurement of a fund side. Ratio analysis, problematic topic, and the weightage of this is so 5 marks to 8 marks. Weightage of this topic 5 marks to 8 marks. Cost of a capital. Cost of a capital, it comes under procurement of a fund side. The weightage of this topic is 6 marks to 8 marks. In cost of a capital, they are asking advanced concept like realized yield method. To understand this realized yield method, you should know what is IRR, internal rate of a return. Yield to maturity, YTM method. So financing decisions, next topic, financing decisions, capital structure. The weightage of this topic is again 4 marks to 10 marks. So the numbers which are in red, so they are multiple choice questions. Multiple choice question. So in FM they will be asking 7 MCQs which carries 2 marks each, plus 1 MCQ which carries only 1 mark. Next, financing decision, leverages. So this cost of a capital structure and leverages will be coming under procurement of a fund side. Investment decision, we invest money in current assets and fixed assets. For fixed assets we are going to discuss investment decisions chapter. So this is also called as capital budgeting. Okay, next, dividend decisions. So this dividend decision is also we can categorize under procurement of a fund side. Okay, next, management of a working capital. Management of working capital, we invest money in current assets, right? So that's why we should know how to manage the current asset investment. So effective utilization of fund, we have a two chapters, that is investment decision and management of a working capital. Investment decision and management of a working capital, these two topics are effective utilization of a money. Procurement of fund side, we have a types of financing, cost of capital, capital structure, leverages, and also what, dividend or decision. So first topic is nothing but introduction. Here we are going to learn the scope. Scope means boundary and objective of a financial management. Okay, and another topic is what, ratio analysis, financial analysis and planning. Here we are going to learn how to analyze the financial statements. Clear? So now here the point is all the topics here are interlinked. We cannot learn the topic directly, what, management of working capital. So all the topics are interlinked and we have to learn each and every topic. I will not say so these are the A category topics, these are the B and C. In final I used to say, in final I say I will be giving what, A category, B category and C category. But whereas at CA inter level I am not going to give A category, B category and C category, because you have to learn each and every concept, because these are very very important. Okay, for AFM as well, advanced financial management. So these days CA inter papers are not that easy, so that's why you have to learn each and every topic. And if you see the weightage, almost all the topics they are asking, every attempt they are asking questions from all the chapters. So that's why you have to learn each and every topic. Okay, so but before moving on to the syllabus, first we should learn the time value of a money concept. Without learning this time value of a money concept, we cannot start financial management. So what is this time value of a money? What is this time value of a money and why we should learn in financial management? Because any business will give a benefit not at present, it will be giving a benefit in the future. So not now, it will give a benefit in the future. Any asset or any business, so asset or a business will be giving a benefit in the future. So we have to know the time value for money, because the reason is, in business we put money as on today, but we receive the benefit in the future. So that's why, so we should know the time value of our money. There is a time value of our money. Sir, what is this time value of our money? So let me take an example. For example, if I have to give 50 lakhs to you, okay, so there are two options. I want to give as on today 50 lakhs or after 10 years. So you will be choosing what? The first option. You will be taking 50 lakhs as on today, so that you can invest this 50 lakhs for the next 10 years and you can earn a rate of a return. Yes or no? So likewise, if you have to give me 10 lakh rupees, if you are giving two options, as on today and after 10 years, so if I give two options, you will be giving that 10 lakh rupees after 10 years. Why? Because there is a time value for money. Time value for money. Okay, so what is this time value for money? Example, right now after completion of a CA, Chartered Accountancy, students are getting package of around 8 lakhs to 20 lakhs. 8 lakhs to 20. Students are happy, family is also happy. But the point is, I have qualified in the year 2011. So at that time also, the package was 8 lakhs to 20 lakhs for a qualified CA. Okay. And when I qualified my CA, in 2011, so 2 BHK rent in Hyderabad was 10,000 to 12,000. Now the same 2 BHK rent in Hyderabad is 35,000. That means there was an inflation, yes or no? So there was an inflation. That means what? To be honest, a CA qualified should get package more than 20 lakhs as on today. But the irony is, corporates are not paying too much. They are paying only 8 lakhs to 20 lakhs. Okay. So this is not at all correct, because here the time value for money is completely ignored while determining the package of a CA and CMA qualifieds. So that is completely unfair. I am against it. Sir, why can't you fight? So right now I am focusing on teaching. We cannot fight with corporates. But the point is, it is completely unfair, because 2011 and 2025, there are 14 years gap. In this 14 years, there is no growth in package of a CA and CMA qualifieds. Okay. So that means they have completely ignored what? Time value for money, which is the fundamental of a FM. Okay. So clear? So time value for money. Sir, why there is a time value for money? Why do we charge interest when we give money to a borrower? First, we should learn from this. So what is the content of this chapter? We are going to learn introduction, simple interest, compound interest, annuity, and valuation of asset. You might be feeling like, sir, time value of money is not there in our syllabus. Why you are taking 1 hour, 1.5 hours time for this topic? Okay, so there is no weightage at all. Believe me, if you understand the time value for money properly, you will find investment decisions chapter easy, cost of a capital chapter easy. Okay, if you understand the time value for money, you will be feeling AFM topics also very easy if you understand the basics of a time value for money. So why do we charge interest when we give money to the borrower? The first reason is what? Risk. First reason, risk. Risk means what? You should know the meaning of a risk. Risk means uncertainty or possibility of a occurrence of a loss or a deviation from the mean. possibility of a deviation from the mean is called as what? Risk. Okay. Sir, can you please tell in a general language? For suppose if someone joins CA, so relatives will say why you are taking risk. Okay. Likewise, if someone wanted to become a hero, okay, like Amar, he wanted to become a hero. Now the point is what? So I will say, why Amar, why you are taking risk? You are a qualified CMA. That is what my reaction, yes or no. So the point is what? Risk, why you are taking risk? So you might have heard about this word risk many a times. What is the meaning of this? There is a possibility of a occurrence of a loss. Amar might become a hero like Mahesh Babu, but there is a chance that what he might become a hero like Sampurnesh Babu also. There is a possibility of occurrence of a loss, deviation, uncertainty. Okay. Likewise, if you are doing a business, there is a possibility of occurrence of loss. Likewise, a lender, if he gives a money to borrower, there is a possibility of occurrence of a loss. Okay. So that's why generally the fundamental point in FM and AFM is, if risk increases, required return will also increase. This is the fundamental point. For suppose a qualified CMA, Amar might expect 1 lakh rupees salary per month. This is his expectation. But instead of working in a corporate, Amar, he wanted to become a hero, pan-India star. Okay. So whether he is taking risk or not, yes, he is taking risk. So tell me, his expectation will be same 1 lakh rupee per month or greater than 1 lakh? Greater than 1 lakh, yes or no? He will be paying 1 lakh salary per month to his bouncers. He will be expecting what? More money. That means the fundamental point is, if risk increases, required return will also increase. Likewise, that's why banks, for example, bank, you know the concept of a housing loan and personal loan. Housing loan means the rate of interest will be somewhere around 7% and 8%. That means bank will collect 7% interest from the customer. Okay. But if it is a personal loan means the loan which is given without any security. Housing loan means house is taken as a security. Personal loan means no security. No security means what? There is a risk. If housing loan is not repaid, bank is having an option to what? Sell the house. But personal loan, okay, Amar has taken a personal loan and he celebrated his marriage grandly. Now the point is, if he makes a default of a payment of a loan, so here the bank cannot collect. It will be difficult, yes or no? So that's why what happens is, interest rate of a personal loan generally will be higher than the housing loan interest rate. The logic is, if risk increases, required return will also increase. Okay. And that too, if a bank is giving a loan to a private employee, it will charge high interest. If it is giving a loan to government employee, it will charge a less interest. Because the reason is what? The simple reason, high risk, high return. Everybody, this is a fundamental point. Are you able to understand? Is it clear? Now, another reason is inflation. If I give 1 lakh to you as on today, again you might repay after 5 years. Okay. Now I wanted to buy what? A bike. But instead of purchasing a bike, I gave that 10 lakh rupees to you. If I want to buy the same bike after 5 years, will the price remain same? No. There will be an inflation. So that's why I charge interest. That's why lender will charge interest. Second, postponement of a present consumption. Postponement of a present consumption. Everybody need a present consumption only. Present consumption. Okay. So Amar is having 1 crore rupee. He, instead of buying an Audi car, okay, he gave that 1 crore money as a loan to Pooja Hegde. Okay. So his colleague, he gave 1 crore money to Pooja Hegde. Now the point is, he is postponing his consumption, yes or no? Instead of buying an Audi car as on today and roaming here and there with Pooja Hegde, he is giving that 1 crore loan to what? Pooja Hegde. So is he going to charge interest from Pooja Hegde or not? Yes, because the reason is he is postponing his present consumption. Next, opportunity cost. Opportunity cost means the benefit foregone in choosing the alternative course of action. Opportunity cost means benefit foregone in choosing the alternative course of action. Amar is a qualified CA. Amar is a qualified CA. He secured a job in PSU, public sector undertaking, and his package is 21 lakhs. Okay, 21 lakhs. But he resigned. He resigned and he wanted to act in a film. He got a movie chance. Now tell me, what is his opportunity cost? 21 lakhs is the opportunity cost per annum. Benefit foregone in choosing alternative course of action, that is acting. Okay. Likewise here, Amar, he gave 1 crore rupees loan to Pooja Hegde. So the opportunity cost is what? He can invest this 1 crore elsewhere and he can earn some return. But instead of investing elsewhere and earning some return, he gave that money to Pooja Hegde. That means what? There is an opportunity cost. Okay. So generally, if opportunity cost increases, interest to be charged will also increase. Generally, if we are postponing our present consumption for a longer period, we expect high interest. If there is a high inflation, we expect high interest. If there is high risk, we expect a high interest. Clear? Next. So these are the reasons. Okay. Next. So in this, the most important point is, if risk increases, required return will also increase. Simple interest. First you should learn how to find out the simple interest. Simple interest is also called as fixed interest, calculated on a original principle. Calculated on a original principle for a specific period of a time. For a specific period of a time. Example 1, principal is equal to 1 lakh, interest rate R is equal to 10%, time T is equal to 1 year. Calculate a simple interest. So simple interest is equal to PTR. Everybody will be knowing this formula. Principal into time into rate of interest, that is 10,000 for example 1. And for example 2, what is the simple interest? 1 lakh into 5 years. So that's why 5 into 10%, that is equal to 50,000 rupees. Now comes the compound interest. Here for compound interest, we have to learn the shortcut. Okay. So first let us see the conceptual one, and then let us come to the shortcut. See the example 2. Principal 1 lakh, interest rate I is equal to 10%, time is equal to 5 years. Calculate a compound interest if compounded annually. Compounded annually. So tell me, so what is the principal amount? Principal amount is equal to 1 lakh. So what is interest rate? 10%. Time is equal to 5%, 5 years. So compound interest means interest on interest will be calculated. Interest on interest will be calculated. For every compounded period, interest will be added to the principal. So first the conceptual one is principal 1 lakh, add first year interest. First year interest will be 10,000. So first year interest 10,000. That is 1 lakh into 10% into 1. For second year, principal will be 1 lakh thousand, because it is compounded, and that means for every compounded period, interest is calculated and it will be added to the principal. Plus second year interest 1,10,000 into 10% into 1, 11,000 will be the answer. So what is the amount? 1,21,000 is the amount. So 1,21,000 is the principal for the third year. So what is the third year interest? 1,21,000 into 10%, 12,100. So 1,33,100. So 1,33,100 is the principal for the fourth year. So fourth year interest 1,33,100 into 10%, that is 13,310. Now tell me what is the principal for the fifth year of 1,46,410. So fifth year plus fifth year interest. What is the fifth year interest? 14,641. So what is the amount? 1,61,051 is the amount at the end of fifth year. So conceptual calculation is this: you take principal, add interest for every compounded period. This is how we do. But every time we cannot do it, because it can be what? Compounded half yearly. If it is compounded half yearly, okay, it will take 2 pages, yes or no? If it is compounded quarterly, it will be too lengthy. So that's why we have a formula. What is the formula? A is equal to P into 1 plus I power n. You have to understand these words carefully. Principal 1 lakh is given as on today. Amount will be received in the future. That means principal is nothing but present value, amount is nothing but a future value. So this is the formula. So A is equal to principal 1 lakh into 1 plus 0.1 power 5. So what is the answer? 1,61,051. Okay. So here also students might take 1.1 in calculator, and again they might take about into 1.1, into 1.1, into 1.1, into 1.1. So that is time taking. So that's why we have a shortcut to find out the amount. So what is the shortcut? First in calculator we should take interest rate. First in calculator we should take what? Interest rate, that is 0.1. Next add 1, and next what? Multiply with the principal. 0.1 plus 1 into principal plus equal to n times. Okay. So while calculating, observe the numbers. 0.1 plus 1 into principal. So when you press equal to for the first time, you will get 1,10,000. That is amount at the end of the first year. Again equal to, you will get 1,20,000 at the end of a second year. Again equal to, you will get 1,33,100, which is at the end of a third year. Again equal to, you will get 1,46,410, which is at the end of a fourth year. So at the end of fifth year, you will get 1,61,051. Am I clear? Okay. So you should know this shortcut. Clear? So if it is compounded half yearly, then you should take half year interest rate in the calculator. So what is the half year interest rate? 0.05 plus 1 into principal 1 lakh. You will get 1,05,000. So that is amount at the end of the first half year. Again equal to, you will get 1,10,250. This is amount at the end of a first year. Again equal to, you will get 1,15,762.5. that is amount at the end of a 1.5 years. Be careful. So this time you have to press equal to how many times? Already 3 over, another 7 times, because for 5 years total half years 10. So once again, shortcut from the beginning, take I per half year, interest rate per half year, because it is compounded half yearly. So interest rate per half year plus 1 into principal, that is 1 lakh, press equal to n times. N times means not number of years, n means what? Number of periods. If it is compounded half yearly, we should take number of half years. If it is quarterly, we should take number of quarters. Done. So likewise, a quarterly, compounded quarterly means we should take quarter interest rate, that is 0.025 plus 1 into 1 lakh, press equal to 20 times, because 1 year is equal to 4 quarters, 5 years is equal to 20 quarters. You will get amount, so 1,63,862, and the compound interest is equal to 63,862. So practically, simple interest or a compound interest, which is relevant? Compound interest is relevant, because outside in society nobody is going to charge simple interest. Okay, even bank is going to charge what? A compound interest. Okay, the next concept, effective rate of interest. Sir, what is this effective rate of interest? How to find out this? Effective rate of interest means actual rate of interest we are paying over a year. Actual rate of interest. So this is also simple. How to calculate the effective rate of interest? For example, interest is equal to 8% per annum, compounded annually. First, compounded annually. Interest 8% per annum, compounded annually. So effective rate of interest will also be equal to 8% only. Effective rate of interest is equal to 8% only, because it is compounded annually. Compounded annually means the effective rate, the actual rate of interest we pay is 8% only. But however, if it is compounded half yearly, interest rate is equal to 8%, compounded half yearly. So then how to find out the effective rate of interest? Obviously your effective rate of interest is not 8% or less than 8%. You are paying more than 8%, because it is compounded half yearly. So if it is compounded half yearly, first you should take half year interest rate in the calculator. Half year interest rate in the calculator. So half year interest rate is what? 0.08 divided by 2. 0.04. Understand the meaning of the 0.04. This 0.04 is interest per 1 rupee per half year. 0.04 plus 1 is the principal amount, into 1. You are getting 1.04. Yes or no? What is this 1.04? If you are taking 1 rupee as a loan, you have to pay 1.04 at the end of the half year. Press again equal to. You will get 1.0816. What is the meaning of this 1.0816? You are taking 1 rupee, but you are paying at the end of the second year 1.0816. That extra amount, nothing but what? Interest. So that's why minus 1. 0.04 plus 1 into 1, press equal to 2 times, so minus 1. What is the amount you got? 0.0816. So convert this number into a percentage. That means 8.16 for the effective rate of interest. 8% per annum compounded half yearly means we are not paying 8%, we are paying effectively what? 8.16. For suppose if it is compounded quarterly, then take 0.08 divided by 4, 0.02. What is the meaning of this 0.02? 0.02 is interest per quarter plus 1 into 1, press equal to 1 time. You will get 1.02. That is amount you have to pay at the end of the first quarter. Press again equal to 1.0404. That is amount paid at the end of second quarter. Press again equal to 1.0612. So this is amount paid at the end of third quarter. Press again equal to 1.0824 is the amount paid at the end of a fourth quarter. Minus 1 principal. The balance is what? Interest. Convert into percentage, into 100. So 8.24% is the effective rate of interest we are paying. For suppose if it is compounded monthly, tell me effective rate of interest will increase or decrease? Effective rate of interest will increase. Simple common sense. How to calculate this? So I don't want the answer, tell me the process. 0.08 divided by 12 plus 1 into 1 plus equal to 12 times, and then what, minus 1 into 100. Clear? So this is how we calculate effective rate of interest. So this financial management is not just important for CA Inter. In life also we will be taking lot of decisions. We might take a loan, we might purchase asset. We should know the time value of a money. For suppose if you have an option to take a loan compounded quarterly and compounded monthly, will you take compounded quarterly or a compounded monthly? Compounded quarterly. For suppose if you are giving a loan, and there is an option to collect interest monthly or a quarterly, monthly. So okay, clear? This is the effective rate of interest. Another next concept is annuity. The next concept is what? Annuity. So first you should know the meaning of annuity. Annuity means same amount received or paid at same interval. Annuity means same amount received or paid at same interval. So annuity can be regular, annuity immediate. So annuity which is received or paid at the end of the period. So annuity received or paid at the beginning of the period is called as annuity immediate. Generally, if a question is silent, we assume the annuity as an annuity regular. Why is our annuity regular? For suppose if I purchase an asset, I will be receiving a benefit at the end of the year, at the end of the period. I will not get the benefit at the beginning. Okay, so that's why generally if a question is silent, we assume that annuity as an annuity regular. So annuity means same amount received or paid at the end of the, so at the same interval. Example, so if you take a car loan, you will pay equated monthly installment. So tell me what is this monthly installment? Monthly equal installment is paid every month. That means same interval, same amount. So that means what you are paying to the bank is an annuity. Okay, so clear? So annuity means same amount at same interval. Annuity regular means end of the period. Annuity immediate means beginning of the period. So here I have taken three cases. In these three cases, case 1 is not an annuity because amount is not same. Case 2, not an annuity because interval is not same. First year we are getting amount, but second year we are not getting any amount. Third year, yes, it is an annuity because same amount at same intervals. Okay, next. So this is very important concept. You should know what is the difference between the present value and the future value. Okay, so first of all, the principal and amount. We learn every concept from the basic, that is A is equal to P into 1 plus I power n. If you observe the shortcut of a compound interest amount, in calculator first we are taking I plus 1 into 1 into, and if you see the amount is always greater than principal. That is common sense point. If I give a loan to someone, so while taking back I will be taking with interest. So that's why amount will be always be greater than what? Principal. Yes or no? So principal is given as on today. That's why this principal is present value. Amount will be received in the future. So that's why amount is a future value. So present value, future value. So if a present value is given in the question, and if they ask you to find out the future value, I will go for compounding. I do compounding. Compounding means multiply. You can observe the shortcut of a compound interest amount. We multiply. But see the formula, A is equal to P into 1 plus I power n. But if a principal is given, present value is given, and if they ask you to find out the amount, that is future value, then what is the formula? P is equal to A divided by 1 plus I power n. A divided by 1 plus I power n. So that means if a future value is given and if they ask you to find out the present value, I will do discounting. Discounting means divided by. I will do discounting, that is divided by. Am I clear? Okay. So what is this A? Amount is a future value, P is a present value, I is a interest, N is equal to what? Years. So from here you should learn the concept. Example, what is the present value for rupee 1 to be received after 2 years, compounded annually at a 10% interest rate? What is the present value for rupee 1 to be received after 2 years, compounded annually at 10% interest rate? They are asking you to find out the present value of a 1 rupee to be received after 2 years. So that is simple. If they are asking you to find out the present value, we should divide. Divide with what? 1 plus I. Why? Because to find out the amount, we are multiplying with 1 plus I. Okay, to find out the present value, we should divide with what? 1 plus I. Clear? So that's why in calculator, take 1 divided by 1 plus I. What is I here? 0.1. So 1 divided by 1.1, press equal to only one time. So what is the number you are getting? 0.909. So understand the meaning of the 0.909. Okay. So what is the 0.909? Present value of a 1 rupee to be received at the end of the first year. Okay, or else you can put it like this. If you are investing 0.909 as on today, that will become 1 rupee by the end of the first year. Okay. Sir, why this present value factor is relevant? Why we are learning this concept? First, suppose if I have a asset, that can be an equity share, that can be a debenture, that can be a plant and machinery, that can be a building, that can be any business. Okay. Let us assume I have a asset which is going to give a future economic benefit of just 1 rupee at the end of the first year. Let us assume I have a asset which is going to give a benefit of just 1 rupee at the end of a first year. What is the value of that asset as on today? 0.909. This 0.909 is called as a theoretical value. Theoretical. We have learned one theory in the first class and applying that theory, and we are finding out the value, that is 0.909. The value you find in balance sheet, is called as a book value, balance sheet value. Historical cost means what? The amount at which we bought the asset is called as historical cost. Market value means what? For suppose if I sell the asset as on today, the amount which I get is called as a market value. So you should understand the differences between these values. Okay. So why I am learning this topic? Simple, to find out the value of asset. Valuation is very important concept. So these days if you follow business news, okay, regularly some company will be acquiring some other company. So mergers acquisitions are common thing around nowadays. How they acquire the other company? One company will be acquiring the other company. How can they acquire? So first of all, to acquire the company, they should know how much to pay. So that means they have to find out the value of the target company. So further we are learning FM and AFM. Clear? So, but here they are asking you to find out 1 rupee to be received at the end of the second year. In that case, we have to press equal to how many times? 2 times. 1 divided by 1.1, press equal to 2 times. So 0.826 is the value as on today, present value. So this can be put in other way, like as on today, if you invest 0.826, that will be equal to 1 rupee at the end of the second year. So this 0.826 is also called as present value factor at the end of the second year if rate of interest is 10%. 0.909 is called as a present value factor at the end of the first year if rate of interest is what? 10%. Clear? Done? Now see another example. You invest rupees 3000. For suppose if you are investing 3000 in a 2-year investment that pays you 12% per annum, calculate the future value of investment. They are asking you to find out the future value of investment. Sir, why we should learn this topic? Simple. Some mutual fund company might send you a mail. Okay, you invest something as on today, you will get something in the future. Okay, if a non-CA is following the mail, non-CA blindly what investing, that's fine. But as a chartered accountant, you should know the time value for money. You should calculate on your own what rate of a return are you getting. Okay, so here simple, you are investing 3000 rupees. What is the rate of interest? 12% per annum. They are asking you to find out the future value of investment. Nothing but they are asking you to find out what amount. So in calculator take 0.12 plus 1 into 3000. So understand the meaning. 0.12 interest rate per 1 rupee plus 1 into what? 3000 actual principal, press equal to 1 time, you will be getting 3360. What is this 3360? Amount at the end of the first year, again equal to 3763, amount at the end of the second year. Am I clear? Okay, now come to the annuity shortcut steps using the calculator. Okay, annuity. Now let us understand the annuity concept. Annuity means what? Same amount at same intervals. So why we should learn this topic? For example, in capital bursting we have a concept called equated annual cost. Equated annual cost and equated annual benefit. So equated annual cost or equated annual benefit, to find out that equated annual cost or equated annual benefit, you should learn this annuity concept. Because equated annual cost is also an annuity, equated annual benefit is also annuity. Annuity means same amount at same intervals. The name itself indicates equated annual. Equated means equal, annual that means every year. So that is an annuity. So to learn this concept, likewise we have several concepts like sinking fund investment. Sinking fund investment. Okay, we have a capital bursting topic, dividend decisions topic, and in final level we have a security valuation topic, derivative valuation topic, we have a corporate valuation topic, valuation, that means wherever there is a valuation word, that means we need to learn time value of our money. Okay, so annuity means what? Same amount at same intervals. Same amount at what? Same intervals. So see the example before seeing the shortcut. First, suppose annuity is equal to 10,000, interest I is equal to 12%, N is equal to 5 years. So 4 categories we are going to learn here. Okay, one is present value of annuity regular, one is present value of annuity immediate, third future value of annuity regular, future value of annuity immediate. Okay, I am taking an example. First, suppose let us assume there is an asset which is going to give a benefit of 10,000 rupees every year for next 5 years. Are you getting my point? For suppose there is an asset. So what can be an asset? Example, there can be a debenture, annuity bond. Annuity bond means what? Annuity bond means simple. You know the concept of what? Bank loan. For suppose if I take a bank loan, I will pay equated monthly installment to the bank. Now this equated monthly installment is an annuity. Am I correct? Okay. Likewise, we have a concept of a debenture. What is this debenture concept? Debenture means a debt. Who is taking this debt? Company is taking the debt. From whom it is taking? From the public. So public giving debt to the company, company is taking the debt, and company is going to pay interest to the public. In bonds there are several categories, but the fundamental categorization is plain vanilla bond. There is a concept called plain vanilla bond. What is this plain vanilla bond? Plain vanilla bond means simple. Company will take debt, company issue debentures to the public. Okay, that means company is taking money as on today. What company will do is company will pay 1 to n number of years interest. 1 to n number of periods it will pay interest. Every year or every half year it will pay interest. At the end of the nth period, it will pay the redemption value. It will pay the redemption value. This concept is called as what? Plain vanilla bond. So we have a concept of zero coupon bond. So what is this zero coupon bond? Zero coupon bond means company will take money. It will not pay any interest because zero coupon, zero interest. And at the end of the nth period, on the maturity, it will pay back the money. But the amount taken as on today and paid in the future is not same. Generally, zero coupon bond is issued at discount, redeemable at face value. For example, face value 10,000. So what does it mean? That means at the end of the nth period, company will repay 10,000. But now company will issue this bond at a discount. That means it will be issuing the bond less than 10,000. Example 6,500. Now the company will issue the zero coupon bond for rupees 6,500. That means the company will collect 6,500 from the customer, public, and will pay 10,000 in the future. Okay, what is the benefit to the investor? 3,500 rupees. Discount is the benefit to the investor. What is the cost to the company? 3,500. Okay, here no interest, nothing. So discount itself is the cost to the company, benefit to the investor. So this is called zero coupon bond. Okay, if you see from the perspective of an investor, in zero coupon bond he will receive only one cash flow. He will receive only one cash inflow, that is at the end of the nth period. Okay, but whereas in plain vanilla bond, investor will receive every period interest, and at the end of the nth period he will receive a redemption value. Clear? Next we have a concept of perpetual bond. Perpetual bond means company will be taking a loan from the public and will pay interest forever. Will pay interest forever. Perpetual means what? Continuous. And next we have a concept of annuity bond. What is the meaning of this annuity bond? Like we pay equated monthly installment to the bank, here also company will be taking loan from the public and company will pay this loan to the investor in the form of an annuity. That means it will pay equal installment to the public. Like we pay EMI to the bank, here company will pay equal installment to the public. So this concept is called as what? Annuity bond. For company it is a liability, but for investor it is an asset. Yes or no? Now, for example, I am taking an example. 1, 2, 3, 4, 5. Cash flow 10,000. Cash flow 10,000. That can be inflow or outflow. For example, for company it is outflow. For investor it is inflow. If it is an annuity bond, I am taking an example of an annuity bond. So annuity bond means equal installment. The debt is repaid in equal installment. Now tell me, what is the benefit received by the investor every year? 10,000, 10,000, 10,000, 10,000, 10,000. So what is the cost to the company? 10,000, 10,000, 10,000, 10,000. Okay. So factor is 12%. What is the rate of interest here? 12% is the rate of interest, required rate of a return. So now How I have to find out the present value of a annuity. How can I find out the present value of a annuity? Simple. Understand it conceptually, please do not by heart, okay? If you are not able to understand, please let me know again, I will be explaining again, but please do not by heart these concepts, okay? So simple, in calculator, take 1 divided by 1 plus I. What is I here? 12%. So 1 divided by 1 plus I. So that is 1 divided by 1.12. Press equal to only once. Only equal to once. So you will be getting 0.892. Sorry, 893. Proper rounding off has to be done. On screen also it is 0.892, but we should take 0.893. So what is the meaning of this 0.893? If you are getting 1 rupee at the end of the first year, the value of that 1 rupee as on today is 0.893 if rate of interest is 12%. Clear? So value always depends on two factors, the benefit we get and the required return. So that I will explain again in the first topic. Now the point is 1 divided by what? 1.12 press equal to 1 time only. You are getting what? 0.892. So what is the meaning of this? For suppose, let us assume the bond is going to give only 1 rupee benefit at the end of the first year. What is the value? 0.892 is the value of a bond as on today. But bond is not giving a benefit of 1 rupee, and that too only for 1 year. It is giving a benefit for 5 years. Press again equal to, you will get 0.797. What is the meaning of this 0.797? This is the value of a bond. If a bond is going to give a benefit of only 0.797 at the end of the second year, press again equal to 0.712. 0.712. What is the meaning of this 0.712? If a bond is going to give a benefit of only 1 rupee at the end of the third year, then the value of the bond is 0.712. Press again equal to 0.636. What is this 0.636? If a bond is giving a benefit of 1 rupee at the end of the fourth year, then the value is 0.636. Press again equal to 0.567 or 8. What is the meaning of this 0.568? If the bond is going to give a benefit of only 1 rupee at the end of the fifth year, then the value is 0.567 or 8. But tell me, here the bond is giving only 1 rupee benefit at the end of the fifth year? No, it is giving benefit for all the 5 years, same amount at same interval. So that's why. So understand what we call these numbers. Whatever the numbers we got till now, that is 0.893, 0.797, 0.712, these are called as present value factors. 0.893 is called as a PV factor for first year at the rate of 12%. 0.568 is called as a PV factor at the rate of 12% for fifth year. For fifth year, we cannot say for 5 years. It is for fifth year. So, okay, press GT, grand total. So now understand these number. If you press the grand total, you will get the total of all these 5 numbers. All these 5 numbers, 3.606. 3.606 or something. So what is the meaning of this 3.606 or 5? If you are getting 1 rupee benefit for every year for 5 years, then the value of that asset as on today is 3.604 or 5 or 6. Okay, you should take a proper rounding off. If you take proper rounding off, what is the number? 3.606. Okay, fine, clear. But here tell me, asset is giving 1 rupee benefit every year. It is giving benefit 10,000 rupees every year for how many years? 5 years. So that's why multiply with what? 10,000. Clear? So 36,047 is the answer. So that means, tell me, so is the formula on the screen is logical or not? Present value of annuity regular is equal to annuity into present value annuity factor regular. Annuity is equal to, if they ask you to find out the annuity, example equated annual cost, that is an annuity. Present value of annuity regular divided by present value annuity factor. Yes or no? Okay, clear? Now, so why here, see the shortcut. Take 1, divide with what? 1 plus I, press equal to how many times? N times. Understand the logic. Y equal to press equal to n times. Annuity regular means end of the period. First year ending means 1 time discounting, second year ending means 2 times discounting, third year ending means 3 times discounting, fourth year ending means 4 times discounting, fifth year ending means 5 times discounting. So that's why press equal to how many times? N times, and then what? Grand total, multiply with annuity, and then smile. Okay, only 5 steps. Clear? But for suppose if it is an annuity immediate, if it is annuity immediate, not present value annuity regular. If it is an annuity immediate, present value of annuity immediate is equal to annuity into present value annuity factor immediate. Annuity into present value annuity factor immediate. So annuity is equal to what? Present value of annuity immediate divided by present value annuity factor. Okay. Now, example, annuity is equal to 10,000, interest is equal to 12%, n is equal to 5 years. Again, same concept, but the only difference is earlier we are getting a benefit at the end of the year. Now we are getting benefit, or we are incurring expense at the beginning of the year. Beginning means, for example, first year beginning means as on today. For suppose as on today, if you have a 1 rupee, that 1 rupee value is equal to what? 1 rupee, and we need not discount. We need not discount. Yes or no? Am I clear? But second year beginning means first year ending, third year beginning means second year ending, fourth year beginning means third year ending, fifth year beginning means fourth year ending. Okay. So if you see the table, first year I am taking PV factor 1 rupee. Why I am taking 1 rupee? Because first year beginning means as on today, and as on today if I have 1 rupee, that value is 1 rupee only. Second year beginning means what? Okay, end of the first year, so that's a one time discounting. So what is the shortcut for present value of annuity immediate? Understand this properly. Okay, in calculator first we take 1 divided by 1 plus I, that is 1.12, 1 divided by 1.12, press equal to 1 time, you will get 0.893, and it is not applicable for the first year annuity. This is second year beginning, it is applicable for second year beginning. Second year beginning means first year ending. Understand this properly. 0.893 again equal to 0.797 again equal to 0.712. Okay, and next word 0.636. Clear? So what is this 0.636? It is the present value which is applicable for present value factor which is applicable for fifth year annuity. Fifth year beginning means what? Only fourth year ending. Now we should press grand total. If you take the grand total, then you are getting a total of 4 numbers. Okay, so now we should add 1. Why we should add 1? This is for the first year beginning annuity. So what is the number you are getting? 4.038. So what is the meaning of this 4.038? If you are getting 1 rupee every year at the beginning, then what is the value of asset as on today? 4.038. here in 10,000 rupees, so that's why the value is 40,380. Am I clear? So if it is annuity immediate, take 1, divide with 1 plus I, press equal to n minus 1 times only. Why n minus 1 times? Because for 5th year annuity, I have to 5th year beginning means 4th year ending. So I have to do discounting only for 4 times. So that's why press equal to n minus 1 times, press grand total, add 1, multiply with what? Annuity. Clear? Am I clear? Now come to the future value of annuity regular. Future value of annuity regular. Now this time we are not finding out the present value, we are finding out what? Future value. Future value means we should go for compounding. Okay, so annuity into future value annuity factor regular. Future value of annuity regular is equal to annuity into future value annuity factor regular. So that means annuity is equal to what? Future value of annuity regular divided by future value annuity factor. Future value annuity factor. Am I clear? Again same example, annuity 10,000, interest at 12%, n is equal to 5 years. This time what they are not asking present value as on today. N is equal to 5 years means they are asking the value at the end of 5th year. At the end of a 5th year. Annuity regular, future value, they are asking future value, not the present value. For example, first year ending 10,000. First year ending 10,000. Tell me first year ending 10,000 means we have to find out the value at the end of the 5th year. How many years are we going to get interest? 4 years only. Second year annuity means we get interest only for 3 years. Third year ending means we get interest only for 2 years. Fourth year ending means we get interest only for 1 year. Fifth year ending means we get interest 0. Okay, so that's why while finding out the future value of annuity regular, be careful. In calculator, first we should take I. This time we are going for future value. It is similar to compound interest. First we should take 0.12 plus 1 into 1. Press equal to 1 time. So what is the number? 1.12. What is this 1.12? For suppose if you are receiving 1 rupee at the end of 4th year, 1 rupee at the end of a 4th year, that 1 rupee will be equal to 1.12 at the end of the 5th year. We are finding out future value. Press again equal to. You will get 1.2544. 1.2544. What is the meaning of this 1.2544? If you are getting 1 rupee at the end of the 3rd year, that 1 rupee will be equal to 1.2544 at the end of the 5th year. Press again equal to 1.404. What is this 1.404? If you are getting 1 rupee at the end of the 2nd year, and if you reinvest this, then this will be equal to 1.404 at the end of the 5th year. Press again equal to. So 1.5735. What is this 1.5735? If you are getting 1 rupee at the end of 1st year, and if you are reinvesting this for next 4 years, then at the end of 5th year you will be getting 1.5735. Press grand total and then add 1. Okay, you will be getting 6.35. Okay, what is this 6.35? For suppose if you are investing 1 rupee every year at the end of, if you are investing 1 rupee at the end of every year for next 5 years, then by the end of 5th year you will be having 6.3519. But here you are investing what, 10,000 rupees. So that's why what is the value you are going to have at the end of the 5th year? 63,509. Clear? Are you able to understand this? So that means if you are finding out the future value of annuity regular, first you should understand difference between present value and future value. If a future value is given and we have to find out the present value, we have to do discounting. If a future value is given and they are asking you to find out, if the future value is given and if they ask you to find out the present value, we do discounting. If a present value is given and if they ask you to find out the future value, we go for compounding. Is it clear the difference? Okay. So what is the shortcut for future value of annuity regular? Take I, add 1, multiply with 1, press equal to n minus 1 times, press grand total, add 1, multiply with annuity. Are you able to understand why we are pressing equal to only n minus 1 times? Done. Now future value of annuity immediate. So what is future value of annuity immediate? Immediate means beginning of the year. For suppose if you are investing 1 rupee every year at the beginning for next 5 years, then this time you have to press equal to how many times? N times. Okay. Why n times? You are investing at the beginning. Investing at the beginning means if you are investing first year beginning, then you will get interest for n years. Okay. And if you are investing 1 rupee at the beginning of the nth year, you will get interest for 1 year. Okay. So that's why. So what is the calculation for future value of annuity immediate? Future value of annuity immediate. In calculator we take future value. Future value means compounding. In calculator we take 0.12 plus 1 into 1. So what is this 1.12? Fifth year beginning, you are investing 1 rupee. That 1 rupee will become 1.12 at the end of the 5th year. Press equal to again 1.2544. What is this 1.2544? So this, so if a 4th year beginning, if you are investing 1 rupee, that 1 rupee will be equal to 1.2544. Press equal to again 1.404. What is this 1.404? If you are investing 1 rupee at the beginning of the 3rd year, that will be equal to what at the, that will be equal to 1.404 at the end of the 5th year. These are future value factors. Press equal to again 1.572. What is the meaning of this? If you are investing 1 rupee at the beginning of the 2nd year, that 1 rupee will be equal to 1.572. Clear? Press again equal to 1.76 something. If you are investing 1 rupee as on today, you will get interest for how many years? 5 years. And that will be equal to 1.76 something. Press GT, grand total 7.11. So what is the meaning of this 7.11? If you are investing from today after listening to this class, you started depositing 1 rupee every year for next 5 years, then at the end of the 5th year you will be getting 7.11. Okay. So this is what SIP. You know the mutual funds SIP. SIP means systematic investment plan. So their target is to what? Salaried employees. Salaried employees, they will get what? Every month salary. So this mutual funds, what they will say is they will be targeting the salaried employees and they will be motivating the salaried employees to make a systematic investment plan. That means what? Every month they will ask you to invest 1000 rupees. Every month 1000. They keep on investing 1000 rupees every month, and they will say like after 10 years you will have a 50 lakh, 60 lakh something. Okay. After 10 years. Okay. So for suppose, let us assume there is a systematic investment plan. What is a systematic investment plan? 1000 rupees. Investing 1000 rupees every month. Investing 1000 rupees every month. Okay. And 1000 rupees every month. Mutual funds is offering like, mutual funds is giving an offer. So what is the offer? If you invest 1000 rupees every month, you will get 10 lakhs after 10 years. Clear? This is the offer given. Okay. This is the offer you have. You invest 1000 rupees every month for next 10 years, and after 10 years you will get what? 10 lakhs. Clear? There is another option, okay, giving 1000 rupees to Amar film producer every month at the rate of 15%. See the second option. What is the second option? You give 1000 rupees every month and the opposite person is going to pay rate of interest 15%. Okay. First, you have to decide between these two. Yes or no? Between these two. So now how to decide? Simple. In calculator you have to take 0.15. Why sir 0.15? Because if I invest elsewhere, I can get 15% rate of interest. Yes or no? So 0.15 plus 1 into 1. What is this 1.15? If I invest 1 rupee with the producer, 1 rupee, I will get 1.15 by the end of what? 1 year. By the end of 1 year. But we are talking about per month, right? So that's why in calculator take 0.15 divided by 12. 0.15 divided by 12. Okay. 0.15 divided by 12. You will get per month interest rate. So what is the per month interest rate? You are restricting to 2 decimals, huh? Okay. So 0.15 divided by 12. You will get 0.0125. Yes or no? Plus 1 into 1. What is this? If you are giving 1 rupee to the film producer, you will get 1.0125 by the end of 1 month. 10 years means how many months? 120 months, right? So already one time equal to you pressed. So you press equal to another 119 times and take grand total. Press equal to another 119 times. Okay, what is the number you are getting? 4.44. What is the 4.44? For suppose if you are investing 1 rupee as on today, that 1 rupee will be equal to 4.44 by the end of the 120th month. But you are not just investing 1 rupee, you are investing 1 rupee every month. Annuity. So that's it, take grand total. What is the number you are getting? 279.68. 279.68 into what? 1000. You are investing 1000 rupees, right? So 2 lakh or 27? 2 lakh 79,682. This is the amount you will be having after 10 years if you are giving what to producer. But if you are investing in mutual funds, you will get 10 lakhs. Obviously you will not get. So the question should be like 10,000 instead of 1000. If you are investing 1000 rupees every month, you will get 10 lakhs at the end of the 10th year. This is the mutual fund offer. Okay. So then if you are giving to the film producer, then what is the value you will be having? 27 lakh 96,823. So which is the better option? Giving to the producer will be the better option. Okay. Actually the question should be instead of 1000 we should take 10,000, because mutual fund will not give return more than 15. Clear? So are you able to understand? So are you able to understand how to find out the Systematic investment plan future value. Systematic investment plan future value. Clear? Now comes the valuation concept. It is very important concept, valuation. I'm going to discuss 5 examples. These 5 examples are very, very important. Okay. So value of any asset, value of any asset is equal to the present value of a future benefit. Present value of a future benefit. Value of any asset, whether it is a mobile, laptop, okay, fan, light, everything, okay. Value of any asset, debenture, plant and machinery, you and me, human resource valuation. We have a concept of human resource valuation, brand valuation, business valuation, security valuation. We have a capital bursting chapter. Value of any asset is equal to what? Present value of a future benefit. This is the popular valuation method. Popular valuation method. Okay. So generally, if there is no future economic benefit, then value of asset is equal to 0. That's why if you die at the age of 21 years, no one will cry. Why? There is no economic benefit, right? There is no economic benefit. You have seen everything. So that's why if you die at the age of 91 years, nobody will cry. Okay, kids will be playing on your dead body, right? So the reason is what? Simple. There is no future. When there is future, there is a value. Okay. If something happens to someone at a young age, then everybody will feel sad, as or no, because the reason is what? There is a future. That means if there is future, then there is a value, otherwise no. Likewise here also, value of any asset is equal to what? Present value of a future benefit. How can we find out the value of any asset? We should bring the future benefit to the present value. That's it. So we can categorize the assets into 5 depending upon the benefit how they give. Asset may give a benefit, even cash inflow for definite period. First category. Asset may give single cash flow like zero coupon bond. If as an investor, if I purchase a zero coupon bond, I will receive only face value at the end of the nth period. Yes or no? So single cash flow or a multiple uneven cash inflow. Multiple uneven cash inflow, best example for multiple uneven cash inflow is plant and machinery. Plant and machinery will give a multiple uneven means not equal cash flow for definite period. Plant and machinery life is limited to 5 years or 10 years. It cannot have an indefinite period life, yes or no? So example 4, even cash flows for indefinite period. Generally building will give a limited benefit, plant and machinery will give a benefit for limited period, but if you are investing in equity shares, you will receive a benefit for indefinite period. Okay, if you buy the equity share of a BCCA, you will get benefit for what? Indefinite period. Yes or no, Amar? Yes. Okay, why you will get benefit for indefinite period? Because the reason is, now I am teaching financial management, but after 5 years Amar may teach financial management. Yes or no? After that, what? Amar kids may teach FM. So here the person is not permanent, business is permanent. Okay, so if a person is purchasing an equity share of ITC or a Reliance, he will receive a benefit for what? Indefinite period. Likewise, cash flows for indefinite period with growth rate. This also happens in equity shares. In business it happens, because if you are investing in business, you will get cash flows for indefinite period, and there can be a growth also every year. So there will be a growth as well. Okay, so that's why assets we can categorize into 5 based on the type of a cash flows they give. What is the first category? Even cash flow. So even cash flow, if you see the example, even cash flow. So what is the example I have taken? 1 to 5 years, asset is giving a benefit of a 10,000 and the time value for money is 10%. So how this time value for money depends? Time value for money, interest, risk, this 10%, it depends upon what? Risk, postponement of present consumption, inflation and opportunity cost. Yes or no? If asset is giving a benefit of 1 to 5 years and cash flow 10,000, and the what is the rate of interest, I mean required return 10%. How to find out the value? Even cash flow means annuity. You are receiving the same amount at same intervals. Annuity means we multiply with what? Annuity factor. Present value annuity factor. Then you will get present value of a annuity. So how to get this present value annuity factor? 1 divided by 1.1 press equal to n times grand total. When question is silent, we assume that annuity as a annuity regular. Clear? So what is the value? 37,910. Clear? Are you able to understand how to find out this? Okay. Next, single cash flow. Single cash flow, we cannot write 1 to 5. It is at the end of the 5th year. At the end of what? 5th year. So at the end of 5th year, we are receiving a benefit of 10,000 rupees. Example, if you purchase a zero coupon bond, you will not get coupon. Coupon means interest. You will be receiving only face value at the end of the nth period. Here example n is equal to 5. That means investor will receive only 10,000 at the end of the 5th year. Single cash inflow means we should multiply this 10,000 with present value factor. How do we get this 0.621? 1 divided by 1.1 press equal to 5 times. Next, multiple uneven cash inflow. Multiple uneven cash inflow means what? Example, okay, so here plant and machinery, example plant and machinery. Is it going to give a benefit for indefinite period or what? No. Plant and machinery may give a uneven cash inflow for a definite period. When the cash flows are not equal, uneven, we cannot multiply with present value annuity factor. We should take what? Separate cash flows, year 1, year 2 and year 3 separate, and we should multiply individually with what? Present value factor. So what is the value I am getting? 25,686. I am bringing the future benefit to the present value. I hope you know how to find out these factors, 0.909, 0.826, 0.751. Are you getting my point? So these examples are very important. Very, very important. If you are not understand, please let me know. Next, even cash flows for indefinite period. If you are investing in plant and machinery, you will receive a benefit for definite period. If you are investing in, okay, building, then also limited period. But if you are investing your money in business, you will receive a benefit for indefinite period. For example, Tata Sons Limited. Okay, it was incorporated more than 150 years ago. Still, the company is in operation, yes or no? So, if you are investing in a business, you will get a benefit for indefinite period. If you are purchasing an equity share, you will receive a benefit for indefinite period. That is the assumption we take. So 1 to infinite years means we cannot take 1 divided by 1 plus I press equal to infinite times. We cannot press equal to infinite times and take grand total, yes or no? But this is very simple. If there is an asset which is giving a benefit of 10,000 for n number of years, infinite years, and if required rate of return is 10%, then what is the value? Simple, annual benefit divided by required return. Benefit divided by required return. What is the benefit? 10,000 divided by 10%, 1 lakh. Okay. So what is this 1 lakh? Simple. If there is an asset which is going to give a benefit of 10,000 every year for next, okay, infinite years, the value is 1 lakh. So generally some students who have a deep thinking, they might be wondering like, sir, asset is going to give a benefit for indefinite period. That means not 10 years, 20, 40 or 50 years. It is going to give a benefit for indefinite period. And you are seeing the value of asset is just 1 lakh. Just 1 lakh. How it can be? For example, in calculator take 1 divided by 1.1 press equal to 10 times. Press equal to 10 times and take the grand total. What is the number you are getting? 6.144 into 10,000. 61,445. What is this? If there is an asset which is going to give a benefit of 10,000 rupees for next 10 years, what is the value of asset as on today? 61,446. Okay, sir, you're telling like if asset is giving a benefit just for next 10 years, the value is 61,446. But here in our example, the asset is going to give a benefit of not 10 years, infinite period, and you are saying that asset value is just 1 lakh. I think it is wrong. Okay, let us take 20 years. You take 1 divided by 1.1, press equal to 20 times and then grand total. 1 divided by 1.1, press equal to 20 times and then grand total. You got 8.51 something into 10,000. What is the meaning of this 85,136 you got? If you are getting a benefit for next 20 years, 10,000 rupees, the value as on today is 85,136. Sir, that means 20 years benefit, the value is 85,000. And you are saying infinite period, the value is 1 lakh. Something is wrong, sir. If we take 50 years, then that value might exceed this 1 lakh. No, you will get 99,990 something. If you take for 100 years, if you are considering benefit for 100 years also, you will be getting what? 99,999 point something. That's it. 1 lakh value will not exceed. Why, sir? Because if you are receiving 10,000 after 100 years, if you are receiving 10,000 rupees after 100 years, that value will be as on today 0.001 something. Are getting my point? Okay. So simple. So even cash flows for indefinite period, value is equal to annual benefit divided by required return. Done. So this question generally they might ask like in CA foundation book. So there is a school principal. He wanted to give 10,000 rupees gift on every anniversary. Okay, he can make an investment at the rate of 10%. He wanted to gift 10,000 rupees on every anniversary for indefinite period. Okay, how much investment he should make as on today? If he can make investment at the rate of 10%? Answer is simple. Okay, so what is the amount of investment he should make? 1 lakh. Are getting my point? If he invests 1 lakh as on today, he can gift 10,000 rupees every anniversary for indefinite period. How? Simple. 1 lakh into 10%. Every year he will get 1 lakh into 10%, 10,000 that will be spent on an anniversary. Simple. Next one, example 5. If there is a growth, remember these examples, okay? Because in capital structure we write value of a firm is equal to EBIT divided by KO. That is similar to example 4. Value of firm is equal to EBIT divided by KO. Why EBIT? Because if you invest in a firm, you receive a benefit of a EBIT for indefinite period. Okay. Why KO? Because required return of a firm is equal to overall cost of a capital KO. Clear? Fifth example, cash flows for indefinite period with growth rate. If there is a growth, then value is equal to annual cash inflow divided by required return minus growth rate. So this again we are going to discuss in Gordon's growth model. Okay, so K is equal to, you know the cost of a capital. So we have not yet discussed the cost of a capital topic, but as this is EO batch, you might be already knowing cost of equity K is equal to D1 by P naught plus C. That means what? Ke minus G is equal to d1 by P naught. Then P naught is equal to d1 by Ke minus G. Yes or no? If you see the formula, P naught is equal to d1 by Ke minus G. This is Gordon's growth model. D1 means dividend at the end of the first year divided by cost of equity Ke minus growth rate. Is it similar to a fifth example or not? Yes. Dividend is a benefit received by the equity shareholder. Ke is a required return of a equity shareholder minus growth rate. Clear? Done. Example 5, is it clear? Are you able to understand this example number 5? Example number 5. Clear? Now let me discuss IRR concept. So after discussing IRR concept, we can have a break. Clear? Let us complete IRR concept. Internal rate of a return. Internal rate of a return. Actually, this IRR concept is an advanced concept, but I am discussing here itself because to solve the cost of a capital questions, we need this concept, internal rate of a return. Internal rate of a return, IRR. IRR. At final level, we call it as YTM, yield to maturity. Yield to maturity, IRR. Okay, so you have to understand this conceptually. It is a discount rate. IRR is what? IRR is a discount rate at which sum of a discounted cash inflows are equal to sum of a discounted cash outflows. IRR is a discount rate at which sum of our discounted cash inflows are equal to sum of our discounted cash outflows. Okay. So generally when I ask students what is IRR, they will say internal rate of a return. So that is not the answer I expect. IRR is a expected rate of a return from the project. So for example, okay, construction companies will be constructing a road. Generally mutual funds company will be asking what is the IRR from that particular project. What is the IRR from the particular project? IRR means what? Return. The return what we are expected to get. Okay, so IRR is nothing but what? Expected rate of a return from the project. For example, 20% is the IRR of the project. Metro rail project IRR is equal to 20%. What is the meaning of this? The company is expected to get 20% rate of a return on a metro rail project. Okay, and that is the general meaning. So how to find out, to calculate? The meaning to be remembered is it is a discount rate at which the sum of our discounted cash inflows are equal to sum of our discounted cash outflows. Sir, why we are writing like this? I'm starting with a small example, very small example. Please be focused for the next 25 minutes. Okay, example, I'm taking an example. Principal is equal to 1 lakh. Amount is equal to 2 lakhs. N is equal to 5 years. Rate of interest is equal to question mark. Rate of interest is equal to question mark. Principal is equal to 1 lakh. Amount is equal to 2 lakhs. N is equal to 5 years. I is equal to what? Question mark. Generally at foundation level, you will be finding I by using the options given in the answer, because QA is a multiple choice question paper pattern. So 4 options will be given, principal is given, N is given. You know how to find out amount, yes or no? I plus 1 into principal plus equal to what? N times. Okay, you choose the option where you get amount 2 lakhs at foundation level. But at inter level, how can we find that I? Because option is not given, yes or no? How can we find out? You write the formula. What is the formula? A is equal to P into one plus I power N. This formula we can apply. By applying this formula also we cannot find I directly. Let us see. What is the amount? 2 lakhs is equal to principal 1 lakh into 1 plus I. This concept is very important. I am discussing in introduction, but in investment decision I am not going to deep there. 2 lakhs is equal to 1 lakh into 1 plus I power N. Yes or no? Now 1 plus I power N is equal to what? 2. That means 1 plus I is equal to 2 power, what is N here? 5. 2 power 1 by 5. 1 plus I is equal to 2 power 1 by 5. Can I find out 2 power 1 by 5 or not? Answer is no. I cannot find out 2 power 1 by 5. For that I need logarithms and anti-log and all. Okay. So we cannot find. Okay. So that's why at foundation level applying amount formula and all is fine. But at inter level, CA inter level, we cannot apply this amount formula. But from the amount formula only we are going to learn the concept. So what is the concept? First of all, the way of asking the question itself will change. The way of asking the question itself will change. Okay. So first example, how they ask you single cash flow. The way of asking the question itself will change. If you see the example, from the basics I am starting, the advanced concept IRR. Principal and amount is given, they are asking you to find out I. Okay, at CA inter also we are going to find out I only, but we are not calling it as I, we are calling it as a IRR, internal rate of return. So how the question is asked? First, investment is equal to 1 lakh. Cash inflow at the end of 5th year is equal to 2 lakhs. Investment is equal to 1 lakh. Cash inflow at the end of 5th year is equal to 2 lakhs. Are you able to understand? The way of asking the question is different, but the numbers are same. Principal, you give 1 lakh as on today, get 2 lakhs at the end of 5th year. Here, invest 1 lakh in project, get 2 lakhs at the end of a 5th year. But they, instead of asking I, they will ask you to find out what? IRR. internal rate of a return, expected return from the project. At foundation level also, for the lender, I is the return. Interest rate is nothing but what? Return to the lender, IRR to the lender, yes or no? Here also, for the investor, IRR is the return. So they are asking you to find out IRR. So how to find out this? Simple. I use a basic formula. What is the basic formula? A is equal to P into 1 plus I. Do not, okay, go away from this concept, because you have to maintain the link, especially here. A is equal to P into 1 plus I power n. So that means P is equal to A into 1 divided by 1 plus I power n. P is equal to A into 1 divided by 1 plus I power n. Yes or no? P is equal to A into 1 divided by 1 plus I power n. Okay. Now understand what is this P. P is a principal, present value. A is equal to future value. Yes or no? What is this 1 divided by 1 plus I power n? 1 divided by 1 plus I power n is nothing but present value factor. 1 divided by 1 plus, for example, 0.12. If n is equal to 5, 1 divided by 1.12 plus equal to 5 times. What is that present value factor? Am I correct? That means, so be careful, I am taking time here. What I am writing? So instead of principal, I will write initial cash outflow. Yes or no? Can I write like this or not? Initial cash outflow. Amount, I am writing cash inflow. I am not writing initial. Why not initial? Because I am not getting as on today, I am getting in the future. So that's a cash inflow into what? PV factor at the rate of IRR. Can I write like this or not? Here I means interest rate. For lender it is what? IRR, return, yes or no? Understand carefully. Initial cash outflow is equal to cash inflow into PV factor at the rate of IRR. Can I write like this or not? If you are not able to understand, ask me. Because without knowing IRR, cannot. Instead of principal, I am writing what? Initial cash outflow. Instead of amount, I am writing cash inflow. Instead of 1 divided by 1 plus I power n, I am writing PV factor at the rate of IRR. Can I write like this or not? Yes. Now, in IRR concept, if they ask you to find out IRR, that means what? Initial cash outflow information will be given. What is the initial cash outflow? 1 lakh is equal to cash inflow 2 lakhs. We have to find out what? PVF. We have to find out the discount rate. See the sentence. What is IRR? IRR is a discount rate at which sum of a discounted cash inflow. If you discount the cash inflows, that cash inflows must be equal to the cash outflows. Okay, clear? Now I should find out what? First I will find out PV factor, and then I will be finding out the rate at which this PV factor lies. Clear? So what is the PV factor? PV factor is equal to 0.5. 1 lakh divided by 2 lakhs. Now, so I should find out the rate at which this 0.5 factor lies for the 5th year, because n is equal to 5 years, right? So I don't know. I will do a trial and error. Trial 1 at the rate of 10%. PV factor for the 5th year is equal to Trial 1, I do not know the rate at which this 0.5 lies. Let's go on a trial and error basis. So trial 1 at the rate of 10%, PV factor for the 5th year is equal to 0.1 divided by 1.1 plus equal to how many times? 5 times. You will get 0.621. But what is the desired factor? I should get 0.5. Okay, the factor has to decrease. That means rate has to be increased. If I increase the rate, value will decrease. You can see the valuation of asset concept also. If I increase the rate, value will decrease. Trial 2 at the rate of 15%. PV factor for the 5th year is equal to 0.497. So what is the desired factor? I should get 0.5. That 0.5 lies between what? 0.621 and 0.497. Are you getting my point? So that means IRR lies between 10 and 15. Approximately it is 15. You can write approximate answer is equal to 15. But if you want to find out the accurate answer IRR is equal to, try to understand this interpolation. IRR is equal to 10 and 15. It lies between 10 and 15 because the desired factor is 0.5. That 0.5 factor is lying between what? 0.621 and 0.497. For suppose at 15% I got 0.5. What does it mean? IRR is equal to 15. Straight away I will write IRR is equal to 15. For suppose at the rate of 10% I got 0.5. IRR is equal to 10%, but I got 0.621. So that's why I have gone for another trial. And here you should observe one point. If the rate increases, value decreases. That's why the fundamental point in FM is financial management, or AFM is, if required rate increases, first if risk increases, required rate increases. If required rate increases, wealth value decreases. Our superior objective is wealth maximization. So that we are going to learn in scope and objective of FM. So IRR is equal to 10% plus, definitely 10% plus, because the desired factor lies between 10 and 15 means IRR greater than 10, less than 15, 10% plus. At 10%, what is the factor? 0.621. I am taking 10% as a basis. Be careful. At 10%, 0.621 is the factor, but I want a 0.5. That means the desired change in the numerator, I should take a desired change divided by 0.621 minus the change we have. What is the change we are having? 0.621 minus 0.497 into 5%. So what is the difference between 0.621 and 0.497? 0.124. Understand the logic of this. You have to understand the logic of this. So you have to understand this conceptually. For suppose at the rate of 10%, I got straight away. At the rate of 10%, straight away I got what? 0.5. My answer is simple. IRR is equal to 10%. But I got 0.621. So what is the desired factor? 0.5. From 0.621 to desired change 0.121. Understand the difference. For 0.124 factor difference, the rate of the percentage difference is 5. Yes or no? Now we are questioning what for 1 to 1. Are you getting my point? For 0.124 factor difference, the percentage difference is 5%. Now the question is, for 0.121 factor difference, what should be the percentage difference? So what is the answer, final answer? 14 point what? 87%. To understand it conceptually, so that I am taking the other calculation as well. IRR is equal to, let us calculate IRR by taking 15% as a base. 15% means you can take 15% minus, because IRR lies between 10 and 15. So 15% minus, or else even if you are not taking 15 minus here, let us take 15 plus only. Okay, at 15%, what is the factor? 0.497, but the desired factor is 0.5. That means we need a negative change. 0.497 minus 0.5 divided by what? 0.621 minus 'Kajal from Kathmandu, are you listening to the class? Okay. 0.621 minus Amar, 0.621 minus 0.497 into what? 5. Automatically you will get minus 15% minus. That means you will get what? Answer 14.87. Clear? Are you getting my point? Everybody please. Or else you can write 15% minus 0.5 minus 0.497 divided by 0.621 minus 0.497. Then also you will get the same answer. Am I clear? Done? This is called interpolation. This is how we find out IRR when single cash flow is given. Let us move on to what? The next one. Second example. What is the second example? Even cash inflow. Even cash inflow. So this is the concept which is related to what? Which is related to investment decision. We are discussing now itself. Even cash inflow. Even cash inflow. Investment is equal to 1 lakh. Annual cash inflow is equal to 30,000 rupees. Annual cash inflow. Annual cash inflow means equal. Every year we are getting 30,000. Life 5 years. IRR is equal to question mark. Very good, Amar. Investment is equal to 1 lakh. Annual cash inflow 30,000. Life is equal to 5 years. IRR is equal to question mark. Now, what is IRR? IRR is a discount rate at which sum of a discounted cash inflows are equal to sum of a discounted cash outflow. I am writing the equation at IRR. It is a discount rate. IRR is a discount rate. Sum of a discounted, nothing but initial cash outflow is equal to last time I have written what? Cash inflow into PVF at the rate of IRR. Now I cannot cash inflow because this time this is not a single cash inflow, this is annual cash inflow. So that's why I should take what? Annual cash inflow into, I cannot take PVF. Why PVF? Last time it is a single cash flow, so that's why I have taken PVF. Now this time I'm getting a benefit every year for n years. So that's why I should take, this time this is an annuity. So that's why I should take PVAF at the rate of what? IRR. Okay. So what is the initial cash outflow? 1 lakh is equal to, what is the annual cash inflow? 30,000 into what? PVAF at the rate of IRR. PVAF is equal to what? 3.33. Where does this PVAF 3.33 lies? Where does this PVAF 3.33 lies? We should find out the rate at which this PVAF factor lies. PVF lies. Okay. So no idea. So that's why what? Trial 1 at the rate of 10%. PVAF for, we cannot write 5th year. We should write PVAF for 5 years is equal to trial 1 at the rate of 10%, present value annuity factor for 5 years. We cannot write 5th year. 5th year means single. For 5 years means multiple. So 1 divided by 1.1 press equal to 5 times and grand total. Life is equal to 5 years. We are getting a benefit for 5 years, right? So 3.791. 3.791. For suppose at the rate of 10% I got 3.33. That means IRR is equal to 10%. But I got 3.791. So that means IRR is not equal to 10. So I should get 3.33. That means value has to decrease. Value decrease means rate increase. Trial 2 at the rate of 15%. PVAF for 5 years is equal to, PVAF for 5 years is equal to 1 divided by 1.15 press equal to 5 times grand total 3.35. Can we do interpolation? No, we cannot do interpolation. Some students might feel like doing interpolation. We cannot do because 3.33 does not lie between 3.791 and 3.35. We cannot do interpolation. We should go for what? Another trial. We should go for what? Another trial. Okay. So dear all students, please like, subscribe and share. Please do comment your place from where you are watching this class. Amar, you came from Andaman, right?
Yes.
Okay. Trial 3. Trial 3 at the rate of, trial 3 at the rate of, so there is a slight difference, so that's why let us take 16%. There is a small difference, so that's why let us take what? 16%. Because at the rate of 15 we got 3.35, but we want only 3.33. So PVAF for 5 years is equal to 3.27. Now IRR lies between what? Now this 3.33 lies between what? 3.35 and 3.27. Now we can do interpolation. So IRR is equal to anyone from Andaman? Anybody know Amar? IRR is equal to what? Answer 15% plus, at 15% what is the factor? 3.35. But what is the desired factor? 3.33 divided by 3.35 minus 3.27 into 1. This time only the percentage difference is 1. 15 and 16. So you may take 20% also instead of 16. Then you have to multiply with what? 5. What is the answer? You will get 15.75 or 25 15.25%. Clear? So you should know the alternative calculation also, ORR. What is the alternate calculation? 16% plus, you can take plus 16% plus. Okay, so even you take plus, you will get minus only. 16% plus, at 16% what is the factor? 3.27 minus 16%. At 16% the factor is 3.27, but the desired factor is 3.33. Divided by 3.35 divide minus 3.27 into 1. Again you will get 15.25%. Clear? Done. Okay, clear. Now let us come to what? Example number 3. Example number 3, uneven cash inflows. For example, if asset is, if investment is giving uneven cash inflows, then how to find out IRR? Okay, for example, investment is equal to 1 lakh, cash inflow first year is equal to 50,000, second year is equal to 50,000, third year 40,000. IRR is equal to question mark. So this time I cannot take 1 lakh is equal to annual cash inflow into PVAF. I cannot take, because this is not an annuity. Annuity means same amount at same intervals. Okay, so that's why, how can I find out IRR? Calculation of IRR, trial and error method. I will be following what? Trial and error method. Okay, let's take a trial at the rate of 15%. You take trials at least what? I mean, maximum gap can be 5%. Cannot take 10% or 20%. Some students might take trial at the rate of 1% and then what? Trial at the rate of 100 direct. We cannot do like that. Okay, so trial 1 at the rate of 15%, trial 1 at the rate of 15%, column year, cash flow, PVF at the rate of 15%, discounted cash flow. Okay, so tell me here 1, year 2, year 3. Cash flow. What is the cash flow amount? 50,000, 50,000, 40,000. First, suppose I am taking PV factor at the rate of 15%, and if I bring all the future cash flows to the present value, and if I get 1 lakh, if I get sum of a discounted cash inflow 1 lakh, what does that mean? IRR is equal to 15. So tell me the factor. 0.86, 0.87, 0.87, next is 0.756, 0.658. Proper rounding off has to be done. 0.87, 0.756, 0.658. So tell me the discounted cash flow. Discounted cash flow. $43,500. 43,500. Next. 43,500. Next number 37,800. Next number 26,320. Total, what is the total amount? Total amount 1,07,620. This is called as sum of a discounted cash inflow. Why it is called as sum of a discounted cash flow? Because cash inflows, future cash inflows are discounted and we are taking a total sum. That's why it is called as sum of a discounted cash inflow. At IRR we should get net present value 0. Sum of a discounted cash inflow minus sum of a discounted cash outflow must be equal to 0. Nothing but the sum of a discounted cash inflow must be equal to initial cash outflow. Here we got 1,07,620, but we should get 1 lakh. That means this amount has to decrease, yes or no? So that's why PV factor at the rate of, let us take a next trial. Trial 2 at the rate of 20%. Trial 2 at the rate of 20%. Tell me the factors. Tell me the factors. 0.833, 0.694, 0.482. So tell me the discounted cash flow. Some students might multiply 43,500 and 0.833. Legends, please pay careful. 50,000 into 0.833. Number 41650. Next 34,700. Very good, Amma. Next 19,280. What is the total? If I get this number greater than 1 lakh, then I should go for another trial. But fortunately we got what? Number less than 1 lakh, 95,630. So that means the initial cash outflow 1 lakh lies between what? 1,07,620, 95,630. Now IRR is equal to, the desired cash inflow is 1 lakh, which lies between what? 15% and 20%, yes or no? Okay. Let us find out NPV also, because there are two methods to find out. Minus sum of a discounted cash outflow. First case, what is the NPV? How do we get NPV? Sum of a discounted cash inflow minus sum of a discounted cash outflow. This concept we have not yet discussed. If you know, okay, fine. Otherwise, leave it. I will explain in capital budgeting. So 7620 NPV. Second case, what is NPV? Negative 4,370. 4370 negative. Is it clear? Let us find out the IRR. IRR is equal to discount rate at which sum of our discounted cash inflows are what? Sum of our discounted cash inflows are equal to outflows. So here our outflow is 1 lakh. That 1 lakh lies between what? 1,07,620 and 95,630. Okay, so that means IRR is equal to 15% plus. At 15%, what is the sum of a discounted cash inflow? 1,07,620, but I want 1 lakh. The numerator is the desired change. Denominator is the change we have. What is the change we have? 1,07,620 minus 95,630. into the percentage change. What is the percentage change? 5%. Clear? Are you able to understand the concept? Are you able to understand the logic behind this calculation? What is the answer? ORR. What is the answer? 18.18% is the answer. So what is the other calculation? 20% plus. At 20% we got 95,630 minus what? The desired one is 1 lakh divided by the change available. The change we have 1,07,620 minus 95,630 into percentage change 5%. Again you will get 18.18% ORR. So formula based. So this formula I will not recommend because even I don't remember the formula. Now I will write based on the logic. Okay. So IRR is equal to lower rate plus IRR is equal to what? Lower rate plus what is the lower rate? 15. What is the lower rate? 15. Okay, lower rate plus NPV at a lower rate, NPV at a lower rate divided by NPV at a higher rate, NPV at a lower rate minus NPV at a higher rate into higher rate minus lower rate. Again you will get the same numbers. What is the lower rate? 15% plus what is the NPV at a lower rate? NPV at a lower rate is equal to 7,620. 7,620 divided by 7,620 minus of minus NPV at a higher rate. What is the NPV at a higher rate? 4370. The formula base lower rate plus NPV at a lower rate divided by NPV at a lower minus NPV at a higher rate minus what? Lower rate. Clear? Into what? 20 minus 15. Again you will get the same answer, that is 18.18%. Or you can take what? Higher rate plus NPV at a higher rate divided by NPV at a lower rate minus NPV at a higher rate into higher rate minus lower rate. Again you will get the same answer, that is 18.18%. So with this we have completed IRR concept, which is relevant for capital budgeting, investment decision chapter. Very important. Actually this is an advanced concept. I have to discuss it investment decision chapter, but it is related to time value of money. I hope you understood the concept. Okay, so this is one of the advanced concept in FM, IRR. If you get clarity in IRR, then you will find investment decision chapter easy, comfortable. Clear? So after a break, let us start with what? Scope and objective of a financial management. So here there was a clerical mistake, please correct it. So here this is not a 482, 0.482, this is 0.578. The concept is clear, concept is same. So please be clear, 0.578. And here 19280, it is not 19280, it is, what is the number? The concept is same. I hope concept is clear, but here the numbers are not same. Here the number is 0.578. 40,000 into 0.578. 23,148. So what is the total? This total is not 95,630. Please do make a correction. 99,537, and this is 99,537 minus 1 lakh 463. Okay, please make a correction. So 99,000 what? 99,000 99,537. So what is the answer? So simple clerical mistake, but the concept is clear. You need not worry about the concept. Here there was a factor mistake. So what is the answer? 19.71%. So okay, so this is not 95,630, this is 99,537. If there are any clerical mistake, please let me know. I am recording this class in a studio. There can be a clerical mistake. Please let me know. So 19.71%. The concept is clear. Here also 7620 divided by 7620 minus what, this one, minus 463 minus 463, you will get 19.71%. Clear? Done. Please make a correction, PV factor mistake. Okay. Next, introduction to financial management, nothing but scope and objective of a financial management. Scope and objective of financial management. So here we are going to learn what is the boundary of a financial management and also what the object of learning the financial management. First I will be discussing the concept, and then I will be discussing the theory which has been prepared using the ICAI study material. Okay. So first of all, financial management is a managerial activity which is concerned with planning and controlling of a firm's financial resources. So it is concerned with what? Planning and controlling the firm financial resources. So it includes two aspects. One is procurement of fund and effective utilization of a fund. So imagine the simple balance sheet. If you visualize the balance sheet, on asset side you will be having only two categories. One is non-current asset, second is the current asset. On liability side you will find only two, equity, debt. So balance sheet liability side is a procurement of fund, asset side is the utilization of a fund. Okay. So procurement of fund, we procure fund either from equity or a debt, that is own fund or a loan fund. We utilize the fund for two purposes, fixed assets and current assets. As you already know, for fixed assets we have a investment decisions chapter. For current assets we have a working capital management chapter. And for procurement of funds, we have a cost of a capital, capital structure, leverages, dividend decisions, and sources of a finance. So total 5 topics. So we have another independent topic, financial analysis, that is ratio analysis. And now we are discussing what scope and objective of a financial management, which is an introduction to the financial management. As we have already discussed, financial management, two basic aspects are procuring money and utilizing the money. So in any business, first we should procure the money, we have to utilize the money effectively. So these are two aspects. So that means we are not concerned about recording, classifying, summarizing and all, because accounts, that is accounts. We are not going to learn how to determine the selling price, cost control, cost reduction and all, because that we have already covered or we are going to cover in cost accounting. Okay. Object of financial management. Object of financial management, not just the financial management, object of any subject in CA course is to maximizing the wealth. First, you should know the difference between the profit and wealth. Profit is different from wealth. For suppose our Amarendra Bahubali is having a Mahishmati. So he gave Mahishmati on rent. He gave a Mahishmati on a rent and he is receiving rupees 10 lakhs per month. Now this 10 lakhs is called as a profit. Okay, 10 lakhs is a profit. Okay, but the market value for Mahishmati is, example, 10 crores. 10 crores. So this 10 crores is called as what? Wealth. 10 crores is called as wealth. Okay. So likewise, for suppose your friend might be having a mango garden. First question you will be asking, what is the profit per acre? Profit per acre means what? Every year how much profit are you earning? Yes or no? If you ask a profit, he will not be saying 1 acre 20 crores. He will not say like that. 1 acre 20 lakhs or 30 lakhs. Yes or no? So 1 acre 20 lakhs or 30 lakhs is what? Wealth. Okay, asset. So profit is different. Wealth is different. Okay. So there are two objectives, profit maximization and wealth maximization, but the superior objective is what? Wealth maximization. Superior objective. Sir, why wealth maximization is the superior objective? Because the reason is, we have already discussed the time value for money concept. In time value for money, if you see the columns, value of asset, we are taking year, cash flow and PV factor or a PVF at the rate of a required return. Yes or no? So that means what? The final amount value depends upon two factors. One is the cash flow we take and the second is the present value factor we take. Present value factor depends upon the rate. Yes or no? So that means here wealth maximization depends upon two factors. One is the profit and the second one is risk. If risk increases, required return increases, and if required return increases, value decreases. Simple, we have already discussed IRR concept as well. If you take the higher rate, the value will decrease. Okay. So if a profit increases, so what happens? So I mean, to increase the wealth depends on two factors. One is profit and the risk. Why profit maximization cannot be the sole objective of a business? Why cannot be the sole objective of a business? Because simple reason why it cannot be a sole objective. If it is the sole object of a business, you will be ignoring the risk factor. You will be ignoring the risk factor and altogether. And profit is a vague term, unclear. Profit means accounts profit is different from costing profit. Accounts profit is different from income tax profit. Okay. So that's why profit is a vague term, unclear term. And if a profit maximization is the only objective, we ignore the risk factor. Ignore the risk factor. And the profit maximization is a short run. Okay, so if the objective is profit maximization, that means you will be looking only for what? Short run. So there will not be a long term growth. There will not be a long term growth. Okay, so in business always we should look for what? Wealth maximization. For suppose Flipkart, Zomato, for suppose in Zomato or Swiggy, you have a refund policy, yes or no? Okay, you have a refund policy. So if a profit maximization is the only objective, Zomato should not allow what? Refund policy, because some people might refund after having half of the biryani, yes or no? Some people. Okay, so the point is here, but if Zomato, if it is not allowing the refund, then what happens? There will not be a long term growth. We are right now, public are habituated to what? Public are habituated to return. I mean Flipkart, Amazon, Uber, Ola. Okay, all these things, Zomato and Swiggy, because the reason is there is a flexibility. For suppose if you are booking the cab, okay, you can cancel the cab before it arrives, yes or no? And Flipkart also, if you are doing shopping online, after receiving something, what you can do is you can refund it. So that means here all the corporate companies, they are looking for what? Long-term growth. Okay. So profit maximization, if it is the only objective, what we do is we ignore completely the risk factor, and profit is an unclear term. So if profit increases, no doubt wealth will increase. For example, cash inflow, if we are taking 10,000, instead of 10,000, if we are getting a cash inflow of 15,000, what happens to the value? Value will increase. Yes or no? But wealth depends upon another factor also. What is the other factor? Risk. If risk increases, required return increases, and required return increases, wealth decreases. This is a very fundamental point. So till completion of a final, you have to remember this, you have to understand this concept. If risk increases, required return increases, and if required return increases, wealth decreases. So that's why as a finance manager, our objective is to keep the risk as low as possible. As low as possible. So it's simple, apply your common sense. Apply your common sense. If risk increases, required return increases, and wealth will decrease. So example, if you're purchasing a second hand car, even though it is in condition, you will be paying a lesser value. Why you will be paying a lesser value? Because risk, second hand car means risk. If the risk increases, wealth will decrease. Likewise, if you are buying a car, which was stolen by the previous one, then also what you will be paying a very less amount, because there is a risk. True owner can come at any point of time and can take back the car. So that's why if a risk increases, required return increases, and wealth what? Decreases. Okay. Likewise, okay, if there is a building in a center and there is a possibility that during the road widening, that building may be collapsed. Now what happens to the value? The value will decrease because there is a possibility of a destructing, building, yes or no? So that means the fundamental point, if risk increases, required return increases, and wealth decreases. For that, right now I am giving an explanation. If you are not able to understand, okay, fine, but thereafter you recall this. For example, we have a cost of equity concept in cost of a capital. CAPM, capital asset pricing model. Cost of equity KE is equal to RF plus RM minus RF into beta. Beta is a risk factor. At CA inter level, we are not going to learn how to find out the beta, but you should know what is beta. What does it denote? So beta is a risk factor. So KE is equal to RF plus RM minus RF into beta. But suppose if beta increases, tell me what happens to KE? KE will also increase. If a KE increases, that means what? If risk increases, required return KE is increasing. Okay. So the sentence is justified or not? If risk increases, required return increases. Next, you know the Gordon model. If you know the Gordon model, and if you know the valuation of asset examples, last example, so what we have written is value is equal to benefit divided by required return minus growth rate, or P naught is equal to D1 divided by KE minus G. P naught means current market price of a share, value of a share, value per share. So value per share is equal to D1 divided by what? KE minus G. So simple, KE is in the denominator, and if KE increases, what happens to the value? Value decreases. So that means if you see this, text on the screen, if risk increases, required return increases. Nothing but beta increases. If beta increases, KE will increase. If a KE increases, P naught will decrease. P naught is nothing but value per share. Wealth of equity shareholder will decrease. So that's why as a finance manager, our objective is to keep risk as low as possible. How to keep this beta as low as possible, that we will be learning in AFM, Advanced Financial Management, that too portfolio management, beta. Okay. So wealth maximization is a superior objective because profit is a vague term. Vague means unclear. Vague means what? Completely unclear. Because if you see the income statement, in income statement itself we have a PBIT, profit before interest and tax. profit before tax, profit after tax, yes or no? So likewise we have a profit in costing, we have a income tax profit, we have a accounts profit, we have a accounts profit. So here the profit means which profit? So completely vague term, unclear. Okay. And next, if the profit maximization is the only objective, we ignore risk. We completely ignore the risk factor. That is the main drawback if you keep the profit maximization as an objective. Okay. So we completely ignore the risk factor. For suppose Flipkart, if it is not giving a refund, I mean if there is no return policy, or if there is no refund policy in Zomato, then obviously for example, if there is no refund policy, that means customer has to have that biryani even though there is no chicken pieces or no. So you are not refunding, Zomato is not refunding. For the timing, Zomato will get profit, but in long run, Zomato goodwill will get affected. Yes or no? So that's why what is the superior objective? Wealth maximization. Now, what are the decisions involved in financial management? There are three types of decisions involved in financial management: financing decision, investment decision, and dividend decision. In advanced financial management, there is one more decision, that is portfolio decision. Portfolio decision. So, financing, investing, and dividend decision. And this is simple to understand. Okay. First one, financing decision, from where to get the money. If you want to start a business, if you want to do a business, you have to decide from where to procure money. So that is a part of financial management. The next, investing decision, where to invest the money. Where to invest money. Example, DMart is starting stores at numerous places all over India, right? Now the question is what? So they might have a 3-4 options. Okay. So Nujividi, Gannavaram and Hanuman Junction, likewise there are 3 places. Okay. So they have to decide where to invest. Where to invest. So that is also a part of a financial management. If it is profitable, then it will be invested. For example, L&T Metro Rail project in Hyderabad. Okay. So it was handed over to the state government by L&T. Why it is handed over to the state government by L&T? Because simple reason. Initially they thought like that investment decision is profitable. So that's why they have constructed the Metro Rail project. But later on what happened is the Telangana government has started giving bus service free for women. So the occupancy in metro rail has got decreased. So L&T has conducted a lot of meetings with Telangana government, but the government cannot take back the promise made to the public. So that's why what L&T has handed over the metro rail project to the government. Keep it with you also. Okay. So here it is not profitable. Likewise, investing decision means where to invest the money. And next, what dividend decision? What is this dividend decision? For suppose we started a business, we procured money, we invested. So after investing, what happens? We generate profits. So after generating profits, next step is what? Distribution of these profits to the shareholders. If it is a partnership, profits are mandatorily distributed to the partners. But if it is a company, distribution of profits is not mandatory. Okay. For suppose business is having a profit. Company is having a profit. Company has generated a profit. Now the company has to decide whether to declare a dividend to the shareholders or not. So whether to declare a dividend or not is also a part of a financial management. Okay. So we have a separate chapter called dividend decision. So there we are going to learn whether we should distribute a dividend or not. Okay. Even though we have a dividend decision chapter in financial management, but what Companies Act 2013 says? Companies Act 2013 says company may declare a dividend provided first board of directors must recommend the payment of a dividend. Board of directors must recommend the payment of a dividend. So board of directors, obviously board of directors means composition of a directors. At least one director will be from the finance background. One director. That director who is having a finance background will be having a knowledge of this dividend decision chapter. Okay, he will be knowing the Walters model. He will be having an idea about Gordon's model. Okay, model. So based on these theories, this person who is having a finance background, director, will be what recommending a payment of a dividend, or he may not recommend the payment of a dividend. Okay, so if every director gets convinced, they will recommend the payment of a dividend. They only recommend. They do not have a power to pay the dividend. They will only recommend the payment of a dividend, and that has to be approved by the members in a general meeting. Members has to approve the payment of a dividend in general meeting, and while approving, members cannot ask for a higher rate of a dividend than recommended by the board of directors. For example, if a board of directors have recommended 20%, they can approve either 20 or less than 20, but they cannot ask for 25%. Okay, clear? So next, factors to be considered while procuring funds. The most important point is here, while procuring funds, what are the factors we should keep in mind? So what are the factors? These 4 factors we should keep in mind while procuring money. So what are the factors? First one, risk, possibility of occurrence of a loss. So you need utmost clarity in this concept. Okay, factor, first one, risk means possibility of occurrence of a loss. Second, flexibility. Third, control. And next, cost means required rate of a return. Okay, we can call it as an expectation. Okay, so if expectation increases, value decreases. First you have to understand this. Okay, so I have already explained, if risk increases, required return that is expectation increases. If expectation increases, wealth decreases. If expectation increases, wealth decreases. So now the point is, okay, here also you have to understand the point. Cost means required return, that is expectation. This is a fundamental point. Always others should have a low expectation on us. Okay, so then what happens? We can reach the expectations easily. We can reach the expectations easily, and if we are able to meet the expectations, the value will increase. Are you getting my point? Okay, so that's why happiness is not dependent on the success or a money. Happiness always depends upon an expectation. That's why if you see, there are many people who does not have any access to the mobile, okay, movies or something. If you go to Araku agency area, or if you go to Assam or some tribal areas, so they will not be having any access to what mobiles, okay, televisions, okay. So they will be daily they will be doing a farming without using pesticides, and what, so they will be you will be finding those people are very happy. Okay, the reason is because their expectations are completely low. So that's why value, it depends upon a perception. Value depends upon a perception. If our expectations are low, then obviously what happens to the value? Value will increase. Okay, clear? So 4 factors we should consider. So what are the 2 sources? Equity, debt. Okay, let us assume first one, risk. I am the business. Okay, I am the firm, company. Okay, so we have Amar. He is an equity shareholder. He wanted to invest in equity. We have a Amal. He is a debt holder. Amal is a debt holder. Amar is a equity shareholder. Let us assume I am the company, I am the business. Now Amar equity, Amal debt. So first point, first suppose if I take debt from Amal, I can take debt from Amal or I can take equity from Amar. Okay. First, for suppose if I take equity from Amar, so what is the advantage to me? Payment of a dividend is not mandatory. For suppose my business is not doing well, I need not pay dividend. So payment of a dividend is not mandatory. First point. And at the time of liquidation, okay, at the time of a liquidation, for example, the project was utter flop. Okay, at the time of a liquidation also, I need not repay the capital. I need not repay the capital. Business need not repay the capital because it is an equity, right? So that means for business or for a company, the risk is less possibility of occurrence of a loss. If you see the income statement also, for example, sales 0. Sales 0 means variable cost will also be 0. Contribution 0. Let us assume for the timing fixed cost is equal to 0. Fixed cost. Generally fixed cost will not be equal to 0. Fixed cost is equal to 0. Then what is EBIT? EBIT is equal to 0. Minus interest. If I take 100% equity, minus interest is 0. Earnings before tax will be 0. Earnings after tax will be 0. Earnings available to equity holders will also be 0. That means there is no possibility of occurrence of a loss. If I take equity, due to equity there will not be any possibility of occurrence of a loss. But if I take debt from Amal, CBIT is 0, but minus interest 1 lakh or 2 lakhs have to pay. That means there is a possibility of occurrence of a loss. So tell me, so company should have a less risk or a higher risk? Less risk. So we always choose an option which is having a less risk. So from risk point of view, if a company as a promoter, if I don't want to take risk, I will be choosing what? Equity. Because in case of equity, I need not pay dividend and payment of a capital is also not mandatory. Okay. So that's why equity, I would be selecting equity. Clear? Are you able to understand this risk? Here the risk, I am talking about the risk from the point of view of a company. Okay, for company, equity is the best option because no risk. Debt is risky. Company has to pay interest on time, principal on time, irrespective of financial position of a company. Okay. Next, flexibility. So flexibility, for example, I have taken equity from Amar. Equity from Amar. Okay. So after procuring money, equity from Amar, I am the promoter, I am also an equity shareholder. Okay, promoter means a person who gets an idea of incorporating a company. I got an idea and I have procured equity from Amar. Okay, now so I wanted to start a branch in Tamil Nadu. Okay, I wanted to start another branch in what? Karnataka and also in Delhi. Okay, in Ahmedabad also I am considering to start a branch. For that I am procuring money. So one of the investor is what? Amar. He is also equity shareholder. Now Amar, okay, so general meeting has to be conducted. Okay, now Amar says, why you are starting branch in Ahmedabad? Why don't you start branch in what? Guwahati, Assam. Okay. So I told no, Ahmedabad will be what? A better place to invest. But Amar what? He is telling like, no, you should start branch in what? Guwahati. Okay. So now tell me, control is getting diluted or not? Yes. So equity, I have to consider the decision of a equity shareholder. For suppose if I take debt from Amal, Amal says, why do you start branch in Ahmedabad? I am not answerable to Amal because Amal is a debenture holder and no equity, no voting rights. Yes or no? So that means here control will get diluted if I procure money from equity. If I procure money from equity, right now the control is with the promoter itself, myself. I am the only person who is taking the decision. But if I procure money from the other people as an equity, then what happens? The control will get diluted. So that means I, I'm alone cannot take a decision. Okay, if a control get diluted, what happens? The decision making gets delayed. The decision making gets delayed. At the same time, the progress of a business will also get slow down. Why? Because I'm the promoter and I have an idea. Okay, I will be having a vision. I know how to start and how to grow the business. But unfortunately, what the person who is not having a vision and the person, okay, who is not having a vision, the person who has just invested money will be giving what will be keep on what involving in a decision making. So then what happens? The control gets diluted. So promoter will have a clear idea because that is the idea, okay, generated by what a promoter, and he knows, okay, where the company has to be taken, how the company has to be grown. Okay, so that is a completely promoter's perception. I'm talking about the promoter's perception. So control should get diluted or should not get diluted? Should not get diluted. If diluted, what happens? Decision making will get delayed. Okay, so for example, Amar and his wife going for a dinner. Amar is single. So decision making is completely with what? Amar. Where to go and where to have a dinner and all. Okay, so decision making will be easy. But after marriage, he has to consider decision of a wife as well. First, suppose if he asks his wife where to have a dinner, she will be saying what? Your wish, Nista. Okay, he will be saying like what? Shall we go to what? What is the famous restaurant in Vijayawada? UTK. Shall we go to UTK? She will say no, some other place. He says, shall we go to KFC? No, some other place. Okay, he will be saying like McDonald's. She will be saying like no. Shall we go somewhere? So now at last Amar will be saying like what? You only decide. Then what his wife will say? Your wish. You have to decide. You have to decide. So now the decision making is getting delayed, yes or no? Decision making will get delayed. Okay, so is it a problem or not? The control should get diluted or not? Should not get diluted. Flexibility. What is this flexibility? For example, I have procured money from Amar, equity shareholder. Company has grown like anything, but this person is irritating me. Okay, so continuously he is involving in decision making. He is poking me. I want to get rid of him. So can I? No. He is also an equity shareholder. He is also having an equal right, and I cannot send him out. There is no flexibility in case of equity share capital. But if it is a debt, I can make a payment at any time. It is flexible. I can repay the debt before the maturity. Okay, there may be a prepayment charges, but I can repay the loan before the maturity. So flexibility should be there or not? Yes, there should be the flexibility. So that means flexibility point of view, which is the best option? Debt. Control point of view, which is the best option? Debt. And next, cost. Okay, here you might get confused. Be careful. Cost. I am the company. Okay, there are two investors. One is equity and the other one is debt. Okay, now think from the perspective of investors. Okay, so company is issuing 10% debenture. Company is issuing 10% debenture. Amal purchased 10% debenture, but Amar, he purchased equity shares. Think from the perspective of an investor. Now tell me, Amal, he will be getting 10% rate of interest every year. Okay, irrespective of a financial position of a company. Yes or no? That means company is having a risk, but Amal is having a no risk. Of course, he will be having a risk, but less amount of a risk. Why? The reason simple. Irrespective of a financial position of a company, Amal will be getting back his interest and capital. So Amal is taking a less risk. Amar, instead of purchasing 10% debenture, he purchased an equity share. If you think from the perspective of investor, who is taking the more risk? Amar, an equity shareholder, is taking a more risk. Because the reason is he may or may not get dividend. He may or may not get back the capital. Okay. So no doubt Amal is also taking risk. But when compare you Amal and Amar, debt and equity shareholder is taking more risk. That means that equity shareholder Amar will be expecting 10% or more than 10. More than 10%. No doubt in that. Because high risk, high expectation. If risk increases, required return will also increase. That means on company, equity shareholders will have a higher expectation on the debenture holder. That expectation we call it as a cost. Cost here doesn't mean expense. Cost does not mean an expense. Cost means a required return, expectation. Who will have a more expectation on the company? Equity shareholder will have a more expectation on the company. Okay. Now tell me, so whether which is the better one, on company, okay, or on we people? The opposite people must have a less expectation so that we can reach easily. Yes or no? Here on company, who is having more expectation? Equity shareholders. So meeting their expectation is difficult task. We should keep always the cost as low as possible. So that's why from the cost point of view also, which is the best option? Debt is the best option. Am I clear? For example, so Mahesh Babu and Rajamouli movie is coming, right? Who will have a more expectation on that film? Obviously, Mahesh Babu fans will have a high expectations. Okay. So normal public will have a generally what? Less expectations. Yes or no, Amar?
Yes.
Who will have a more expectations? Mahesh Babu fans will have a higher expectations. Now the point is what? Rajamouli meeting Mahesh Babu fans expectation is very difficult. So that's why, so we should keep the expectation of audience as low as possible. So for that, best example, Kaleja movie. Okay. Why? Because of huge expectations. Even though the movie was good, it has got flop. Okay. Likewise, Saho, same result, Prabhas Saho. Because there are huge expectations. When expectations are high, it is very difficult to meet the expectation. Then automatically what happens? Value decreases. So that's why the students who are listening to this class, you should keep your parents' expectations as low as possible. As low as possible. If you are preparing for both groups, let them know, okay, that you are preparing only for one group. If you are trying for a rank, let them know only that you are writing both. Okay. If you are keeping their expectations low, then that will be very easy to meet the expectations and automatically your value will increase. Okay. Clear? Next, debt is cheaper than equity. Debt is cheaper than equity. So why the debt is cheaper than equity? Reasons. First reason, tax savings on an interest. Okay. On payment of interest, we can save a tax. So that's why taking debt is cheaper than an equity. First reason, cost of debt is always less than the cost of equity. First reason, tax savings on interest. Second reason, cost of issue of a debt is less than the cost of a equity. Generally, the cost of issue of a debt is less than the cost of issue of a equity. What is this issue? Cost of issue. Example, underwriting commission. underwriting commission, brokerage, okay, advertisement and all. So generally for debt, this cost of issue will be less. That's why in Companies Act also, when the maximum limit has been set for debt, the underwriting commission maximum limit was less when compared to the equity. Okay, so cost of issue of a debt is less than the cost of issue of a equity. And next, third important reason is the risk taken by the debt holder is less than the risk taken by the equity shareholders. So that's why debt holder will have a lesser expectation than the equity shareholder. So that's why debt is cheaper than equity. Or we can say in the other way, equity shareholders' expectations are generally higher than the expectation of a debenture holders. Debenture holders. So that's why debt is always cheaper than equity. Yes or no? That is simple common sense point. For suppose if I am taking debt from Amar at the rate of 15%, Amal at the rate of 15%, I am taking debt. Now the Amal expectation will be only 15%. Now I am the person promoter who is doing a business. Okay. Obviously my expectation will be what? More than 15%. Because he is just a debt holder, he is not doing any business. He just gave me a money. I'm the person who is working day and night. So my expectation will be what? Obviously more than 15% because I am an equity shareholder as well as I am a promoter. Clear? Done. These are the reasons why debt is cheaper than equity. Now let us come to the scope and object of a financial management. This is completely a theory as per ICAI material. CA Inter study material module. Now let us link the concept which we have discussed. Okay. So financial management is concerned with what? Effective acquisition of fund and effective utilization of a fund. This we have already discussed, yes or no? With the objective of a wealth maximization. With the objective of what? Wealth maximization. Okay. So decision area. The key decisions involved in financial management are investment decision, financing decision, dividend decision. What is the key question? Where to invest money, from where to raise money, how much profit to distribute. Dividend decision. Examples: where to invest money means assets and working capital. Okay, that assets and working capital also. How much to invest in fixed assets and how much to invest in working capital, and where to invest this money. Whether we should invest in Ahmedabad or Guwahati, where we should start a plant. For example, so Google is going to start a data center in Vizag. So they have decided to start what? Data center in Vizag. So obviously what? That is an investment decision. That is a part of what? Financial management. Next what? From where to raise money? Equity versus debt. Equity versus debt. How much money we should procure from equity and how much to procure from debt. Next, dividend versus retained earnings. How much to distribute as dividend and how much to retain. Okay. So this is a part of what? Financial management. Introduction. Next, financial management meaning. Financial management is the managerial activity which is concerned with planning and controlling of a firm's financial resources. The two basic aspects of financial management are procurement of fund and effective utilization of a fund. Procurement of funds. How to procure money? Equity, debentures, angel financing. Angel financing means high net worth individuals who will be investing in a business. Okay, who will be investing in a business. At the beginning, why they are called as angel investors? They are called as angel investors. Angel investors means, for suppose if I wanted to start a business, manufacturing unit. Okay, so the people who are investing at the beginning, example, Amar is investing in the company. Now Amar is called as what? Angel investor. These people are high net worth individuals. High net worth individuals. HNI. High net worth individuals. And the baga. So international funding. Next what? International funding. International funding, global depository receipts, American depository receipts. This extensively we are going to learn in sources of finance. Next, funding from banks. Funding from banks. Funding from banks can also be what? Fund based and non-fund based. Fund based, non-fund based. Fund based means what? Example, cash credit or a overdraft or a bills discounting. That means company will get money. Overdraft, company can utilize, yes or no? Overdraft. Cash credit, overdraft, bills discounting, all these fund based. That means company will get money. Term loan and working capital loan. In all these cases, what happens is company can get money. Non-fund based is a different. Example, guarantee. So what is this guarantee? Non-fund based. Example, we have a concept of a bank guarantee. Public sector undertaking, generally if they want to award a contract, they will ask for a bank guarantee. What is this bank guarantee? Example, NTPC company, public sector undertaking. It gave a civil contract to contractor Amar. Okay. Amar is from Andhra Pradesh and he got a contract in Bihar. NTPC company plant is in Bihar. Okay, so what NTPC will do is NTPC will be asking for a bank guarantee. Okay, we give a contract to you, 100 crores worth contract to you. But if you are not completing this contract within the time, then how? Okay, so we lose money. Okay, we will be losing money. And generally what advance is paid to the contractor to do a work. If we give an advance and if you go away with the advance, what can we do? Okay, then what happens is NTPC will give advance 10 crores to Amar, provided if Amar Bank gives a guarantee to the NTPC. Are you getting my point? That means what? No doubt NTPC will give 10 crores advance. But what is the condition? Amar Bank means what? Amar might be maintaining a bank account with State Bank of India. The State Bank of India has to give a guarantee to the NTPC company. Like what? Okay, you give advance to our customer. If he makes any default, I will pay. So this is a bank guarantee. So further what happens? SBI will take some commission. On 10 crores it might take 2% or 3% commission. Okay, Amar will take 10 crores from NTPC and will start doing work. For suppose if Amar after taking 10 crores instead of doing work, okay, he left the work on the way, then what happened? So SBI has to pay the money. Are you getting my point? Now it is called as a non-fund based. Why it is called as a non-fund based? Bank is not giving a loan to Amar. Bank is not giving loan. Bank is just giving a guarantee and this person is getting money from elsewhere. So that's why it is called as what? Non-fund based. Letter of credit also same. What is this letter of a credit? For example, you wanted to import the machine from Japan. Okay, so that Japanese company exported machinery to Vijayawada. Amar imported machinery. Okay, and the exporter has given a 3 months credit. 3 months credit means Amar will be going to pay the money after 3 months. Okay, now generally what happens is supplier is in Japan and customer is in what? India. Okay, for suppose after 3 months if Amar is not going to pay money, then what happens? That Japanese supplier should come to what? Vijayawada, our Labbipet, our area, and has to recover money from what? Amar. Is it possible? Not possible. Why? The Japanese supplier, if he comes to our Labbipet area, he will not go again, yes or no? He will not go back, yes or no? It is very difficult. Likewise, if we are exporting something to China or Japan, we cannot go there and we cannot recover the money. So that's why. So we have a concept of a letter of credit which is similar to guarantee. What is this letter of a credit concept? For example, Citibank in India will give a guarantee to the suppliers bank. Okay, suppliers will have a bank, right? So this Citibank in India will give a guarantee. What? If my customer makes a default, I will make a payment. So that means nothing but Citibank will issue a letter of a credit. Please give a credit. It will give a letter to give a credit. So that's why it is called as what? Letter of a credit. Are you getting my point? Previous one is not a letter of credit. It is giving a guarantee. Here it is, letter is given to get a credit. So that's why it is called as what? A letter of a credit. Again, Citibank will collect some charges from what? Customer. Okay. Why again it is called as non-fund based? Because bank is not giving money. Bank is what? Giving a letter of a credit so that he can import the equipment from Japanese supplier. Clear? Why we have this concept? Are you able to understand? Okay. So effective utilization of fund, we utilize the fund for fixed assets and what? Working capital. Next, evaluation of a financial management. In the past it was asked once. Simple question. So evaluation of a financial management. There are three phases in evaluation of a financial management. First one, the traditional phase. Second one, the transitional phase. And the third one is the modern phase. Okay. Traditional phase. During this phase, financial management was considered necessary only during the occasional events such as takeover, merger, expansion, liquidation, etc. That was the traditional phase. Okay, so it was considered necessary only during occasional events such as takeover, merger, acquisition, liquidation, and etc. You know the concept of merger and acquisition, merger, expansion. Next is the transitional phase. Transitional. During this phase, the day-to-day problems that finance manager faced were given importance. Day-to-day problems like general problems related to fund analysis and planning and control were given more attention in these phase. Example, there might be what a problem in payment of a salaries. You might be facing a liquidity crunch. These type of problems are given importance. Okay, and planning and control were given more attention in this phase. Now, modern phase is still going on. Right now, modern phase is still going on. The scope of a financial management has greatly increased now. Scope means boundary. The boundary of FM has greatly increased now. Seriously, it has increased a lot. Earlier, we are concerned about what? Only mergers and acquisition. Now what? As a finance manager, you are responsible for procuring money. Okay, you have to carry out the financial analysis of a company. This analysis helps in decision making, ratio analysis, comparative analysis, common size financial statements, cash flow statements. This analysis helps in decision making. And during this phase, many theories have been developed regarding efficient market, CA final concept, capital budgeting that we are going to learn in CA Inter itself, option pricing valuation models that we are going to learn in CA final, AFM advanced financial management, and also in several other important fields in financial management. So whatever the terms here mentioned, that is efficient markets, option pricing valuation models, these are all CA final topics. Okay, right now, these all theories were developed during this phase. So this is an evaluation of financial management. So they have already asked theory question. Next step, finance functions. They might ask you write a notes on finance functions. So as we have already discussed, finance functions is equal to, so value of a firm always depends on various finance functions. Value of a firm will depend on various finance functions or decisions. So what are these finance functions? Those can be the long-term finance functions or a short-term financial decision. Short-term finance functions or a long-term finance functions. So what are the long-term finance functions? Investment decision, dividend decision, and financing decision. Already we have learned. Short-term finance function is what? Working capital. Actually, investment decision itself means long-term and short-term. So here what? In long-term they have taken investment decision, that is capital budgeting. In short-term finance function they have taken what? Working capital. What is this investment decision? It is concerned with selection of assets where fund will be invested. Where fund will be invested. So that is very, very important. For example, you know AMB Mall, which is belonging to Mahesh Babu. Okay. You know, okay, AAA Cinemas.
Yes,
AAA Cinemas. That belongs to what? Allu Arjun. So Allu Arjun Cinemas, it is located in Ameerpet. AMB movies, AMB Cinemas, it is located in Gachibowli. Okay. So generally there will be a full occupancy. Okay. In AMB Cinemas. In AAA Cinemas also there will be generally a full occupancy because Ameerpet is a students area. But when you compare AAA Cinemas and AMB Cinemas will be performing better than what? AAA Cinemas because of location. What? In Ameerpet, generally students will be coming to the movies. They will not be spending much money on what? Snacks. They will not be buying popcorn, cold drink, nachos, etc. But whereas in AMB Cinemas, generally families will be coming or working professionals will be coming to the movie. So they will be spending what? Money on, okay, money during the intermission. So that is the reason. So here investment decision is concerned with selection of assets where fund will be invested. Long-term funds are used for fixed assets and partly for current assets. Long-term funds are used for the fixed assets. Long-term funds are used for fixed assets and partly for current assets. So you might be getting a doubt, sir, why long-term funds are used for current assets? Generally long-term funds are used for what? Fixed assets. Okay. So because in FM we have a rule, long-term funds must be used for long-term source. Long-term need. Long-term need means, example, plant and machinery is a long-term need that has to be met from the long-term source. Short-term need must be met from short-term source. Medium-term need must be met from medium-term source. So let me give an example. Plant and machinery is a long-term need. Advertisement is a medium-term need. Okay. Temporary working capital is a short-term need. Temporary working capital is a short-term need. So for temporary working capital, you should take a short-term finance from the bank. For medium-term need, advertisement, you should take a medium-term source. If it is a long-term need, like plant and machinery, you should go for what? Long-term source like debentures, preference shares, equity shares, etc. So here you might be getting a doubt, sir, long-term funds are used for the fixed assets and partly for current assets. Why, sir, partly for current assets? Current asset is a what? Short term. No. In working capital we have a two terms. Again I will be recalling it, working capital management. There are permanent working capital and temporary working capital. There are two. Permanent working capital, temporary working capital. So what is this permanent working capital and temporary working capital? Example, Amar is having a crackers shop. Amar is having a crackers shop. Okay. So for example, flower pot. Okay. So and also what? 1000 wala and flower. Let us take only two, 1000 wala and flower pot. So tell me, 1000 wala will be used only during the Diwali season or any other occasion? Throughout the year, this 1000 wala will be used. Example, on Diwali, these 1000 wala will be used. At the same time, during marriages, these 1000 wala will be used. During the results, during some celebrations, or someone has died, even on the occasion of death also, what? These 1000 wala will be used. Yes or no? Okay. Now tell me, if someone dies then will Amar will be suggesting flower pot or what to the customer? Use this flower pot at the head of the dead body? No, right? Nobody will be using what? Flower pots near dead body, right? So that means here flower pot generally what used only during the Diwali. So the point is throughout the year 1000 is maintained throughout the business period. So the amount you invest in 1000 is what? Permanent working capital. But the amount you invest in flower pot is what? Temporary working capital. Likewise in DMart, throughout the year you will find rice. The amount you invested in rice, stock of a rice, is permanent working capital, but the amount invested in Rakis, because Rakis are maintained only during the festival. Okay, so the amount invested in Rakis is a temporary working capital. So permanent working capital is long-term need, not a short-term need. It is a long-term need, permanent working capital. So that's why long-term funds are used for fixed assets and partly for current assets. Clear? Are you getting my point? But temporary working capital is a short-term need. So short-term source, we use short-term source. Projects must be evaluated through the capital budgeting before investing. Yes, that we are going to learn. A portion of long-term funds should be reserved for working capital need. That is what I am saying, permanent working capital. Asset management policies, not politics. Asset management policies must be laid down for efficient use of current assets. We should lay down the asset management policies. That means how much current, what should be the current ratio, what should be the liquid ratio. Likewise, the management should have some policies so that we can use the current assets efficiently. Inventory policy should be jointly set up by production and finance managers. Production managers cannot alone decide the inventory policy. They might maintain a huge stock. No, that inventory policy should be jointly set up by what? Production and finance manager, because we know, as a finance manager, we know what is the cost of holding the inventory. So that's why inventory policy should be jointly set by production and finance managers, considering production needs, raw material price trends and fund availability. Next, financing decisions. Concerned with what? Acquiring optimum finance. Optimum means best finance. We should procure money at a cheaper cost. Best finance to meet organizational objectives, managing both fixed and working capital effectively. Fixed capital, fixed assets and working capital effectively. So for this, financial manager must know sources of finance. That's why we have a second chapter, source of finance, and their respective cost to ensure sound capital structure, that is proper balance between equity and debt. Requires clear understanding of profit versus cash profits. Finance manager should know the difference between profit and cash flow. That is very, very important, because if we are in short of a cash, if we face the liquidity problem, that might affect the reputation of a business. So that's why he should know the clear difference between profit and cash profit. Involves risk evaluation. Example, excessive debt increases risk due to lender's priority rights. If you are taking excessive debt, what happens? The risk will increase. You have to make a payment to the lenders on priority. Special attention to foreign exchange risk in overseas trading requiring protective technology like hedging. This concept we learn in CA Final AFM. We have to pay special attention to foreign exchange risk in overseas trading requiring protective technology like hedging. Hedging means reducing the risk. Hedging means what? Reducing the risk. We should pay the special attention to the foreign exchange risk. What is the foreign exchange risk? Foreign exchange risk means uncertainty in cash inflows or cash outflows arising due to the foreign exchange rate fluctuations. What is the meaning of this? Foreign exchange risk. Uncertainty in cash inflows or cash outflows arising due to foreign exchange rate fluctuation. Example, Amar wanted to do a CPA course. After 6 months, he has to pay exam fee $100. Exam fee $100. Not now, after 6 months. So after 6 months, dollar price will remain same or what? Dollar price may increase or decrease. For example, right now the dollar value is somewhere around 88 to 90. But after 6 months, okay, he has to pay exam fee $100. Let us assume. Now tell me, this dollar value might increase or decrease. That means what is the cash outflow? We cannot calculate now. We have to wait for next 6 months, yes or no? In 6 months, for suppose dollar value increases to 95, then what is his outflow? 9,500 is the outflow. Are you getting my point? That means here foreign exchange risk means uncertainty in cash inflow or a cash outflow arising due to foreign exchange rate fluctuation. So generally when this arises, when there is a cross-border transaction, then there is a overseas trading. If there is no overseas trading, we are not going to face any foreign exchange risk. But if you are doing a overseas trading, for suppose if you are importing material from US and you have to make a payment of $100 after 6 months. So after 6 months, dollar value may increase or decrease. That possibility of loss is called as what? Foreign exchange risk. So further what we do is we learn a concept called hedging at CA final. Next, risk management also include insurance. Example, we may take what? Fire insurance for production of a goods. Next, dividend decision. It is concerned with how much and how frequently the profits are distributed to shareholders as a income. Clear? And owners expect a reward in two forms. One is capital growth, increase in value of investment, and second is dividend. Yes or no? Dividend decision involves amount to be paid out as a dividend. Amount to be paid as a dividend. Amount to be retained for business growth, linking to financing decision. That's why I told dividend decision chapter will come under a financing decision. Because whatever the amount we retain for business growth, nothing but what it is an internal source. It is an internal source of a fund. It is also a financing decision, because if you are retaining the money, if you are retaining the profits for business growth, that is an internal equity, internal source. Dividend policy significantly impact the market value of the company's shares. Dividend policy significantly impact the market value of the company's shares. This we are going to learn in dividend decisions chapter. Next, interrelationship of a financing decision. Interrelationship of a finance decisions. Interrelationship. In finance, we have an investment decision, financing decision, dividend decision. Long term. Short term, we have a working capital. Okay. Investment and financing decision apply to all types of organization. We are talking about interrelationship. Investing and financing decision apply to all type of organization, because we have to procure money, we have to utilize the money for all businesses. Dividend decision apply only to profit making organization. If there are no profits, then what is the point of taking a dividend decision? Yes or no? So therefore financial management is vital. Overall, the conclusion is financial management is very important at all the level of a business activities, from a sole trader to multinational companies. Okay, so whatever we have discussed till now is what? Financing decision, finance decisions. In finance functions or decisions, we have a three. Finance functions or a finance decisions, we have a three: financing decision, investing decision, and dividend decision. Okay. Next, importance of a financial management. Importance of a financial management. The best way to demonstrate the importance of a good financial management is to describe the sum of the task that it involves. The best way to demonstrate the importance of a good financial system management is to describe what? Some of the tasks that it involves. First one, taking care not to over invest in fixed assets, obviously. So that is the task we take care in financial management. We should not over invest in fixed assets. Balancing cash outflows with cash inflows. That's why we are Generally we learn cash flow statement, of course not in financial management, but in advanced accounting we will be learning what cash flow statement. Ensuring that there is a sufficient level of short-term working capital so that we should not face a liquidity problem. Setting a sales revenue target that will deliver a growth. These are all tasks we perform in financial management. Increasing gross profit by setting the correct pricing for products or services. Tax planning that will minimize the taxes a business has to pay. Clear? If you are including a debt in a capital structure, then obviously you can save tax on payment of interest. So these are the tasks which are performed in financial management. So that means so financial management is very important. Okay. Next, scope. Scope means what? Boundary. What is the boundary of a financial management? Determine size of the enterprise, determination of size of the enterprise, and determination of a rate of a growth. Determining the composition of assets of the enterprise. We have to determine the composition of the assets. And next, determining the mix of enterprises financing, considering the level of debt to equity. We should determine the mix of enterprises financing. That means whether we should procure 100% equity or a 50% equity and 50% debt. That we have to do. Analysis, planning and control of financial affairs of the enterprises. So this is the scope of a financial management, but ultimately again the same point, procuring money, utilizing money. Because first point is determining the size of enterprise and determining the rate of growth. Okay, you have to determine the size of the enterprise. Second one is what? Determining the composition of assets, investing decision. Third one is determining the mix of enterprises financing, nothing but financing decision. So analysis, planning and control of a financial affairs of the enterprises. Next, financial controller. What is financial controller? Financial controller objective is to maximize the share value by taking financial decisions. What are the financial decisions? Financing decision, investment decision, dividend decision. He should take care of both return and risk. He should keep the risk as low as possible and he should maximize the return. Next, objectives of FM. It is the most frequently asked question in CE Inter past. Objectives of a FM. Profit maximization, wealth maximization. So profit maximization, it is traditionally been argued that the primary objective of a company is to earn profit. However, profit maximization cannot be the sole objective of the company, because we know the limitations. What is the first limitation? The profit term is vague. It does not clarify what exactly it means. Profit maximization has to be attempted with a realization of a risk involved. If a profit maximization as an objective does not take into account the time pattern of a returns, nothing but we ignore the time value of a money. If a profit maximization is an objective, we does not take into account the time pattern of a return. Okay, so profit maximization and objective is too narrow. It is too narrow. If a profit maximization as an objective is too narrow. So they will be asking a question, 2 marks or 4 marks. What are the limitations? Profit term is vague. It does not clarify what exactly it means. Profit maximization has to be attempted with the realization of risk involved. Profit maximization as an objective does not take into account the time pattern of a returns. Profit maximization as an objective is too narrow. Wealth maximization or a value creation. For measuring and maximizing shareholders' wealth, finance manager should follow. They will be asking, for measuring and maximizing the shareholders' wealth, finance manager should follow. They will ask this question for 2 marks. Finance manager should follow cash flow approach or not accounting approach. Here we are not considering the accounting profit. We should always follow what? Cash flow approach. We should do a cost to benefit analysis and we have to apply the time value of our money. These are the 3 important factors we should follow. So okay, for measuring and maximizing the shareholders' wealth. So wealth is equal to what? Present value of a benefits minus present value of a cost. We bring the benefit to the present value minus what present value of a cost. Okay, and wealth or a value of firm, actually this should be the wealth or value of a equity, cannot be a firm. Wealth or value of a equity is equal to number of a shares into market price of a share. We call it as a market capitalization. Or value of a firm is equal to value of equity plus value of a debt. In study material, so I have taken the text as it is, but the point is value of a firm is equal to value of equity plus value of a debt. But in the above case, they have mentioned value of a firm, but it is not a value of firm, it is a value of a equity, because value of equity is equal to number of shares into market price of a shares. Why wealth maximization works? Okay, why wealth maximization works? Because achieving a higher growth rate, attaining a larger market share. Attaining a larger market share. What is the market share? For example, in mobile electronic devices. Okay, so who is having a larger market share? Example, Samsung and Apple. They are having a larger market share, means they are having a huge number of a customer base. Okay, so attaining a larger market share. Next, gaining leadership in market in terms of product and technology. Gaining leadership in market in terms of product and technology. That is what being done by Apple. Nokia, it has not gained leadership in market in terms of a technology. So that's why it has gone out. Promoting employee welfare. Example, Google will be doing that, promoting employee welfare. Increasing the customer satisfaction. Increasing the customer satisfaction. Increasing community life. Supporting education. Research, solving societal problems, etc. All these will be done if the objective is a wealth maximization. But if the objective is profit maximization, we will not be bothered about customer satisfaction, we will not be bothered about employee welfare, we will not be improving community life, supporting education and research, etc. Okay, so profit versus wealth maximization. Profit maximization, what is the goal? Profit maximization. Wealth maximization, what is the goal? Shareholders wealth maximization. Objective, large amount of profits, but whereas wealth maximization, high market value of a share. Advantages, profit maximization, easy to calculate profit. It is very easy to calculate profit. Easy to determine the link between the financial decision and profit. We can easily determine the link between what financial decision and profit. What is our decision and how much profit we got. But whereas wealth maximization emphasize the long-term gain, that is a benefit, recognizes risk or uncertainty, recognize the timing of a return, considers the shareholders return. These are the advantages. What are the disadvantages? Emphasizes the short-term gain, that is obviously a drawback. Ignores risk or uncertainty, ignores the timing of pattern, require immediate resources. Require what? Immediate resources, not request, require immediate resources. What are the disadvantages of wealth maximization? Offer no clear relation between financial decision and a share price. So we might have started one project, due to that profits increased and share price also increased, but we cannot establish the link directly between what the financial decision and share price. Can lead to management anxiety and also what? Frustration. So wealth maximization. Next, role of finance executive or a CFO. Role of a finance executive or a CFO. His responsibilities includes, first one, financial analysis and planning. That is what? Ratio analysis. Again the same point will get repeated. Ratio analysis. Next, investment decision, financing and capital structure decision, risk management chapter. This we are going to learn in CA final AFM. Management of a financial resources. Again the same point. The role of a finance executive, past versus today's world. What is CFO used to do? What is CFO used to do? Earlier budgeting, now also he is doing budgeting. That's why you are learning budgeting in cost accounting. Forecasting. Now also we are doing forecasting, accounting, treasury, cash management. Treasury means cash. You will be taking care of cash. Preparing internal financial reports for management, preparing quarterly annual filings for investors, tax filing, tracking accounts payable and accounts receivable. But now, so managing mergers and acquisition. Obviously, CAs are involved in what? Mergers and acquisition. Profitability analysis, for example, by customer or product. So, what is this profitability analysis? For example, by customer or product. So, generally, for example, Domino's might be selling what? Pizza, okay, chocolate cake, thumbs up, hash browns, and garlic bread. So likewise, there are many products which are being provided by what? Domino's. Okay. Now the point is this sentence. See this sentence. Profitability. Earlier we used to what? Determine the profit for entire Domino's. Now what we do is, what is this by customer or product? By customer or product means on garlic bread how much profit are we getting? On choco lava cake how much profit are we getting? Okay, on pizza how much profits are we getting? So likewise what we find out the profit for each and every product, so that we can take a decision whether to continue that particular product or not. So this type of analysis. Likewise customer, for example Domino's have a delivery, okay, delivery service, okay, free delivery service. So customers might be ordering from 10 kilometers distance, 20 kilometers distance, 30 kilometers distance, okay. Now here we do a profit analysis by customer, so that we can decide what, whether we can sell a product to a particular customer or not. Example, based on a distance, they will keep a cutoff, okay, they will be what, selling product only to the customer within the 5 kilometers range or a 10 kilometers range. Pricing analysis, okay, what should be the price? Decision about outsourcing. Most of the products these days are outsourced, okay. There are many reputed brands, they will not be manufacturing the products, okay, they will be just what, using the brand. So the product is manufactured by someone else, okay, but this reputed brand will put the name and will sell the product, okay, clear? Overseeing the IT function, information technology, overseeing the HR function, human resource function, so when to recruit and all, okay. So financial distress and insolvency. Financial distress and insolvency. What is this financial distress and insolvency? Okay, to understand this concept, insolvency and also what financial distress. A firm must continuously manage factors like what? Product demand, pricing, input cost and debt proportion. It has to continuously manage which product to produce, what is the demand, how to price, input cost and also debt proportion. If high debt increase, if debt increases, interest burden. High debt increases what? Interest burden. And if cash flows are insufficient, both short term and long term creditors exert pressure. Understand this point. High debt increases what? Interest burden. And if cash flows are insufficient, both short term and long term creditors will exert a pressure. They will put a pressure on a business, yes or no? When a firm cash inflows are inadequate to meet current obligations, then it is said to be in a financial distress. Are you getting my point? We cannot call it as insolvency. In general terms, we tell if a company is not in a position to meet the current obligation, we say the company is in an insolvent. But no, when a firm cash flows are inadequate to meet current obligation, then we say the firm is in financial distress. The prolonged distress, for example, creditors are asking money, I'm not able to pay, okay, but next week I paid, then it is not an insolvency. So next week I haven't paid I told give me 1 month time. After 1 month I couldn't pay. But this distress has prolonged, then it may force the firm to sell assets often at a low price. I saw no. So I have to make a payment of a debt. I have to make a payment of interest. But there is no enough cash inflow. So there is a prolonged distress. It may force me to sell the assets often at a low price. If revenue remain inadequate and debts cannot be repaid, the firm become insolvent. Okay. Insolvency is equal to inability to meet debt obligation, usually the end result of a sustained financial distress. If the financial distress is prolonged, that leads to what? Insolvency. Are you getting my point? Sometimes even we face some difficulty in making a payment, but we ask for 1 week time, 2 weeks time, or 1 month time. After 1 month, if we are able to pay, that is not called as an insolvency. But if we are not in a position to what? Make a payment, then the sustained financial distress is called as what? Insolvency. Okay. So this question was asked in the past. Be careful. Next, relationship of a financial management with other disciplines. Financial management is not independent, yes or no? Obviously, financial management is not independent. It draws input from other disciplines. Example, accounting. To take a decision making, for example, ratio analysis. For doing a financial analysis, we need balance sheet and P&L to find out the ratios. We need cash flow statement to analyze the financial condition of a business. So provides financial data through statements, balance sheet, P&L and cash flow statement. Accounting is equal to accrued based, records past data. Financial management is cash flow based, future oriented, focus on planning and decision making. Financial management begins where accounting ends, but actually not correct. Financial management is first and then what? Accounting. First we procure money, they start accounting. First we utilize money, they start accounting. Okay. But here their version is what? After books are prepared, then we start analyzing the financial statement. Clear? Economics, microeconomics guides pricing, demand, supply, cost of a capital. It guides what? Pricing, demand and supply, and also what? Cost of a capital. Microeconomics, inflation, interest rates, fiscal, not micro, that is macro. Inflation, interest rates, fiscal and monetary policy affect financial decision. Monetary policy means what? RBI may increase interest rates or decrease the interest rates. That will affect our financial decision. If RBI is decreasing the interest rates, that means what? We can get a loan at a lower interest rate. in that case, instead of procuring money from equity, we might procure money from what? Debt. Macroeconomic. Next, marketing. New product, promotions, pricing decisions need financing and impact cash flows. Production. Decisions like expansion, technology and process changes require capital expenditure and financial evaluation. Yes or no? For example, production department, they wanted to purchase a new machinery. They wanted to change the production process. That requires a capital expenditure and financial evaluation. Quantitative techniques, quantitative methods. So quantitative methods means statistics. Example. So provides analytical tools, probability, regression, linear programming for forecasting, risk analysis and decision making. So essence, financial management integrates inputs from what? Accounting, economics, marketing, production, quantitative methods to make an effective financial decision. Example, in final level we find out the standard deviation. That is an analytical tool, quantitative method. Okay, clearer? So financial management integrate inputs from accounting, economic, marketing, production and quantitative methods. The last concept in this chapter, what is the last concept? Agency problem and agency cost. This question was recently tested. Agency cost Agency problem and agency cost. So what is this agency problem? In corporates, in companies, there is a separation of ownership and management. Yes or no? There is a separation of ownership and management. For suppose I am the owner. For example, I am the manager, I am the director, and Amar is the owner. He is the equity shareholder. I am the management, board of directors. I am one of the board of directors. In corporate, generally there is a separation of ownership and management. Agency problem and agency cost. It was tested in the examination. Okay. So simple concept. Shareholders, owners is equal to principals. Managers, agent. So board of directors are nothing but indirectly what agents of a shareholders. Yes or no? What is the agency problem? Agency problem means managers, that is board of directors, may pursue personal goals instead of shareholder wealth maximization. Yes or no? So that can happen or not. For suppose if I do not have any equity shareholding in the company and if I am the director and Amar is the director, Amar is the owner. So what I will do? I will not be focusing on wealth maximization. I will be focusing on my what? Personal goals. This conflict is called what? Agency problem. So that's why we have to incur agency cost. What is this agency cost? Extra cost burden by the shareholders to ensure manager act in their best interest. So this is the extra cost. Agency cost is the extra cost incurred by the shareholders to ensure managers act in their best interest. Okay. So what can be the agency cost? Types of agency cost. Example, monitoring cost. What is this monitoring cost? Incurred to supervise managers. Incurred to supervise the managers. So to supervise the managers. So generally we have a concept of independent directors in listed companies. So why this independent director concept is started? Generally independent director means a person who is not at all related to the company. That person will be what? Unbiased. He will be expressing his opinion unbiasedly. But to appoint an independent director, the company has to pay what? Remuneration. Yes or no? Clear? The cost we incur in supervising the manager is called as a monitoring cost. Next, bonding cost. Okay, bonding cost. So this is a cost incurred by the shareholders. Bonding cost means nothing but what? Example, conducting parties, some like that. So this is not a communicating. So bonding cost. So I will change the text. Bonding cost means what? Maintaining the relationship with a good relationship what? Managers. Okay. Next, opportunity cost. Opportunity cost. Loss due to managerial decisions not aligning with owner goals. For suppose owner is expecting something, but the manager has taken some other decision, and due to the loss has got incurred. That loss is called as what? Opportunity cost. Structuring cost. Structuring cost means what? Cost related to designing contracts. Example, so entering into contract with what? Directors. Shareholders will enter into contract with directors, okay, for remuneration, for what to do and what not to do. The cost relating to designing contracts and governance is called as structuring cost. So there are 4 types of agency cost: monitoring cost, bonding cost, opportunity cost, and structuring cost. Monitoring cost means cost incurred to supervise managers. Opportunity cost means loss due to manager decision not aligning with owner's goal. Owner is thinking something, but manager has taken some other decision, due to that loss incurred. That is called as opportunity cost. Structuring cost means cost relating to designing contracts, governance, etc. If we have a contract with the directors, then obviously director has to bound by the contract, right? Okay, so that is structuring cost. Addressing agency problem. So how to address the agency problem? First one, with debt lenders, using of a negative covenant, like putting a restriction on a further borrowing. We say the directors, Okay, you have to borrow only up to 100 crores. This restriction on a further borrowing will act as a negative covenant. Negative means what? Instead of saying do this, we say what? Do not do this. Do not borrow beyond 100 crores. This is called as negative condition. Covenant means condition. Importance in credit risk management, fundraising, and valuation of a distressed companies. With the shareholders. With the shareholders. What we do is link managerial compensation with company profits and long-term goals. Then obviously what? They will be working for wealth maximization. Stock options. Give the stock options. Align managers' wealth with shareholders' wealth. If you do this, okay, equity shares will be issued. Effective monitoring by board. Effective monitoring by board, audit, and what? Governance practices. So regular audits will reduce this agency problem. Okay. So good, I mean best monitoring by board. Generally the board of directors will be what? Equity shareholders, most of the case. Okay. So that's why the monitoring by the board of directors can also what? Reduce this agency problem. And the best governance practices. So this will reduce what? Agency problem. Okay. So this is what? Agency cost and agency problem. So with this we have completed what? Scope and object of a financial management. So what is the weightage of this chapter? Weightage of this chapter. Okay. You will get 2 to 4 marks. I have covered comprehensively, and the material has been prepared based on a ICAI study material. Okay, but the topics, I mean the concept which I have discussed between time value for money and scope and object of financial management is to make you understand the concept FM. But again, from examination point of view, I have discussed the text completely as per ICAI. Okay, you can go through this theory, and the weightage of this topic is 2 marks to 4 marks. Okay, in next class we are going to start cost of a capital chapter. Clear? Thank you all. Thank you so much. So our next topic, cost of a capital chapter. Cost of a capital. So first we should understand what is the object of learning this topic, cost of a capital. As we have already discussed in introduction, that is scope and object of financial management. While procuring money, we should consider 4 factors, that is cost, risk, control, and flexibility. Okay, there are 2 aspects in financial management: procurement of fund and effective utilization of a fund. So while procuring money, we should consider 4 factors, and one of such factor is cost of a capital. Okay, so here cost of a capital means what? It is a minimum rate of a return required to be earned by the company to meet the expectation of the investors. Minimum rate of a return required to be earned by the company to meet the expectation of the investors. Okay, so who are the investors? Equity shareholders, preference holders, and debenture holders. So first you should understand this sentence. This sentence is very important. If you understand this sentence properly, you can easily solve the questions. Okay, so cost of a capital means minimum rate of a return required to be earned by the company to meet the expectation of the investors. So for example, debenture holders will have an expectation over the company, preference holders will have an expectation over the company, and equity shareholders will have an expectation over the company. So to meet all these expectations, the minimum rate of a return required to be earned by the company, that minimum rate of a return is known as a cost of a capital. Okay, example, cost of a capital, we got 20%. Cost of a capital is not an absolute amount, it is a rate of a return. Rate of a return, it is a percentage. For example, if it is 20%, what is the meaning of this 20%? We have to earn minimum 20%. Then only we will be able to meet the expectation of the investors. Okay, so here the careful point you have to examine, understand here is cost does not represent the actual payment. It does not represent the actual payment. It is not the actual outflow of a interest or a dividend. Okay, so then only you will be understanding each and every concept in this chapter. Cost here does not mean an expense. It does not represent the actual payment. It is not the actual outflow or a interest or a dividend. Actual outflow of a interest or a dividend. Okay, here cost means expectation or a expected return. So requirement of the investors. Here cost does not mean expense. Okay, so cost of a capital also called as, we call it as cutoff rate, hurdle rate, opportunity cost of a capital, capitalization rate. Okay, so why we are finding out the cost of a capital? So for example, cost of a capital 20%. In one capital structure we got 20%. Capital structure means what? Capital mix. Okay, mix of a capital, that is debt equity mix. Okay, so one debt equity mix cost of a capital is 20% and other debt equity mix cost of a capital is 15%. So tell me which option we are going to choose? The option which is having a lesser cost of a capital. Okay, because cost of a capital should be as low as possible. So why the cost of a capital? What is the significance of a cost of a capital in financial management? So first reason, financing decision. It helps in choosing the most economical, cheaper source of a fund. And second reason, evaluation, not evaluation. It is evaluation of investment options. Used as a cutoff rate for project selection. Cutoff rate. You know the meaning of a cutoff. For example, so in CA Inter, what is the cutoff? 40 marks is the cutoff for each subject, and overall cutoff for group is what? 50, right? So likewise, cutoff to pass, the pass or fail, what is the cutoff? 50 is the cutoff. Likewise here, evaluation of investment options. Here the cost of a capital, for example, if it is 20%. So for example, we have to take an investment decision. So there are a lot of investment opportunities, and what is the cutoff rate to select an investment opportunity? 20% is the cutoff rate to select an investment opportunity. For example, if the investment is expected to give only 15%, are we going to select? No. But if an investment proposal is going to give 25%, are we going to select or not? Yes, we are going to select it. Okay, it is used as a cutoff rate. And next, designing of a optimum credit policy. Okay, second part you are going to learn in capital bursting chapter, evaluation of investment options. Third one, designing of a optimum means best credit policy. It is important for determining what credit terms offered to customers. Cost of a capital is very much relevant to determine the credit terms offered to the customers. So whether we should give a credit to the customer or not. If we decided to give, how many months we should give? 1 month, 2 months, or 3 months. Okay, so this is very important. So we should keep in our mind cost of a capital. This point also you are going to learn in working capital management, especially in debtors management. And other uses, what are the other uses? Dividend decision. In Walters model, while taking a dividend decision, we compare the return on equity with cost of equity KE. If a return on equity is greater than cost of equity KE, then what? The optimum payout ratio will be 0. Optimum payout ratio for the dividend is what? 0. So we use this cost of a capital chapter in dividend decision. Valuation of a firm. So at CA Inter level, we are not going to find out the value of a firm. Okay, so extensively. We have a concept called corporate valuation at final level, CA final level. Here we find out the valuation of firm. Okay, but basic only. That is by using the formula EBIT divided by KO in capital structure topic, and also for what? Performance evaluation. So these are the uses of what? Cost of a capital. To take a finance decision, to evaluate investment opportunity, and for designing of optimum credit policy, and next what, dividend decision and valuation of firm and performance evaluation. So how do we determine the cost of a capital? So first step is to determine cost of each source of finance. What is the first step? Cost of each source of finance is calculated separately. Okay, so there can be what, so 4 sources or 5 sources. Example, debt. In case of a debt also, there can be 10% debenture, 12% debenture and 15% term loan. There can be preference, equity shares, and there can be retained earnings. So equity share capital is external equity. Retained earnings is an internal equity. Internal equity, it is an internal source of a finance. So what is retained earnings? So for example, we started a business, we earned profits. Instead of distributing these profits as a dividend, we can retain them and reinvest them. Okay, so retained earnings is also a source of a finance. First in this chapter, we're going to learn how to find out the cost of each source of a finance. So first we should calculate what, cost of each source of finance separately, and then what, we calculate what, weighted average cost of a capital, which is also called as overall cost of a capital of a firm. Overall cost of a capital of a firm. Okay, clear? So factors affecting cost of a capital. So what are the factors affecting the cost of a capital? First one, supply and demand of a funds. For suppose if in the market there is a scarcity of a funds, it raises cost of a capital. Example, during monsoon season, everybody needs money, farmers need money. Okay, so what happens is generally the rate of interest will be high. Okay, again during Pongal, what happens, farmers will get yield and they will repay the debt. Okay, so if there is a supply, if there is a high supply, then what, so rate of interest will be less. But if there are scarcity, if there is a scarcity of a funds, it raises what, cost of a capital. Cost of a capital will increase. Investor preference. So investors preference, investors generally what, they prefer safety, liquidity or a higher return. Influences what, cost. For suppose if it is not safe to keep the money with the company, then what, they will expect higher rate of a return. If there is less liquidity, then they will expect what, higher rate of a return. So investor preference, if investor preference is safety, if investor preference is liquidity, then what, they will expect a higher rate of a return if there is no safety or a liquidity in the company's equity. Next, risk and return. Risk and return. If there is high risk, so this is a fundamental point I have discussed a lot. Higher risk, higher expected return, higher cost of a capital. Higher cost of a capital. Inflation. Rising inflation increases cost of a capital. Rising inflation increases what, cost of a capital. Rising inflation increases what, cost of a capital. That we discussed in time value of a money chapter. If inflation increases, the required rate of a return will also increase. Okay, so rising inflation. Inflation means what, rise in prices. Rise in prices. Exchange rates. So this point is applicable if you are procuring fund from outside. Okay, if you are procuring money from outside sources, that is outside India, so then exchange rate fluctuations will also affect what, cost of raising fund internationally. So these are all the factors which are going to affect the cost of a capital. Next, high risk increases what, cost of a capital. High inflation increases cost of a capital. More supply of funds decreases cost of a capital. High investor confidence, if investor is having a higher confidence, it decreases cost of a capital. Low investor confidence, it increases cost of a capital. Am I clear? So now let us start with cost of a debt. How to find out the cost of a debt? Okay, so how do we get cost of a debt? Cost of a debt. Okay, simple. Cost of a debt. So to understand the cost of a debt, first you should know the several factors which will influence the cost of a debt. Okay, so this chapter is very simple. Even if you learn 2 questions conceptually, that is more than enough. Okay, so this chapter is very simple. First we are going to learn what? Cost of each source of a finance. In that first we are going to learn cost of a debt. So what is the cost of a debt? Effective rate of a return that company has to pay to its debenture holders or a bond holders. Cost of a debt is a effective rate of a return that company has to pay to its debenture holders or a bond holders. Effective. See the word effective rate of a return. Effective rate of a return, or we can this sentence is not important from examination point of view. You need not write it in examination, you have to understand it. But okay, or otherwise you can mention like cost of a debt means minimum rate of a return required to be earned by the company to meet the expectation of a debenture holders. Okay, it is influenced by several factors. So first, face value. Face value. What is this face value? Simple. The name itself indicates face. That means the value which is printed on the debenture certificate. On the face, the value which is printed on the debenture certificate is called as face value. It is also called as a nominal value or a par value. Okay, example rupees 100. It can be rupees 10. It can be rupees 1000. So is it going to affect the cost of a debt or not? Yes, it is going to affect the cost of a debt, because if investor is purchasing a debenture which is having a face value of 100 rupees and the rate of a debenture is 10%, that means they will be expecting interest of rupees 10. If the face value of a debenture is 1000 rupees, then they will expect what? 100 rupees. If the face value of a debenture is only 10 rupees, they will expect only what? 1 rupee. So that means the face value is going to affect what? The cost of our debt. So interest is always calculated on the face value. High face value means what? Higher absolute interest outflow. That means cost of a debt will increase. I mean, in absolute amount, not in the rate. Because if in the numerator we are taking 10, that means denominator 100. If numerator 100 means denominator 1000. So the rate of a return will be same, but higher face value, higher absolute interest amount. Okay. Next, issue price is going to affect the cost of a debt. So at the end I will give an example how it is going to affect. Issue price. Issue price, it is the price at which the company actually issues the debenture. It is the price at which the company actually issues the debentures. So issue price at par. Issue price is at par. So that means issue price is equal to what? Face value. Issue price is equal to what? Face value. So issue price is equal to face value. At premium, issue price greater than face value. At discount, issue price less than face value. So you know the issue price, yes or no? So issue price, it can be at par. Issue price can be equal to what? Face value. So issue price, if it is greater than face value, that means what? It is issued at premium. If issue price is less than face value, that means at discount. So what is the effect on cost of a debt? If debenture is issued at discount, whether you issue at discount or at a premium, you will be paying interest on a face value, yes or no? So if it is issued at a discount, that means company receives less money but pays same interest, yes or no? So then obviously what happens? Cost will increase. If it is issued at premium, that means what? Company receives more money but pays same interest, then obviously cost will decrease. So you need not worry. So we can discuss one question. With one question you will get clarity. Redemption value. What is this redemption value? The value at which the debenture is repaid on maturity. Redemption value, the value at which the debenture is repaid on a maturity. Repaid on maturity. The value at which the debenture is repaid on a maturity. So what is the effect on cost of a debt? For suppose if it is redeemable at par, there is no effect on a cost, because we take 100 and we repay 100. So no effect on a cost. But if it is repaid at a premium, if redemption value is at a premium, then what? Company pays more at maturity. Redemption value is at premium. That means what? Company pays more at maturity. That means cost will increase. If redemption value is at discount, that means company pay less at maturity, so the cost will decrease. Clear? Next, maturity period. Maturity period. So maturity period can be what? 5 years, 10 years, 3 years, 4 years, yes or no? So what is the effect on cost of a debt? Longer maturity spreads out the repayment burden. Okay, spreads out the repayment burden, but lenders may demand a higher rate for increased risk. So for example, maturity is not 5 years, 10 years. So for company, what happens? This maturity spreads out the repayment burden. The repayment burden will decrease because instead of 5 years, we are paying after 10 years. The repayment burden will decrease. But from the lender's point of view, they are taking a high risk. So that's why they might demand a higher return, and longer period is equal to potentially what? Higher cost of a debt. Next, flotation cost. Flotation cost means issue expenses like what? Brokerage, underwriting, printing cost. Because you have to invite the public to purchase the shares or debentures. So you have to issue a prospectus. That prospectus printing cost, brokerage, underwriting expenses. So these are all called as flotation cost. Cost of raising the capital. Flotation cost means what? Cost of raising, cost of procuring the funds. So effect on cost of a debt. So reduces the net proceeds received. If a flotation cost increases, it reduces what? Net proceeds received. Example, issue price 110, flotation cost 10. We receive ultimately what? 100 only. For suppose issue price only 100, flotation cost 10 rupees. That means we receive only 90 rupees. But we have to pay interest on 100. That means it reduces the net proceeds received, so interest increases cost of our debt. Clear? The next one, tax savings on interest. Tax savings on interest. Interest on a debt is tax deductible. Interest on a debt is tax deductible. Yes or no? Payment of interest. Payment of a interest, so is allowed as an expenditure, and we can save a tax, which reduces the effective cost of a debt. So before tax, cost of a debt is equal to interest divided by net proceeds. After tax, cost of a debt is equal to before tax into 1 minus tax rate. Okay, clear? So first, let us, you should know about the income statement. Income statement. Income statement, particulars amount. Income statement, what is the income statement? First, we should take sales minus variable cost. So name itself indicates income. How do you get income? Sales minus cost. Sales minus cost. Sales minus variable cost. Costs can be of a two types, yes or no? Variable cost and fixed cost. So sales minus variable cost contribution minus what? Fixed cost. Then we get EBIT, earnings before interest and tax. If it is a costing income statement, then directly we get profit, because interest is a pure financial expense, tax is also a pure finance expense, equity dividend, preference dividend is also a pure finance expense. Okay, but it is an income statement under financial management. So sales minus variable cost contribution minus fixed cost, EBIT. So now the earnings before interest and tax. Earnings before interest and tax. Earnings before reducing interest and tax. So first we should reduce what? First we should reduce interest. Why interest? Because interest is allowed as an expenditure. Earnings before tax minus tax. After reducing tax, you will get earnings after tax. Earnings after tax. So after payment of a tax, you do appropriation. So first you should understand these words also for FM. Interest is a charge to P&L. Interest is a charge to P&L. Interest is an expense. Irrespective of your financial position, you have to make a payment of a interest. Tax is also a charge to P&L. Tax is also charged to P&L. But preference dividend is an appropriation. Why preference dividend is an appropriation? Because the reason is preference dividend is paid when there are only profits. So earnings available to equity shareholders minus what? Equity dividend. Earnings available to equity shareholders minus equity dividend, then you will get what? Retained earnings. First you should know this income statement, retained earnings. So earnings per share is equal to earnings available to equity shareholders divided by number of equity shares. Yes or no? The language is simple. Earnings available to equity shareholders. So what are the earnings available to equity shareholders? After payment of variable cost, fixed cost, interest, tax, preference dividend, then the balance will be what? Earnings available to equity shareholders. So earnings per share is equal to earnings available to equity shareholders divided by number of equity shares. Am I clear? Okay. And next, return on equity. Return on equity. The name itself indicates return on equity. Return on equity. So what is the return to the equity shareholders? What is the return? What is coming back to the equity shareholders? EAES. You should understand the logic. EAES divided by return on equity investment. So EAES divided by what? Equity. Okay. Next, return on investment. Return on investment. Return on investment is different from return on equity. So whenever someone asks you what is your investment in your business, we will not be saying only the equity. We have to say both what? Equity and debt. Equity and debt. So that's why in the denominator we should take what? Capital employed. We should take what? Capital employed. Capital employed. In the numerator, we cannot take EAS because earnings available to equity shareholders is for only equity shareholders. But here I am taking what? Capital employed. That includes both equity and debt. So that's why in the numerator I have to take EBIT. Earnings available to both equity shareholders and debenture holders. In interviews, they will be asking us simple questions. What is return on investment? EBIT divided by capital employed. Okay. So why not EAES? Why you are taking only EBIT? What is capital employed? They will ask you what is capital employed. You have to be careful. Okay. So here, what is this capital employed? First, equity. Let us write equity. For this chapter, this may not be relevant, but for ratio analysis, this is very much relevant. Equity is equal to equity share capital plus reserves and surplus minus fictitious assets. Equity is equal to equity share capital plus reserves and surplus minus fictitious assets. Equity is also called as net worth. It is also called as common stock. It is also called as proprietary fund. proprietary fund. Equity is equal to equity share capital plus reserves and surplus minus fictitious assets. So what is this fictitious? Fictitious meaning is unreal, imaginary. Unreal, imaginary. Okay, unreal. Amar is having a girlfriend, which is fictitious. Okay, unreal. Likewise, in balance sheet you might find the fictitious assets. Example, discount on issue of a debentures not written off. Discount on issue of a debentures not written off. It is a fictitious asset, unreal, imaginary. You will find in balance sheet. Okay, on asset side. Sir, how sir? So let me write an example. First, suppose if you are issuing a debenture at 5% discount, 5% discount. So what is the entry? Discount account debit 5 rupees. Bank account debit 95. To debenture account 100. So tell me this discount is having a which balance? Debit balance. Okay. So this discount we are not going to write off immediately. So that will be written off over a maturity of a debenture. For suppose maturity is 5 years. So we are using that debt amount for how many years? 5 years. So we are issuing a debenture at a discount of rupees 5. So this 5 rupees is an expense. But this expense is incurred for using the debt for how many years? 5 years. So that's why this is amortized over a period of 5 years. So that's why what is the next entry? P&L account debit to discount account, but just only 1 rupee. That means remaining 4 will go to what? Balance sheet, debit balance. So is it a fictitious asset or not? As likewise, there can be what? Preliminary expenses not written off. Preliminary expenses not written off is also what? Okay, fictitious asset. So there can be P&L debit balance, which is also about fictitious asset, unreal. So that's why here equity is equal to. So you might be saying like reserves and surplus is overall equity fund. No. Equity share capital plus reserves and surplus what? Minus fictitious asset. Okay. Or you can take the otherwise also. Okay. So or equity plus reserves and surplus minus what? Fictitious assets. The other way of writing equity is equal to fixed assets plus current assets minus current liability minus long term debt. So nothing but total assets minus what? Outside liabilities. If you simplify this, you can write it as fixed assets plus current assets minus current liabilities. It is written as working capital. Am I clear? So fixed assets plus working capital minus long term debt. If you are not able to understand, better you take what? Simple balance sheet. Equity share capital, reserves and surplus, long term debt, current liability. On asset side you will have what? Fixed assets, current assets. So if you want to take amount, better you can take amount also to get more clarity. Equity share capital 200, reserves and surplus 100, long term debt 100, current liability, $100. So what is the balance sheet total? 500. So now fixed assets. Let us assume fixed assets is equal to 300, current assets 100. Let us take fictitious assets. Fictitious assets what? 100. So what is the balance sheet total? 500. So how can we say what is the amount of equity? Amount of equity is equal to simple amount of equity share capital plus what? Reserves and surplus minus what? Fictitious assets. So then what is your answer? 200 is our answer. Yes or no? So what is the other way of finding it? Fixed assets plus current assets. Fictitious assets we cannot take. So 300 plus 100, 400 minus what? Outside liabilities. Current liability is 100 and long term debt 100. So what is the answer again? 200 is the answer. Equity. Am I clear, Amar? Okay. Done. Okay. So now if they ask you what is an investment is equal to equity plus, generally we take only long term debt. Equity plus what? Long term debt. So we are not going to consider current liability as an investment, but so there are no standards. So that's what sometimes we take current liability also, but in most of the case we take only what? Long term debt. So investment is equal to equity plus what? Long term debt. Because why? The reason, current liabilities, example creditors. So creditors generally what? During the course of a business we take a credit from a supplier. So that is not considered as an investment. So generally investment is equal to equity plus what? Long term debt. Am I clear? So capital employed is equal to equity plus what? Long term debt. Capital employed or a investment. Am I clear? Done. Now let us come back to what? Cost of a capital. Cost of a capital. In cost of a capital, cost of a debt, we have a two. One is irredeemable debt and second one is what? Redeemable debt. Irredeemable debt and second one is what? Redeemable debt. Okay. Irredeemable debt and what? Redeemable debt can be categorized into two. So first one, let me take a small example. What is the cost of a debt? Cost of a debt means a minimum return required to be earned by the company to meet the expectation of a debenture holder. Cost of a debt. Yes or no? So case 1, let us assume the loan is equal to 1 lakh. Loan is equal to 1 lakh at the rate of what? 10% per annum. Case 1, loan is equal to 1 lakh at the rate of 10% per annum. So tell me, what is the minimum rate of a return required to be earned by the company to meet the expectation of the investors? Simple. They are asking you to find out the minimum rate of a return. Minimum rate of a return. So cost means here expectation. Tell me what the debenture holder is going to expect. Debenture holder is going to expect 1 lakh into 10%. Lender is going to expect 1 lakh into 10%. On what? 1 lakh. What is the rate of a return required to be earned by the company? 10%. So this is KD. So what is the calculation? What is the formula? Interest divided by principal. KD is equal to what? Interest divided by principal. Step by step we are deriving the formula. But second one, for suppose same example, I am adding a point. What is adding a point? Processing charges 2%. Sir, what is this processing charge? So if you take a loan, for suppose you might have not taken loan, but if you take a loan from a bank, the loan will be bank will be charging what? 1% or a 2% on a loan amount as a processing charge. But documentation and all, they will be charging what? 1% or 2%. In that case, cost of a debt KD is equal to, what is the minimum expectation? They will be expecting 10% on 1 lakh. Processing charges 2%, yes or no? So 1 lakh into 10%. Bank will take 1 lakh into 10%. So we take 1 lakh into 10%. But the point to be learned here is, in business we are going to invest how much? Only 98,000. Only 98,000. Only 98,000. So the answer is 10.2%. So now tell me why this KD is equal to 1 lakh into 10% divided by 98,000. Only 98,000. Because even though we are taking a loan of rupees 1 lakh, ultimately we receive 98,000 and we are able to invest only 98,000. 98,000 is our actual investment. Okay. So that's why we take what? 98,000. So the formula is I divided by NP. So interest divided by principal is not 100% correct. So to be 100% correct, we should take what? Interest divided by net proceeds. Here interest means interest amount, not the interest rate. Interest amount. We are talking about cost of a irredeemable debt. Okay. Now example number 1. So that is not the final formula. I divided by NP. Let us take an example to conclude this cost of a irredeemable debenture formula. There are two companies, namely X Limited and Y Limited. The capital of the X Limited financed by the equity shareholders. The capital of the X Limited is fully financed by the equity shareholders, whereas Y Limited uses debt fund as well. Y Limited uses debt fund as well. Given below is the profitability statement of both the companies. Given below is the profitability statement of both the companies, X Limited, Y Limited. Earnings before interest and tax 100. Interest paid to debenture holders hyphen and 40. Okay. EBIT is given. So what is the question? There are two companies. One company is fully financed by equity, and whereas Y Limited is using debt fund. So EBIT is 100 and 100. Both the companies invested the same amount. The only difference is Y Limited is using debt. So what is the interest paid in second case? 40. Profit before tax is there. Okay. Here the point to be observed is tax. So what is the tax amount? First case 35, second case 21. X Limited and Y Limited amount of a capital is same, but the only difference is X Limited is an all equity company, Y Limited is a levered company, the company which is using a debt. So the second company is paying a less amount of a tax, that is 21. So the amount is, how much tax saving we are doing? 14 lakhs. In second case, there is 14 lakhs tax savings. Why 14 lakhs tax savings are there? Because the simple reason, second case we are paying an interest of 40 lakhs. On 40 lakhs, we are saving a tax at the rate of 35%. 40 lakhs into 35%. Okay. So that means how much tax savings? 14 lakhs. Yes or no? So why the reason we are saving the tax? The reason for saving the tax is payment of a interest. Why we are paying interest? Because instead of taking equity, we take a debt. We have taken a debt. That means we cannot say effective interest is equal to 40 lakhs. Actual payment of interest is 40 lakhs, no doubt in that. But the effective interest is only 26 lakhs, because as we are paying 40 lakhs interest, we are able to save a tax by 14 lakhs, and the effective interest is what? Effective interest is only 26 lakhs. Are you getting my point? That's why, see here, we cost of a debt KD is equal to, capital is not given, cost of a debt. What is this 40 lakhs interest amount? Minus, what is the tax saving? 14 lakhs. But if you take the 40 lakhs common, you will get 1 minus 0.35. What is this 40 lakhs interest into 1 minus 0.35 is nothing but what? Tax rate. That means in case of a debt, we can save tax, and due to that, cost of a debt will increase. That is what we have learned in first chapter. Debt is cheaper than equity. The first reason for cheaper debt is tax savings on interest. Okay, clear? So that's why in our formula, cost of a debt KD is equal to I into 1 minus T divided by net proceeds. This is the formula. Am I clear? Okay. So okay, here due to payment of interest, we are saving tax, and due to tax savings, what happens? The cost of a debt will decrease. So cost of a irredeemable debt KD is equal to I into 1 net proceeds. Sorry, I into 1 minus T divided by net proceeds. So are you able to understand the logic for this formula? So y divided by NP only. NP means net proceeds. How do we get net proceeds? Net proceeds is equal to issue price minus flotation cost. Issue price minus flotation cost. Issue expenses. Issue price minus issue expenses or a flotation cost. If issue price is not given, then we take current market price. If a current market price is also not given, we take face value. We take face value. If issue expenses are not given, we take 0. Are you able to understand this? So cost of a debt KD is equal to cost of a debt after tax. I is equal to annual interest payment amount. It is not interest rate, amount. Be careful. NP is equal to net proceeds of a debenture or a current market price. Okay. T is equal to what? Tax rate. If issue price is not given, we take what? Current market price. Am I clear? Okay. So flotation cost, again, flotation cost means what? When a company issues new securities, shares or debenture, it has to spend money on underwriting fee. You know the concept of underwriting, yes or no? Brokerage, legal and administrative charges, registration and printing fee. These expenses are called as what? Flotation cost. For example, if a company issues 1000 debentures of rupees 100 each, it receives what? 1 lakh. Issued at a discount of rupees 5 per debenture. That means discount is equal to 5000. Other expenses like underwriting 5000. Underwriting 5000. So ultimately, what is the net proceed? Even though we are issuing 1 lakh rupees worth debenture, okay, we are issuing only for what? 95,000, because discount is 5000. And we are incurring money on underwriting 5000, and what is the net proceeds? 90,000 is the net proceed. Clear? Interest is equal to example 15,000 per year interest. Tax rate 50%. So then how to calculate? Simple. So our interest amount is 15,000, no doubt in that. But on payment of interest of 15,000, we can save tax by 50%. That means the effective payment of interest is only 7,500. Effective payment of interest is only what? 7,500. Are you getting my point? Okay, divided by what is the investment amount? We are investing only what? 90,000. So that's why what is the cost of a debt here? 8.33% is the cost of a debt. Am I clear? Done? Okay. Next, cost of a redeemable debenture. Cost of a redeemable debenture. So right now whatever the formulas we are learning, these are approximation methods. We get approximate answer, not the accurate answer. If you want to get accurate answer, we should go for what? IRR method, yield to maturity method, yield to maturity. Cost of a debt. Okay, cost of a debt. So what is the formula? Cost of a debt, KD is equal to I into 1 minus tax rate plus RV minus NP divided by N whole divided by RV plus NP divided by 2. So it is also easy to understand. You can understand the logic. You need not by heart it. I means interest payment. T means tax rate applicable to the company. NP means net proceeds or a current market price. RV means redemption value of a debenture. N means remaining life of a debenture. Okay. So we apply this formula. Generally in most of the case we apply this formula only, because only interest is deductible, only interest is tax deductible, only interest is allowed as an expenditure. Okay, so that's why we apply this formula. We take an assumption that only interest on a debt is tax deductible. But whereas there is another alternative where discount on issue or a premium on redemption is tax deductible. For example, net proceeds 90, net proceeds 90, redemption value 110, redemption value 110. That means you are paying extra of 20. You are paying extra 20. So definitely the 20 is expenses or no? If the 20 is also tax deductible, discount on issue or a premium on redemption is tax deductible, then what? Instead of taking I into 1 minus T, we take 1 minus T for what? The overall final answer. Okay, clear? So what is the logic for the first formula, that is redeemable debt? KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by what? RV plus NP divided by 2. Simple logic. When the debenture is redeemable, example, I am taking interest 10 rupees into 1 minus tax rate 0.3 plus redemption value 110 minus net proceeds 90 divided by 5 whole divided by 110 plus 90 divided by 2. Here the answer is not important. Understand this. 10 into 1 minus 3. Why 10 into 1 minus 3? Because on payment of interest we can save tax. So that's why 10 into 1 minus 3. Why we are taking that plus RV minus NP divided by N? Simple logic. So KD means cost of a debt, yes or no? 90 means the net proceeds. We are taking 90 and making a payment of 110 over a period of how many years? 5 years. That means per year you are paying, on an average per year you are paying an extra of 4 rupees, extra 4 rupees. That means in addition to interest, you have an additional cost, that is difference between the redemption value and net proceeds. That can be positive or that can be negative. So it can be reverse also. You might take 110 and you might redeem at 90. Okay. So that's why we have to consider that also. When it is a redeemable debt, I into 1 minus T plus RV minus NP divided by N whole divided by. Sir, why we are not taking net proceeds? Because the reason is the principal we are taking is 90. The principal we are giving back is 110. So that's why we have to take what? Simple average. That's why in the denominator we are taking what? RV plus NP divided by 2. Clear? So here is the formula, that is KD is equal to I into RV I plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 1 minus tax rate. Okay. So these formulas of cost of a debt not suitable These formulas of a cost of a debt are not suitable if a difference between redemption value and net proceed is very high. Reading my point, because you will get a lot of difference between the actual answer and this approximate answer. Okay. So in case of a gradual redemption of a debentures or a bonds, in case of a gradual redemption of debentures or bond means what? Instead of paying on the maturity, you might what? Pay every year principal. If a principal is repaid every year, for example 5,000 is the debt amount, maturity 5 years. Instead of paying 5,000 at the end of 5th year, what you can do is you pay 1,000 at the end of first year, 1,000 at the end of a second year. In that case also this formula will not suit. Okay. So that's why we have a cost of a debt using what? Yield to maturity method. So this is a frequently asked question, one of the most frequently tested concept, yield to maturity. If you want to solve this yield to maturity, if you want to calculate the cost of a debt using yield to maturity, you should learn IRR. So the concept which we have already discussed in what? Time value of a money, IRR. So IRR, I have discussed the logic, simple logic. IRR is equal to lower rate plus NPV at a lower rate divided by NPV at a lower rate minus NPV at a higher rate into higher rate minus lower rate. But instead of by hearting the formula, you better apply the logic. Okay, clear? So when I discuss the concept, it might take a time, but once a discussion is over, we can solve the questions easily. You will get more clarity on these concepts when we solve a question. Okay. Next, amortization of a bond. So what is this amortization of bond? A bond may be amortized every year. That means principal is repaid every year rather than at maturity. That is what I told earlier. The principal will go down with annual payment and interest will be computed on a outstanding amount. Okay. How to find out the value of a bond? They have given this formula, but this formula is not at all relevant, because we know the logic how to find out the value of any asset. That can be a debenture, that can be a preference share, that can be an equity share, anything. How do we get value of any asset? We should bring the future cash flows to the present value. That's it. Okay. So this formula is not at all relevant. I will make you understand with simple, okay, example how to find out the bond value. So let me take an example. Here amortization of bond, that means what? A bond may be amortized every year. Bond face value rupees 5,000. Maturity 5 years. Bond face value rupees 5,000. Maturity 5 years. Rate of interest 10%. Value of a bond is equal to what? Question mark. Value of a bond is equal to question mark. Simple. How do we get value of any bond? We should bring the future benefit to the present value. Value of any asset. Value of any asset. So let me take columns here. Cash flow. I cannot take PVAF. I should take present value factor at the rate of, for example, required return is equal to 12%. We should always bring the future benefit to the present value using the required rate of a return. If risk increases, required rate of return increases. Okay. So discounted cash flow. Year column. 1, 2, 3, 4, 5. So first year, for suppose if you are purchasing this bond, then as an investor, what is the benefit you are going to get in first year? 5,000 divided by 5. Maturity 5 years, it is amortized. It is repaid every year. Okay. So that means 5,000 divided by 5. You will get 1,000 plus on 5,000 you will get 10% interest. That means what is the amount? 1,000 plus 500. Clear? So 1,500. Am I clear? Next, 1,000 plus. This time you will get only 4,000 into 10%. Okay. You can find out the value of a bond from the perspective of a company also. From the company's perspective, company it is outflow. For company it is what? Outflow. For investor it is inflow. For both of them, how to find out the value? Bring the future cash outflow or inflow to the present value. Okay. But their required rate of returns may differ. Investor required rate of return 12%, but company required rate of return may be 14% because value completely depends upon perception. Next, third case what? 1,000 plus 300, 1,300, 1,000 plus 200, 1,200, 1,000 plus 100, 1,100. So tell me the present value factor at the rate of what? We should take 12%. PV factor at the rate of 12%. Why PV factor at the rate of 12%? The bond interest rate is 10%, but the investor required rate of return is 12%. We should bring the future benefit to the present value using the required return. Please do understand. So what are the factors? 0.893, 0.797, 0.712. Proper rounding off has to be done. 0.636, 0.567. Discounted cash flow 1,500 into 0.893. 1,500 into 13,000. Okay, 1,340. 1,400 into 0.797. 1,116. 1,300 into 0.712. 926. 1,200 into 0.636. 763. 1,100 into 0.567. 624. Total 1,340 plus 1,116 plus 926 plus 763 plus 624. 4769 is the value of a bond. Am I clear? The concept is clear. I have discussed already in time value of money. Value of any asset, how do we get value of any asset? We should bring the future benefit to the present value. That is what we are doing. Okay? Clear? Done? Are you able to understand this? Convertible debt. Sir, what is this convertible debt? Convertible debt. Simple. Convertible debt. So we know equity, we know debt. Yes or no? Equity and debt. A debenture holder will get only interest. Yes or no? Equity holder will get what? Whatever the balance remaining after payment of interest and preference dividend, The entire amount will be enjoyed by equity shareholders. Okay. So what is this convertible debt? Simple concept. So whenever you want to start a business, you will have a fear. What is the fear? The business might fail. Yes or no? Likewise, every investor fear is what? So here the business might fail. Likewise, for suppose if I wanted to start a business, I have asked investment from what? Amar. Okay. So I have asked high net worth individual. High net worth individual. High net worth individual means Baga. Okay. So I asked amount from what? Amar for investment. Okay. Now the question Amar is, so Amar, please give me a debt. Please give me a debt. I will pay 15% rate of interest. Now the Amar question is, sir, if a business becomes successful, I will just get 15% rate of interest, but you will be enjoying the profits. So I don't want to give a debt. Okay. Then I told, okay, if you want to enjoy the profits, then you invest in equity. But I want money for business. Now Amar question mark is what? Sir, if a business becomes successful, okay, we both can enjoy profits. But if a business becomes unsuccessful, then I will be losing the money. And for the next 4 years or 5 years, I will not be getting any interest. Okay. But at any cost, I want money as a promoter. What I will do is, I will give an option to the Amar. What is the option? Amar, you give me a debt. Next 5 years, I will pay interest. Okay. And at the end of 5 years or on or before 5 years, you have an option to convert this debt into equity at any time. You can convert this debt to equity in the future. Okay, if you want. Otherwise, what I will repay the debt. Simple logic. I am giving an option to the investor. If a business becomes successful, he will opt for equity. If a business becomes unsuccessful, he will opt for debt. Yes or no? Okay. Sir, why we are discussing in cost of a capital? So convertible debt means it is debt that can be converted into equity share at a future date. So what is the purpose? Why this concept has brought in? It balances investor risk and reward. So business outcome can be what? Business outcome can be business may fail. Then investor, what is the benefit to the investor? He receives debt repayment. Business may succeed. If a business succeed, has an option to convert into equity. Okay. So cost calculation. You know the formula I into 1 minus T plus RV minus NP divided by RV plus NP divided by 2. Cost calculation is similar to normal debt. It is similar to normal debt, but at maturity, redemption value will be, investor choose the option most beneficial to them. We cannot directly take the redemption value. For suppose if he convert the debt into equity, he might get 140 rupees. If he is not converting to equity, then he will get 120. If he is converting the debt into equity, he will get 140. Otherwise, he will get only 120. That means he will be choosing an option to convert the debt into equity. So that means for cost calculation, the redemption value we should take is 140. Clear? But if we convert into equity, the amount is 100. Otherwise, debt is equal to 120. Then he will be choosing what? Debt. So that means we should take redemption value what? 120. So conversion value. First we should find out what conversion value. What is the conversion value? Conversion value means value of a shares received if converted into equity. Redemption value, amount received if debt is repaid. So cost calculation. For cost calculation, use higher of, not height of, use higher of conversion value or a redemption value. Are getting my point? For suppose debt redemption value is equal to 100. Debt redemption value is equal to what? 100. But if it is converted into equity, then conversion value is equal to 15 equity shares into 10. One debenture can be converted into 15 equity shares and one equity share is equal to 10. Then what is the value? 150. Okay, so investor will be choosing what? 150. So that means for cost calculation, redemption value, we should take what? Redemption value, we should take what? Higher of the conversion value or a redemption value of a debt. Redemption value of a debt. Am I clear? Done? Clear? So determination of a cost. The cost of any source of finance is expressed as a percentage per annum. Yes or no? Okay. So now this is IRR method. IRR, internal rate of a return, that is, here text is given. This text you need not remember it. IRR method, yield to maturity. So how to find out the cost using the yield to maturity method, that is IRR method. First identify the cash flows. Identify the cash flows. Identify cash outflow. So first, from company point of view, in IRR method, in capital bursting different. In capital bursting what happens is initially outflow, in the future inflow. Yes or no? For company initially outflow, in future what? Inflow. Okay. But here in cost of a capital, initially inflow, future outflow. Because if we issue a debenture, we receive money. But in future, we pay interest or a dividend or a redemption amount. Yes or no? So the point is, here while finding out IRR, IRR is nothing but a discount rate at which sum of a discounted cash inflows are equal to sum of a discounted cash outflow. In capital bursting, we know the initial cash outflow, but here we know initial cash inflow. So here we should bring the future cash outflows to the present value, and that should be equal to what? Initial cash inflow. The rate at which the sum of a discounted cash outflows are equal to sum of a discounted cash inflow is called as a cost of a debt, KD or a KE for that matter, under yield to maturity method. So tax effect, inflow on a tax benefits on interest. Tax benefits on interest is what? Inflow. So there can be outflow on dividend tax, outflow of a dividend tax, that we have to consider. After identifying all cash flows, we find the rate at which present value of outflow is equal to present value of a inflow. That rate represent what? IRR. That is an IRR to what? Investors. But for company it is cost. Okay. So investment decision, IRR represents income or return. In investment decision, okay, context, you have to understand the concept, context. Cash flow pattern, initial cash outflow, series of a inflow. Yes or no? Are you getting my point? In investment decision, capital bursting chapter, IRR means income. IRR means return to the company. Cash flow pattern, initial outflow, series of a inflow. Okay. In cost of a capital chapter, IRR means cost to the company, required return to the company. Okay. But for investor, it is what? Return. What is the cash flow pattern? Cash flow pattern is equal to initial inflow, series of outflow. Series of a outflow. Am I clear? Clear? So generally what, to get accurate answer we use IRR, but to avoid complex IRR computation we often use a shortcut formula that gives an approximate result. Hence such formulas are known as what? Approximation methods. That means I into 1 minus t plus rv minus np divided by n whole divided by rv plus np divided by 2. This is an approximation method. Are you getting my point? So IRR concept I will be discussing. Simple. Next, cost of a preference share capital. So this will not take much time. Cost of a preference share capital. Again, it is a dividend. It is a rate of return expected by what? Preference shareholders. It is dividend that company has to pay in relation to net proceeds received from issuing the preference shares. So KD is equal to, KP is equal to simple preference dividend divided by net proceeds. So why we are not taking into 1 minus tax rate? Because we cannot save tax on a payment of a preference dividend. So that's why KP, cost of a preference share, is equal to preference dividend divided by net proceeds. Again, the same factors, the factors which are going to affect a KP. The nominal value, face value printed on the share is called as a nominal value or a face value. What is the effect on preference share? Dividend is calculated on face value. Higher face value, higher absolute dividend. Issue price, the price at which the preference shares are issued. Issue price is equal to face value, that means at par. Issue price greater than face value, at premium. Issue price less than face value, at discount. What is the effect on cost of preference? If it is issued at discount, company receives less money, but base dividend on face value, cost increases. If it is issued at premium, company receives more money, but pays dividend on face value, cost will decrease. Redemption value, in case of redeemable preference share, the amount payable to preference shareholders at redemption. In case of redeemable preference share, the amount payable to preference shareholders at redemption. So what is the effect? At par, neutral effect. If you are redeeming at premium, more payout, cost increases. If you are redeeming at discount, less payout, cost decreases. Maturity period, again same. Longer the maturity, cost may increase because investors will expect a higher rate of a dividend. Flotation cost increases. If a flotation cost increases, net proceeds will decrease, and so cost will increase. Tax treatment, no tax shield benefit is available on preference dividend. So therefore, generally the cost of a preference capital is higher than the cost of a debt. Okay. So cost of a preference share capital can be irredeemable preference share, redeemable preference shares. If it is irredeemable preference share, KP is equal to PD divided by P naught or net proceeds. Okay, net proceeds, P naught or a net proceeds. P naught means current market price. If issue price is not given, we take what? Current market price. Issue expense is not given, issue expense is equal to 0. How do we get net proceeds? Net proceeds is equal to issue price minus what? Flotation cost. Cost of a redeemable preference share. Cost of a redeemable preference share, KP, is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2. So PD is equal to annual preference dividend, RV is equal to redemption value, NP is equal to net proceeds from issue of a preference share, N is equal to remaining life of a preference shares. Is it clear? The only difference is we cannot save tax on a payment of a preference dividend. Clear? Next, cost of a equity share capital. Cost of a equity. Cost of equity means expectation of equity shareholders. There are different methods to find out the cost of equity because in debentures and preference shares we have a clarity. Debenture holders will expect only interest. Preference holders will expect only preference dividend, but whereas equity holders, we cannot say they will expect only equity dividend because all companies will not pay dividend because payment of dividend is not mandatory. We have a dividend decision chapter. In that chapter we are going to learn the concepts, okay, dividend decision theories. Okay, so the point is here, equity share capital. In case of a cost of a equity share capital, we have a different methods. First one, dividend price approach, earnings price approach, growth approach, realized yield approach. Realized yield approach means nothing but YTM approach, yield to maturity, IRR method. Next, capital asset pricing model. Capital asset pricing model. So dividend price approach is simple. Dividend price per share is, dividend price approach is, okay, simple concept. Equity shareholder will expect only the equity dividend. Equity shareholder will expect only what? Equity dividend. So that's why what? Cost of equity is equal to D1 by P naught. P naught means a current market price. we can take net proceeds for fresh issue. So here we should understand, in case of equity especially, difference between the net proceeds and current market price. For suppose 20 years back a company issued an equity share for rupees 12, 20 years back. So that means 20 years back what was the net proceeds? 12 rupees was the net proceeds. So 20 years back, for calculating cost of equity, you can take what? 12 rupees as a net proceeds. But right now, today, to find out the cost of equity, we cannot take 12 rupees as a base, because the reason is, so within these 20 years, the share price of equity increased to 2000 rupees. Share price has got increased from 12 rupees to 2000 rupees. That means here we cannot consider 12 rupees is invested in the company. So 2000 rupees invested in one equity share. So that's why while calculating cost of equity KE for an existing issue, already existing share capital, to find out the cost of equity, we cannot take the old net proceeds, that is 12 rupees. We have to take current market price. The logic is, today an investor is foregoing an opportunity of investing 2000 rupees elsewhere. So that's why cost of equity K is equal to D1 by P naught. Okay, so what is this D1? D1 means expected dividend, and P naught is market price of equity. Be careful, it is ex dividend price, excluding the dividend. Ex dividend means what? Excluding the dividend. Cum dividend means including the dividend price. Cum dividend price means including the dividend price. Okay, am I clear? Next, earnings price approach means instead of taking a dividend, we take what? Earnings. Okay, so in this approach we assume that what? So earnings per share is constant, remains constant forever. In previous method, we take an assumption that dividend per share is expected to be constant forever. But generally in equity shares, what happens is dividend will grow every year, earnings will grow every year, because company is doing a business will grow every year, right? But first two methods, we assume that there is no growth, it remains constant for every year. So what is the cost of equity formula? K is equal to earnings divided by earnings divided by current market price. Okay, sir, why again this method? We already taken dividend approach, why again earnings approach? Simple. So why earnings approach? Because the reason is, why do the equity shareholder expect only the dividend? For example, EIS minus equity dividend, there are retained earnings also. That retained earnings also belongs to what? Equity shareholders. So here this is similar to dividend price approach, but it is only to seek to nullify the effect of change in dividend policy. For suppose some companies will not pay dividend, that doesn't mean what? Equity shareholders have no expectation. So they will expect what? Earnings in that case. So that's why earnings per share divided by current market price per share. Am I clear? Next one, growth approach. Growth approach, it is also called as Gordon's model. Be careful, in examination they might ask you to find out the cost of equity using Gordon's model. So Gordon's model is simple. As per this approach, dividend growth remains constant. Growth remains constant, not the dividend. Growth remains constant. Dividend and equity share price all grow at the same rate. They will grow at the same rate every year. Okay, so every year, that means investor will be expecting a growth on a dividend every year. So that's why the formula is D1, expected dividend. How do we get expected dividend? D1, D naught into 1 plus G. P naught is equal to current market price per share. G is equal to current growth rate of a dividend. Okay. In case of a newly issued equity shares where flotation cost is incurred, if it is a new issue, as I have already told, if it is a new issue, we should take what? Net proceeds. Okay, if it is a new issue, we take net proceeds. If it is an existing issue, we take what? Current market price. How do we get net proceeds? Simple, issue price minus what? Flotation cost. Issue price minus what? Flotation cost. Okay, clear? So how do we get growth rate? Growth rate, Gordon's growth model, growth rate is equal to B into R. B into R. So, and first one, there is another method to find out what growth rate by using IRR method. So there is a formula n square root of that, we need not use this formula. Okay, I will explain with problem how to find out the growth rate. So see the second one, focus on the second one, which is conceptual. Growth rate is equal to B into R, Gordon's model. So B means retention ratio, R means rate of a return on equity or a fund invested. Okay, simple. The logic with this formula is, so if you want a growth, first factor is retention ratio, second is what, return on a equity. For example, Amar, he got 20 lakhs package. He is earning 20 lakhs per annum. 20 lakhs per annum. Okay, but the retention ratio is equal to 0. Retention ratio is equal to 0. Okay, will there be a growth or not? No. Okay, but Amal, a decent fellow, 20 lakhs package, 20 lakhs package, he is retaining 100%. He is retaining 100%, but not reinvesting. Not reinvesting. So will there be a growth or not? So there will not be a growth. There will not be a growth. Okay, what is your brother name? Adarsh. For example, Adarsh, he is also earning 20 lakh rupees per annum. He is decent as well as what? Rational. Okay, he is retaining 100% and reinvesting at the rate of 20%. Now tell me, there are three families. Okay, Amar family, okay, Amal family and Adarsh family. So whose wealth will grow at a higher rate? Adarsh family. But Amar and Amal will have no growth, because Amar, no retention. Okay, Amal, retention 100%, but return on investment is 0. Okay, Adarsh, so 100% retention plus what? There is a return on a investment. Simple logic. So growth is equal to B into R. Retention ratio into return on a investment. If return on investment is 0, growth is equal to 0. If retention ratio is equal to 0, growth is equal to 0. So okay, clear? So how to find out growth under average method, I will explain with question. Realized yield approach. Realized yield approach is nothing but what? Cost of equity is equal to realized rate of return. We use IRR method, internal rate of a return. You need not worry, I will explain this. Capital asset pricing model. It describes a linear relationship between risk and return of a securities. CAPM approach, capital asset pricing model. So capital asset pricing model, simple. This is based on the principle, if risk increases, required return will also increase. So this is a final level portfolio management concept. We have a concept of systematic risk and unsystematic risk. Total risk is equal to systematic risk plus unsystematic risk. Risk means uncertainty, possibility of occurrence of loss, possibility of a deviation from the mean. Okay, standard deviation. So we are going to learn how to find out the standard deviation, total risk, systematic risk and unsystematic risk at a final level, AFM, advanced financial management. But right now, to understand the CAPM, let us discuss what is the systematic risk and unsystematic risk. So systematic risk means it cannot be eliminated by diversification. Unsystematic risk means it can be reduced or diversified. First of all, what is the meaning of diversification? Diversification means entering into a new line of a business. Diversifying means entering into a new line of a business. Example, in portfolio investment. So in stock market, there is a rule, popular one. There is a saying, we cannot put all eggs in one basket. If we put all eggs in one basket, eggs will break, yes or no? Likewise, we cannot put all the money in one stock. If you are investing all the money in one particular stock, what happens? If that company CEO dies, what happens? All your money may be lost, yes or no? So that's why you should not put all your money in one stock. You have to diversify your investment. Diversify your investment means what? You have to invest in two or more securities. That is called as a portfolio. That we are going to discuss in final. Portfolio. Portfolio means investment in two or more securities. If you are investing in two or more securities, okay, example, you invested in 10 company shares, then what happens is unsystematic risk will get diversified, unsystematic risk will get reduced. Sir, what is this unsystematic risk? Unsystematic risk is a company specific. Okay, example, Amar, he invested in Reliance shares. Okay, but Mukesh Ambani immediately what, he resigned as a CEO. Now the point is, he invested only in Reliance shares and Mukesh Ambani resigned as a CEO. Is it a company specific or a market specific risk? Company specific risk. If Mukesh Ambani is resigning as a CEO of a Reliance company, only the Reliance company is going to affect, not the market. Are you getting my point? So how it can be diversified? By investing in other shares also. Instead of investing only in Reliance, if you are investing in other 2 or 3 companies, that risk can be diversified. Okay, so that's why it is also called as was diversifiable risk, company specific risk. But market specific risk, what is this market specific risk? Example, market specific risk means what? Simple. For example, if there is a change in government in a country, for example, Donald Trump was elected as a US president. So will it affect only one company or overall market? Overall market will get affected. That means in that case, even if you invest in 5 stocks or 10 stocks, the risk cannot be diversified. Okay, so examples for systematic risk is what? Inflation. Inflation will equally affect what? All the companies. You might have seen Temper movie, Junior NTR. Okay, in that there is a famous dialogue, right? Okay, రమ్మను సునామీని రమ్మను. ఓకే, వస్తే నువ్వు నేను అందరం ఏంటి పోతాం. Okay, that means tsunami or a corona, COVID, all these are what? Okay, systematic risk. So that is not going to affect only one person or one single company. That is going to affect what? Everyone. Government policy, interest rates. Okay, but whereas strike or a lockdown in the company is what? Unsystematic risk. If a labor doing strike in one particular company, only that particular company is going to affect it. So okay, so beta denotes systematic risk. Here beta denotes what? Systematic risk. So that's why we have discussed this concept. So what is the CAPM return? Cost of equity CAPM return, KE is equal to, cost of equity KE is equal to RF plus RM minus RF into beta. Sir, what is this RF? Risk free rate of a return. Beta coefficient, risk factor. RM, rate of a return on a market portfolio. RM minus RF, market risk premium. Sir, what is this concept? KE is equal to RF plus beta into RM minus RF. For example, so what is this risk free rate of a return? Risk free rate of a return. First you have to understand the risk free rate of a return. Risk free. For example, treasury bill. Treasury bill is a risk free instrument. Treasury bill is what? Risk free investment. If you are purchasing a treasury bill, if you are investing in a treasury bill, that means you will be having a zero risk. No uncertainty, you will get back your money. But suppose if you are making a fixed deposit in bank, we cannot say zero risk, but less risk, negligible risk. If you are making a fixed deposit in bank, why? Because you will get back your capital and you will get back your interest. Because simple reason, bank will not make a default. Okay, if a bank do not have a money, what they will do? They will take charges from the customers for not maintaining a minimum balance. Yes or no? For not maintaining minimum balance, what the bank will collect charges, and bank will levy charges if there are more than 5 withdrawals in ATM. Likewise, what the bank will do is bank will collect charges from the customers and will give back your FD, fixed deposit with interest. So that's why if you are investing in a bank also, if you are making a fixed deposit in bank, that means almost no risk. Okay. For example, treasury bill rate of return, example 8%, let us assume 8% is the treasury bill rate. That means without any risk, you and me can earn 8% rate of a return. This 8% is called as what? RF. Okay. But now we all decided to invest in Amar, okay, Beverages Limited. Amar Beverages Limited. We all decided to invest in Amar Beverages Limited. Now the point is, instead of investing in treasury bill, which is non-risky, now we decided to invest in what? Amar Beverages Limited. He gave a pitch presentation. What is this pitch presentation? You might have watched Shark Tank program. In Shark Tank, so venture capitalists will be sitting, okay, as a judge, as or no? Venture capitalist. Who is venture capitalist? Venture capitalist means a high net worth individual. They will always be interested in a risky businesses. Risky business which gives a exponential growth, which gives an exorbitant profits. They will not be investing in a routine businesses. Venture capitalist will be taking risk. Okay, they will take risk, they will invest in startups. Okay, so Amar has given a pitch presentation. Pitch presentation means what? Nothing but, so in Shark Tank program, whatever the presentation being given by the entrepreneurs, that is what? Pitch presentation. So likewise, Amar also, he gave a pitch presentation. We all got convinced. We wanted to invest in what? Amar Beverages Limited. Now tell me, is there a risk or not? Too much risk, yes or no? Too much risk. Okay. So if earlier no risk in treasury bill, now we are investing in Amar Beverages Industries Limited. So too much risk, yes or no? So that's why our required rate of return will increase or decrease. Our required return will obviously more than what? RF plus. RF plus what? RM minus RF into beta. So this is excess is called as RM minus RF into beta is called as what? Security risk premium. RM minus RF is called as a market risk premium. Be careful. RM minus RF is called as a market risk premium. Okay. RM minus RF into beta is called as a security risk premium. Sir, what is this market? So whenever we say market, market means what? Nifty. Market means what? Nifty or Sensex. Market means what? Nifty or a Sensex. Okay. So what is this market return? Example, market return is equal to 12%. What is the meaning of this 12%? If you are investing in Nifty or a Sensex, if you are investing in market, the return you are going to get is what? 12%. If you are investing in risk-free security, what is the return you are getting? 8% is the return you are getting. So beta of a risk-free security is always equal to 0. Beta of risk-free security is always equal to 0. That's why K is equal to what? RF plus RM minus RF into 0. That is equal to what? RF. That means if investor is investing in risk-free security, he will be expecting what? RF. But if investor is investing in market, so what is the market beta? Market beta is equal to 1. What is this beta? What does it denote? Beta denotes responsiveness of a security with respect to the market. Sensitivity. It is called as sensitivity. We all are sensitive. We all are sensitive. We respond to many things. Okay. If Donald Trump is getting a fever, are we going to respond? No. Yes or no? But if Narendra Modi health is not good, then what? Okay, we respond, yes or no? Because we are sensitive. We are sensitive to Narendra Modi, yes or no? Likewise, Reliance share is sensitive to the market, sensitive to the market. Market may move up or down. If a market is moving up, the Reliance share may also move up. Okay. If a market is going down, then Reliance share may also go down. So this is called as what? Sensitivity. For suppose if it is not moving, Reliance share is not getting affected by the market, that means what? Insensitive. Insensitive. Are you getting my point? For example, beta of risk-free security is equal to 0. Why I am writing beta of risk-free security is equal to 0? Because market may move up or down, but the risk-free security treasury bill will remain same. Okay, are you getting my point? So Pooja Hegde is getting married, Amar will get affected or not? Answer is no, because sensitivity between Pooja Hegde and Amar 0. Are you getting my point? But okay, his girlfriend name Nil, if she is getting married, then what? Is he going to get affected or not? Yes, he will get affected. Okay, so here beta of a risk-free security is equal to 0 because risk-free security is insensitive to the market. What about sensitivity of a market? Sensitivity of market is equal to 1, because if a market move up, market will move up by the same ratio. So that's a beta of a market is equal to what? 1. In that case, K is equal to what? RF plus RM minus RF into what? 1. So RF and RF will get cancelled and what? RM. So that means equity shareholder will expect, that means if he is investing in market, he will be expecting what? RM. Okay, now let us come to what? Beta of Amar Beverages Industries Limited. Beta of Amar is equal to 5. What is the meaning of this 5? If market move up by 1%, Amar Beverage Industry Limited increases by what? 5%. Okay, if a market increases by 10%, okay, market price of Amar Beverages Limited will increases by what? 50%. We are talking about increase, but if a market decreases by 10%, Amar Beverage Industry Limited market price will decreases by 50%. That means high beta indicates high risk. High beta indicates high risk. That's why what will be the expectation of investors? This time investors expectation will be RF plus, without any risk itself we expect RF. That's why RF plus, we are taking risk. So that's why we expect what? RM minus RF. RM minus RF is nothing but what? Market risk premium. Okay. But here the risk of this Amar Industries is what? 5 times of a market. So that's why we expect what? 5 times of a market return. Sorry, market risk premium. 5 times of a market risk premium. So that means that here K is equal to RF 8 plus RM 12 minus 8 into 5. Are you getting my point? Overall, what is the required return? Required return is equal to 28. Are you getting my point? For suppose beta of Amal is equal to 2, then K is equal to what? 8 plus 12 minus 8 into 2. Comparatively less risk, yes or no? So that's why what is the required rate of a return of equity shareholders in Amal Limited? 16%. So beta of Adarsh is equal to 0.5. Then K is equal to what? 8 plus 12 minus 8 into what? 0.5. 10%. That means equity shareholders of Adarsh Limited will require a return of 10% only, because the risk is less than the market. The risk is less than the market. Clear? Are you able to understand this cost of equity concept? KE, CAPM return. Next, cost of a retained earnings. Cost of a retained earnings is equal to what? KR is equal to KE. So students might think, sir, retained earnings means belong to equity shareholders. We are not procuring from outside. We are not going to paying anything on a retained earnings. So that's why it is free of a cost. In the beginning itself, I made it clear, cost does not mean actual outflow or a cost expense. Cost means what? Expectation, required rate of a return. Okay. So here cost of a retained earnings, it is an opportunity cost of a dividends foregone by the shareholders. Opportunity cost. There is an opportunity cost. Equity shareholders might have taken a dividend and they might have invested this dividend elsewhere, but they have interest or no. So that's why there is a cost for retained earnings. Cost of a retained earnings is equal to cost of equity KE in most of the cases. But if there is a personal tax rate, if there is a personal tax rate, KR is equal to KE into 1 minus TP. TP means what? Personal tax rate into 1 minus brokerage. Into what? 1 minus brokerage. Cost of a retained earnings KR is equal to KE into 1 minus TP into 1 minus brokerage. TP means what? Personal tax rate. B means what? Brokerage. Okay. Sir, why sir? For example, cost of equity K is equal to 20%. 20%. Okay. Personal tax rate is equal to 20%. Personal tax rate is equal to 20%. So why the cost of retained earnings is equal to KE into 1 minus TP? Let me explain. First, suppose cost of equity 20%, yes or no? Retained earnings, equity retained earnings also belongs to the equity shareholders. So that's why KR is equal to KE first. Okay. But this equity shareholders, for suppose if I pay the retained earnings to the equity shareholders, these equity shareholders take the amount and they might invest elsewhere. They might invest elsewhere and they might get 20%, no doubt in that. But even if they get 20% return, they have to pay 20% tax on the 20%. Ultimately, they are going to receive only what? 16%. Are you getting my point? So KR is equal to KE into 1 minus TP, personal tax. Why? Because the reason is, yes, the company is paying dividend to the equity shareholders. It is not retaining. What they will do, they will be investing elsewhere and they can earn the same 20%. Example. But even if they earn 20%, while taking back, they have to pay what? 20% tax. That means ultimately what they are going to receive 16%. That means their opportunity cost is only 16%. There might be a brokerage. That means what they have to pay? Brokerage as well. So that's why KR is equal to KE into 1 minus TP into what? 1 minus brokerage. Clear? Is it clear? So now comes the weighted average cost of a capital. Weighted average cost of a capital. Simple weighted average cost of a capital, KO is equal to W1 K1 plus W2 K2 plus W3 K3 and so on. So this is the formula. Overall cost of capital. Now we are talking about overall cost of a capital. Till now we discussed about the cost of each source of a finance. Cost of it at KD, KP, KE and KR. Cost of a retained earnings. But now we are talking about overall cost of a capital. Overall minimum rate of a return required to be earned by the company to meet the expectation of the investors. So generally, instead of taking the formula, we take what? Table. Source, amount, specific cost, proportion, source, source, amount, proportion, specific cost, Proportion into what? Specific cost. Okay. Tell me what is the source. Example source can be what? Equity share capital. Let us assume equity share capital is equal to 10 lakhs. Next source can be what? Reserves and surplus. 10 lakhs. Next what? Preference share capital. 10 lakhs. Next can be what? Debenture. 10% debt. That can be 20 lakhs. Next 15% term loan. 15% term loan. So let us assume 15% term loan, 50 lakhs. To get a round figure, I am taking 15. Overall, what is the amount? 1 crore is the amount. This is how we find out the overall cost of a capital. So proportions, if I take proportion 0.1, what is this proportion? Weight. 0.1 meaning is, for suppose you invested 1 rupee. So out of 1 rupee, 10 paisa is from equity share capital. 0.1 is from equity share capital. 0.1 is from retained earnings. 0.1 from preference share capital. 0.2 from 10% debt. 0.5 from 15% term loan. Let us assume specific cost is equal to 20%. Cost of retained earnings 16%. Generally, cost of retained earnings is equal to cost of equity. If a personal tax rate is not given in the question, and if brokerage is not given in the question, okay, 16%. Next, preference share capital 12%, debt 8%, and next what? 12%. Okay, so these numbers I have taken, but how these numbers are calculated generally? KE is calculated by applying what? Dividend growth model, earnings growth model, CAPM, or a realized yield approach. How the cost of a retained earnings KR is calculated? KE into 1 minus personal tax rate into 1 minus brokerage. How the KP might have been calculated? KP formula. Likewise KD. Clear? So proportion into specific cost. First case 2. First case what? 2. Second case 1.6, 1.2, 1.6 and 6. Total 12.4 is the answer. What is this 12.4? 12.4 is the overall cost of a capital. 12.4 is the overall cost of a capital. Am I clear? Okay. So this 12.4, till now we have learned how to find out this overall cost of a capital 12.4. Why it is relevant? To choose the cheapest source of a fund. Second, for capital bursting chapter, for investment decision chapter, this 12.4 is used as a cutoff rate. In working capital management chapter, we use this rate to determine the best credit policy. And other uses, to take a dividend decision, we need this 12.4. We need KE, cost of equity KE, actually KE not KO, to take a dividend decision. And next, to find out the value of a firm, we need this KO, overall cost of a capital. So what is this KO? Minimum rate of a return required to be earned by the company to meet the expectation of the investors. Let us understand this. So let us understand this simple one. Understand this concept. So 1 crore is our investment, yes or no? 1 crore. On 1 crore, we have to earn minimum of 12.4%. That means what? 12,40,000. So this is the minimum rate of a return required to be earned by the company. Clear? Minimum rate of a return required to be earned by the company. Done. 12,40,000 now. This is the minimum return amount, absolute amount, so that we can meet the expectation of what? Investors. For the investors, first one, equity share capital. What is the equity share capital amount? 10 lakhs into what? 20%. Equity share capital 20 lakhs, sorry 10 lakhs, and what is their expectation? 20% is their expectation. That means 2 lakhs is the amount required to meet their expectation. Retained earnings. Retained earnings 10 lakhs into what? 16%. So that means we need 1,60,000 to meet their expectation. Next, preference share capital. To meet their expectation, we need 10 lakhs into what? 12%. 1,20,000. Next, what? 10% debt. To meet their expectation, we need 20 lakhs into 8%. Again, 1,60,000. Next, to meet the 15% debt, we need 50 lakhs into what? 50 lakhs into 12%. 50 lakhs into 12%, that is equal to what? 6 lakhs. Overall 12,40,000. We need minimum 12,40,000 to meet the expectation. Yes, we are able to meet the expectation. Clear? It is a minimum rate of a return required to meet the expectation of the investors. Okay. So with this, we have completed the concept of a cost of a capital. We have to go through the questions, but before moving on to the question, the few important points are, sir, we can calculate the cost of a capital using the book value weights or a market value weights. Book value weights means a balance sheet values. Book values means balance sheet values. Generally, these values are given in the question. We need not calculate. We will be taking from the question. Book value weights, balance sheet weights, balance sheet. If a question is silent, generally we use book value weights. But if they specifically ask you to find out the weighted average cost of a capital using market value weights, we use market value weights. Sometimes they will ask you to find out the cost of a capital using both book value weights and market value weights. Sir, what is this market value? Market value is simple. First, suppose here equity share capital is what? 10 lakhs. How to find out the market value? So equity share capital 10 lakhs divided by face value. You will get number of equity shares into market price per share. That will be the market value. Okay. So generally in ICAI book CA into study material, so market values are considered as a more appropriate market value weights. Why? Because they are determined by the markets. Values are determined in the markets, but book value weights are generally dependent on the accounting policy. Book values, that is in our hands, yes or no. Depending upon the accounting policy, what happens? Book values will change. Yes or no? So preference share capital 10% debt, 15% term loan, and equity share capital will remain same. But depending upon our accounting policy, profits will change, and accordingly reserves and surplus will change. Clear? So market value weights, it is easy to find out the market value weights. And we have one more concept, weighted marginal cost of a capital. Weighted marginal cost of a capital is nothing but cost of additional capital. For suppose already we have a 50 crores fund. Additionally, we want to procure 10 crores. If we are going to find out the cost of only additional 10 crores, that is called as what? Cost of a additional capital, that is weighted marginal cost of a capital. Weighted marginal cost of a capital. Okay. Am I clear? But while calculating the weighted average cost of a capital using market value weights, you have to be careful, because in sources we have to take only equity share capital. We have to take only what? Equity share capital. Why we have to take only equity share capital? Because 10 lakhs divided by face value, 10 rupees for example, 10 lakhs divided by 10, 1 lakh shares, into market price per share 40. So we take 40 lakhs. equity share capital 40 lakhs. Again we cannot take reserves and surplus. Why we cannot take reserves and surplus? Because the reason is investor is paying 40 rupees, and if he is paying 40 rupees means he will get share in equity share capital as well as reserves and surplus. That 40 rupees includes both equity share capital and reserves and surplus. You will be taking only equity column, amount 40 lakhs. That too if a KE is equal to KR. K is equal to what? KR. But if KE, for example, in present example, KE is not equal to KR, in that case, we should apportion this market value using the book values. That means this 40 lakhs is apportioned between equity share capital and reserves and surplus using what? Book value 10 lakhs and 10 lakhs. That means 20 lakhs we take equity share capital, 20 lakhs we take reserves and surplus, because KR is not equal to KE. For suppose if KE is equal to KR, then we directly take what? Equity 40 lakhs. Are you getting my point? Okay. So after a small break, let us continue the practical questions. You will get more clarity on weighted average cost of a capital using book value weights, market value weights, and what? Weighted marginal cost of a capital as well. Okay. So whatever the concepts I have discussed, if you listen to 1-2 practical questions also, you will get clarity. Okay. So in next session, I'm going to discuss past 10 papers questions. I have arranged concept wise. Okay. If you understand those 10 questions conceptually, that is more than enough cost of a capital. But if you want, you can practice what IC AI study material questions. For that also I will be providing a question bank. I have arranged the question bank. Already prepared a question bank dividing the questions, study material questions, into main and additional. Okay. So after listening to the class, you can go through what study material questions. That means the PDF which is provided by BCCA, you can go through it. Okay. Clear? And please let me know the feedback in your comments, and from where you are watching this class, please let us know. Thank you all. Thank you so much. So let us see the questions. Question number 1. Book value of a capital structure of a B Limited is as follows. Sources 12% 6,000 debentures at rupees 100 each. Retained earnings 4,500, equity shares at the rate of rupees 100 each. Currently the market value of a debenture is rupees 110 per debenture and equity share is rupees 180 per share. The expected rate of a return to equity shareholder is 24% per annum. The company is paying a tax at the rate of 30%. So December 2021 question. Calculate weighted average cost of a capital on the basis of the market value weights. Calculate weighted average cost of a capital on the basis of a market value weights. Okay. So they are asking you to find out the weighted average cost of a capital based on a market value weights. Here December 2021 suggested answer. First I will explain the suggested answer and then I will discuss my answer. Okay. So first one, calculate weighted average cost of a capital based on a market value weights. So before finding out weighted average cost of a capital, first step is to find out what cost of each source. How many sources are there here? Debentures, and next what? Equity shares. Okay. So what is the rate of interest? Rate of interest is equal to 12%. Rate of interest is equal to what? 12%. Okay. So cost of a debenture KD is equal to 12 into 1 minus 0.3, that is equal to 8.4%. 8.4%. Actually here the answer should be 12 divided by 110 into 1 minus 0.3. That should be the answer. This is my answer. But whereas in suggested answer they have taken what? 12 into 1 minus 0.3 divided by 100. So that's why they got 8.4%. Next, weighted average cost of a capital. So weighted average cost of a capital based on a market value weight. So debentures, how many debentures are there? 6,000 debentures, and what is the market value? 110 per debenture. So 6,000 into 110, 6,60,000. And next, equity shares. How many equity shares are there? 4,500 equity shares, and each equity share 180 rupees per share. So 4,500 into 180, 8 lakh 10,000. Overall 14 lakh 70,000 is the market value. So let us find out the proportion. 6 lakh 60,000 divided by 14 lakh 70,000. The proportion is 0.45. And second case, 8 lakh 10,000 divided by 14 lakh 70,000, 0.55. Okay. So KD 8.4, KE is already given in the question. By doing weighted average, we are getting what? 16.98%. Okay. Clear? So, but here my answer is 12 into 1 minus 0.3 divided by 110. Because when market price is given, net proceeds is equal to what? Market price. We take 110. So cost of a debenture and cost of equity considered as given. So that is the assumption. Without considering market value. So they have written an assumption. The cost of a sources of capital can be computed based on a market price, and accordingly weighted average cost of a capital can be calculated as below. So that means what is the answer? 12 into 1 minus 0.3 divided by what? 110. Then what is the answer? 7.636. But first case answer cannot be 13.33 again, because they have clearly mentioned expected rate of a return to equity shareholder is 24% per annum. We should take 24. In second case, in second alternative, what? Cost of a debenture KD calculation is correct only. But cost of equity they should take what? 24%, because they have clearly mentioned what expected rate of a return on equity. But what they have done is they have taken what? 100 face value into 24% divided by what? 180. Okay. So this is a problem. That means to be 100% correct, we should take what? 7.636% KD, and KE we should take what? 24%. But unfortunately in suggested answer what? Okay. So in first part, in first alternative they have taken what? KD wrong. In second alternative what? They have taken KE wrong. Clear? So this is the answer. So we have to follow the suggested answer. This is the irony. Clear? So weighted average cost of capital. Next, illustration number 2. November 2022 5 marks question. The following is the extract of a balance sheet of Messrs KD Limited. Ordinary shares face value rupees 10 per share. Share premium, retained profits, 8% preference shares, 12% debentures. The ordinary shares are currently priced at 39 ex dividend. It is excluding dividend price 39. Preference share is priced at rupees 18 cum dividend. Preference share is priced at rupees 18 cum dividend. This is the special point in this question. So what is the preference dividend amount? Face value 25 into 8%. 25 into 8%, that is 2 rupees. That means what is the preference share ex dividend price? Preference share ex dividend price is equal to 18 minus 2 rupees, that is 16 rupees. So the applicable tax rate of a KD Limited is 30%. KD Limited's cost of equity has been estimated at 19%. Calculate the weighted average cost of a capital of a KD Limited on the basis of market value. On the basis of market value again. So weighted average cost of a capital based on a market value. First we should find out what specific cost. Specific cost, okay. So cost of a preference. Let us find out cost of a preference. Cum dividend price of a preference share is 18 rupees. Minus dividend 2 rupees. Market price of a preference share is 16 rupees. Okay. So cost of a preference KP is equal to preference dividend 2 rupees divided by 16. So the answer is 12.5%. Yes or no? Okay. KP is equal to PD divided by net proceeds or market price. So we are taking market price. Okay. So how many preference shares are there? 4 lakhs divided by what? 25. This we are finding out to find out the market value of a preference share for finding out weighted average cost of a capital. Next, Let us come to the debenture. Debentures are selling at 120% x interest. What is the debenture interest rate? 100 into 12%, that is 12 rupees. What is the tax rate? 30%. Maturity period is not given. Redeemability period is not given. Then what is the calculation? KD is equal to I into 1 minus tax rate divided by net proceeds. So when net proceeds are given, not given, we take market price. So that's why 12 into 1 minus 0.3 divided by 120. 7% is the answer. So how many debentures are there? 6 lakhs divided by 100 face value. So that means how many debentures are there? 6,000. Okay. Next step. Cost of equity. The ordinary shares are currently priced at 39. But here cost of equity is already given. What is the cost of equity? 19%. Cost of equity 19%. Cost of equity K is given 19%. We need not find out. So number of equity shares. How can we get number of equity shares? 5 lakhs divided by 10. 50,000. So almost everything is given in the question only. This is not a tough question, but the only special point in this question is cum dividend price. If it is cum dividend price, we should, cum means including dividend, including preference dividend, we should exclude the preference dividend, then we get pure preference share price. That is the only special point in this question. So equity shares. So how many equity shares are there? 5 lakhs divided by 10, that is 50,000. 50,000 into what is the market price per share? Market price per share is equal to 39. So 19 lakh 50,000. This 19 lakh 50,000 market value of equity includes value for what? Equity shares, share premium and retained profits. Because if we are purchasing one equity share for rupees 39, that means we get share in share capital, share premium and retained earnings. Everything belong to the equity shareholders. Next 8% preference shares. 16,000 shares into what? 16 rupees. Next debentures. 6,000 into what? 120. Okay, so the overall weighted average cost of a capital is 15.47%. So simple question. The only special point in this question is what? Cum dividend. The previous question is also simple, but the problem is the suggested answer is complicated, that's it. But you know how to find out, okay? Next illustration number 3. November 2023, 10 marks question. 10 marks question, okay? Z Limited wishes to raise additional fund of rupees 25 lakhs for meeting its investment plan. How much? 25 lakhs. It has rupees 5 lakh 25,000 in the form of a retained earnings available for investment purpose. 5 lakh 25,000 in the form of retained earnings available. So this is internal source. Further details are as following. Combination of a debt and equity 2:3. Cost of a debt up to 2,50,000 rupees, 8% before tax. Above rupees 2,50,000 and up to 5 lakhs, 10% before tax. Beyond 5 lakhs, 12% after tax. Earning of a company rupees 50 lakhs. Retention ratio 40%. Expected growth of a dividend 15%. Market price per share 500. Number of outstanding equity shares 1 lakh. Tax rate 30%. You are required to calculate cost of a debt, cost of a retained earnings, cost of a equity and weighted average cost of a capital. Okay. So it is also a simple question. You have to understand this easily. So first of all, what is the additional fund to be raised? 25 lakhs. So what is the combination of debt and equity? 2:3. That means debt is equal to 25 lakhs into 2 by 5. That is 2 by 5. That is 10 lakhs. Next equity is equal to what? 25 lakhs into 3 by 5. 15 lakhs. Okay. So first we should go for working note. So pattern of how we are going to raise the fund. So 15 lakhs is from equity. 15 lakhs is from equity. Yes or no? 15 lakhs equity, but already we have a 5,25,000 retained earnings. So that means the balance 15 lakhs minus 5,25,000, 9,75,000 will be the new equity capital. That 9,75,000 we are going to raise money by way of new equity. 5,25,000 retained earnings. And what is the debt amount? Debt amount 5 lakhs. But for this 5 lakhs, sorry, not 5 lakhs, 10 lakhs. For this 10 lakhs, up to 2,50,000, what is the rate of interest? 8% before tax. That means 8% debt is equal to 2,50,000. Above 2,50,000 and up to 5 lakhs, 10% before tax. 10% before tax. Okay. Above 2,50,000 and up to what? 5 lakhs is what? So 10% debt. 10% debt. So am I clear? So now the point is 10% debt 2,50,000 and next 12% debt beyond 5 lakhs. What is the rate of interest? 12%. So 12% debt is equal to beyond 5 lakhs. How much we are going to borrow? 5 lakhs. So that's why this is the pattern of raising the fund. Total 25 lakhs. Total 25 lakhs. How we are going to raise the fund? Out of 25 lakhs, 15 lakhs equity, 10 lakhs debt. And this 15 lakhs equity, already we have a 5,25,000 retained earnings, 9,75,000 equity capital. 8% debt up to 2,50,000. So about 2,50,000 but up to 5 lakhs, 10% debt and 12% debt above 5 lakhs, that is 5 lakhs rupees. Clear? This is the pattern of raising money. So this should be the working note. So what is the first part of the question? Cost of a debt. Cost of a debt. So there are 3 debts. Be careful, there are 3 debts. Okay. So generally, so how we find out the cost of a debt? We apply the formula I into 1 minus tax rate divided by net proceeds. They have not mentioned about issue price and market price. That means we assume it as a issued at face value 100 rupees, but they haven't mentioned it is a debenture or something. Okay. What we can do is, so we have a 8% debt, yes or no? 8% debt. How much? 2,50,000 into what? 8%. 2,50,000 into 8% plus 2,50,000 into what? 10%. This is one way of calculating cost of debt. Next one what? 5 lakhs into what? 12%. This is the overall interest we are going to pay. 2,50,000 into 8% plus 2,50,000 into 10% plus 5 lakhs into 12%. So I think 1,05,000. On this amount we are going to save tax by how much percent? 30%. Into 1 minus 0.3. So this is overall interest amount on what is the amount of debt? Overall amount of debt. Overall amount of a debt is equal to 10 lakhs. Overall amount of a debt is equal to 10 lakhs. So 2,50,000 into 8% plus 2,50,000 into 10% plus 5 lakhs into 12% into 1 minus 0.3 divided by 10 lakhs. So what is the answer? 9.15 percentage. You will get 9.15 percentage. Okay. So there is other way of calculating. So what is the other way of calculating? The pre-tax debt rate is given. What is the pre-tax debt rate? 8%. 8%. So 8 into 1 minus 0.3. You will get after tax debt. What is the after tax debt? 5.6 or 0.056. Next 10%. 10% means after tax it will be 7%. Likewise 12%. 12% means after tax it will be 12%. I think it is already given after tax. Wow, we have to be careful. I'm sorry. The calculation should be what? We have to be careful here. This fellow has given differently. So we have to be careful. I'm sorry, really sorry. 2,50,000 into 8% plus 2,50,000 into 10%. These are the before taxes, yes or no? So that's why into what? 1 minus 0.3. 2,50,000 into 8% plus 2,50,000 into 10% into 1 minus 0.3 plus 5 lakhs into 12%. Why directly 5 lakhs into 12%? Because that 12% is after tax. So here they are expecting you to commit a mistake at 12%. That 12% is our subconscious mind will be taking like 12% before tax, but 12% after tax. Clear? So 2 lakh 15 to 8% plus 2 lakh 15 to 10% into 1 minus 0.3 plus 5 lakhs into 12%. That means the tax savings is applicable only for first two. Clear? So this is one alternative to find out. So what is the second alternative? 5.6, 7 and 12. Okay, do a weighted average. 5.6 is the cost of a debt for how much amount? 2 lakh 50. 7% is cost of a debt for 2 lakh 50 and 12% is cost of a debt for 5 lakhs. Do a weighted average, then also you will get the same answer, that is 9.15%. Okay, next let us move on to the next one, cost of a retained earnings and cost of a equity. So how can we get cost of equity? So be careful, cost of equity, retention ratio is given, yes or no? Retention ratio is given. Expected growth of a dividend is given. What is the expected growth of a dividend? 15%. What is the retention ratio? 40%. Retention ratio of 40% means dividend payout ratio is equal to 60%. Earnings of a company is also given. What is the earnings of a company? 50 lakhs. Number of outstanding equity shares are also given. 1 lakh. So dividend is equal to. So how can we get dividend? Simple, 50 lakhs is the earnings, yes or no? 50 lakhs is the 50 lakhs or not? Earnings per share is equal to 50 lakhs divided by what? Number of equity shares? 1 lakh. So earnings per share is equal to 50. Earnings per share is equal to 50. Am I correct? Okay. Out of this 50, what is the payout ratio? 60% is the payout ratio. That means what is the dividend per share? 30 rupees is the dividend per share. Okay. So we are considering this 30 rupees as D naught. D naught, current dividend. But whereas key formula is equal to D1 divided by P naught plus G. D1 divided by P naught plus G. How can we get D naught? Sorry, D1. How can we get D1? D1 is equal to D naught into 1 plus G. That means 30 into what? 1 plus 0.15. 30 into 1 plus 0.15 will be the D1. Clear? So 30 into 1 plus 0.15 divided by 500 plus 0.15. 0.15 growth rate. Some students might take 15%. You write it as a 0.15. Okay, or else you can take 15. But this 0.069, convert this 0.069 into percentage and then add 15. Then only you will get 21.9. Students might take 0.069 plus 15. Wrong. Or students might take 6.9 plus 0.15. That is also wrong. Either you take numbers or either you take percentage. Clear? 21.9%. So is there any personal tax rate in the question? No. No brokerage. That means cost of a retained earnings is equal to what? Cost of a equity. Okay. So now let us come to what? Weighted average cost of a capital. So weighted average cost of a capital. Simple, weighted average cost of a capital. Equity 15 lakhs including retained earnings. What is the debt amount? 10 lakhs. Overall 25 lakhs. Weights 0.6 and 0.4. Cost of equity 21.9%, 9.15%. Okay, cost of a debt already we calculated 9.15, cost of equity 21.9. By doing weighted average we get 16.8%. Clear? Done? Is it clear? The question is simple. The only special point, the mistake where we might commit is 12% debt after tax is given but whereas at 8 and 10 are given before tax. Clear? Done. So they have given an alternative answer also, alternative solution for what? 4 2 and 4 3, which is actually a nonsense. Why actually it is a nonsense? Because if we assume expected growth rate of a dividend as a 5%, why do we assume it as a 5%? Because already it is given as 15% in the question. Then why we assume it as 5%? Okay, it is completely what? Nonsense. Okay, you can ignore this. Clear? See the next question. Illustration number 4. The capital structure of RSA Limited is as under: equity shares rupees 10 per share 1 crore, 8% irredeemable preference shares 5 crores, face value 100 rupees per share. Additional information: equity shares are quoted at rupees 60 each and a new issue price at 60 will be fully subscribed. Flotation cost will be rupees 4 per share. Issue price is 60 and flotation cost is 4 rupees per share. When the flotation cost is given, we should find out net proceeds. We should take net proceeds. Issue price of a 8% irredeemable preference share was rupees 45. Issue price 45. Current market price of a 8% irredeemable preference share is rupees 55. So what is this current market price and issue price? Issue price need not be equal to the current market price. For example, current market price of 1 acre land might be 2 crores, but we might sell it for rupees 1.5 crore. So that might happen. RSA Limited has been paying a dividend to its equity shareholders at a constant growth rate of 5% per year, and the dividend paid this year was rupees 2 per equity share. You are required to calculate the cost of equity using Gordon's model. Gordon's model means dividend growth model. That is d1 by p0 plus g. Cost of a irredeemable preference share. Cost of a irredeemable preference share. And the third part, they are asking you to find out the weighted average cost of a capital using what? Market value weights. So this question is simple. Market value weights. So first one, cost of equity. They are asking you to find out what? Cost of a equity. So this question is September 25 1A. First we should start with main answer. We can start with main answer. What is the main first part? They are asking you to find out cost of equity. So cost of equity K is equal to D1 by P0 plus G. So we take P0 if it is an existing issue, but here flotation cost is given. So that's why we take what? D1 divided by NP plus G. So what is D1? D1 is equal to 2 rupees. Dividend paid. Dividend paid is equal to 2 paid D0, not D1. 2 into 1 plus growth rate 0.05 divided by net proceeds. What is the net proceeds? Net proceeds is equal to, so 60 minus 4 rupees flotation cost. What is the flotation cost amount? 4 rupees. Plus what? Growth rate. What is the growth rate? 0.05. 0.05. So what is the answer? So what is the answer? 8.75. Clear? So this is the first part. This is simple. So we have already discussed when flotation cost is given, we should take what? Net proceeds. Next B part. Cost of irredeemable preference share. Cost of irredeemable preference share. What is the cost of irredeemable preference share formula? KP is equal to PD divided by NP. Preference dividend. So 100 into what is the what is the dividend rate? 8%. 100 into 8% divided by net proceeds. Even though the current market price is 55, we are going to issue at 45. So what is the answer? 17.78. Proper rounding off is very important. 17.78. Am I clear? So in suggested answer you can find an alternative answer. Alternative answer is taking 8 divided by 55. But the more appropriate answer is 8 divided by 45. Okay. Next C part. What is the C part? Weighted average cost of a capital. Source, amount, proportion, specific cost, proportion into specific cost. Source, how many sources are there here? Only two sources, equity and what? Preference. Equity, they are asking you to find out the weighted average cost of a capital using what? Market value weights. Market value weights. So tell me, what is the face value? Face value is equal to 10 rupees per share and 1 crore. So 1 crore divided by 10, you will get number of equity shares into what? Market price per share. What is the market price per share? 60. That means overall you will get 6 crores. What about second one? Preference share capital 5 crores divided by 100. You will get number of preference shares, that is 5 lakhs into what is the market price per preference share? Market price per preference share is equal to 55. Here we should take 55. Okay. While finding out WICC, we should take current market value, not the issue price. What is the amount? 2 crore 75 lakhs. Total 8 crore 75 lakhs. Yes or no? So tell me the proportion. Six crores divided by 8 crore 75. 0.686. Next 0.314. 0.314. So take, if possible, take 4 decimals. 0.68, 0.68. What is the number? 0.6857. Next 0.3143. Specific cost already calculated, 8.75. Next what? 17.78. So this question was not framed properly. Why? Because the reason is, generally the cost of equity shareholders will be greater than the cost of a preference shareholders. But here in this question, what cost of preference is 17.78, but cost of equity is 8.75. So practically this is not correct. Okay, because equity shareholder is taking more risk, his expectation will be high. Clear? So after calculating, let me know the final answer. What is the final answer? 11.59, 0.06, 0.0559. Answer is 11.59%. This is the overall cost of a capital. September 25. question. Okay, clear? So alternative answer is what? Kp is equal to what? Taking Kp is equal to 8 divided by 55. Done. Next, illustration number 5, September 25, 3B question, simple question. A company issues 20,000 18% debentures of rupees 100 each. The debentures are redeemable after a period of 8 years. Redeemability period 8 years. The cost of a debenture using approximation method is 14.58%. Approximation method is nothing but Kp is equal to Pd plus Rv minus Np divided by N all divided by Rv plus Np divided by 2. So cost of a debentures is given. Cost of a debentures is given. Not PD, sorry, I'm sorry. Cost of a debenture KD is equal, I'm sorry, I into 1 minus T plus Rv minus Np divided by N all divided by Rv plus Np divided by 2. So here cost of a debt is given. Generally we have to find out the cost of a debt. But in this question cost of a debt is given. The corporate tax rate is 30%. You are required to calculate the issue price of a debenture if redeemable at par. Okay, they are asking you to find out what issue price if it is redeemable at par. So let us start this question. September 25, 3B. So it is a debenture, not preference share. I have told preference share formula first. First part, they are asking you to find out what issue price. So first write down the formula. Cost of debt KD is equal to, we should write what? Redeemable formula, because redeemability period is given. I into 1 minus tax rate plus Rv minus Np divided by N whole divided by Rv plus Np divided by 2. So what is the interest rate? Interest rate is given, yes or no? So what is the answer? Cost of a debt 14.58. 14.58 means 0.1458 is equal to interest amount. What is the interest amount? 18 rupees into 1 minus tax rate. What is the tax rate? 1 minus 0.3 plus redemption value, redeemable at par. Redeemable at par means 100 minus net proceeds. We do not know about net proceeds. We have to find out. Divided by N 8 whole divided by 100 plus Np divided by 2. 100 plus Np divided by 2. Am I clear? So that means 0.1458 into 50 plus 50 plus what? 0.1, sorry, 0.50 NP. Am I correct? Tell me if I am wrong, okay? 0.1458 into 50, 100 divided by 250 plus 0.50 NP. Okay, is equal to what? 18 into 1 minus 0.3. What is 18 into 1 minus 0.3? 18 into 1 minus 0.3, 12.6 plus 100 divided by 8. What is 100 divided by 8? 12.5 minus 1 divided by 8. 1 divided by 8. 0.125 NP. Yes or no? So now 50 into 50 into 0.1425. 7.7 5 0.1458 into 50. 0.1458 into 50. 7.29 plus 0.1458 into 0.5. 0.0729 NP is equal to what? 12.6 plus 12.5. 25.1 minus what? 0.125 NP. Clear? Okay. So 0.0729 NP plus 0.125 NP is equal to 25.1 minus 7.29. 25.1 minus 7.29. So tell me what is the net proceeds? $25.1. So give me the calculator. 25.1 minus what? 7.29. On right hand side you will get what? 17.81. So 0.0729 plus 0.125. You will get 0.1979. What is the previous number? So 17.81 divided by 0.1979. What is the answer you are getting? 90 rupees. 90 rupees is the 90 rupees net proceeds. Nothing but issue price is equal to what? 90 rupees. First part. So simple question only, yes or no? Simple question, okay. Next, B part. What is the B part? B part, they are asking you to find out what? Revised cost of a debt. Revised cost of a debt. The only difference is what? The only difference is if redeemable at 10% premium after 8 years. 10% premium after 8 years. Simple. KD is equal to, what is the interest amount? 18 into 1 minus 0.3 plus redemption value. What is the redemption value? Redeemable at 10% premium. That means 110 minus net proceeds 90 divided by 8 whole divided by 110 plus 90 divided by 2. So tell me the final answer. Cost of a debt KD is equal to 1. So 15.1%. Cost of a debt KD is equal to 15.1%. Simple. We already discussed the factors affecting the cost of a debt. In that, one of the factor is redemption value. If the redemption value increases, you are paying a higher amount, yes or no? Then obviously cost of debt will increase. That is what happened in this question, okay? Clear? So we completed what September 25 question as well. So see the next question, illustration number 6, May 2023. In this question, the special point is growth rate. Growth rate. Capital structure of D Limited as on 31st March 2023 is given below. Equity share capital 30 lakhs, 8% preference share capital 10 lakhs, 12% debenture 10 lakhs. Current market price of equity share is rupees 80 per share. The company has paid a dividend of rupees 14.07 per share. Company has paid a dividend of rupees 14.07 per share. 7 years ago, it paid a dividend of rupees 10 per share. Expected dividend is rupees 16 per share. In this question, the special point is finding out the growth rate. 8% preference shares are redeemable at 6% premium after 5 years. Current market price per preference share is 104. 12% debentures are redeemable at 20% premium after 10 years. Flotation cost is rupees 5 per debenture. The company is in 40% tax bracket. In order to finance an expansion plan, the company intends to borrow 15% long-term loan of rupees 30 lakhs from bank. This financial decision is expected to increase dividend on equity share from rupees 16 per share to 18 per share. However, the market price of equity share is expected to decline from 80 to 72 per share because investors' required rate of return is based on current market conditions. Okay, so there is a logic for second part. The company intends to borrow 15% long-term loan of rupees 30 lakhs from bank. So if a company is taking a loan, that means what? Risk increases. If risk increases, expectation of equity shareholders also increase. So that's why instead of 16 rupees per debenture per share, they are expecting 18 rupees per share, and they are ready to pay only 72 rupees. Earlier the market price was 80 rupees, but now it will decrease to what? 72. Nothing but expectation of equity shareholders is increasing. Okay. And second part is compute the weighted average cost of a capital after expansion plan. After expansion plan, taking what? Book value weights. Taking book value weights. Am I clear? Done. So the question is simple. They are asking you to find out what? Weighted average cost of a capital. In this question, the special point is finding out the growth rate. Finding out what? Growth rate. So growth rate in dividend. So what was the dividend actually? Last year, present we paid a dividend of 14.07. Yes or no? So in time value for money, we discussed the formula. A is equal to P into 1 plus a power n. 7 years ago, what was the dividend amount? 10 rupees into 1 plus growth power what? 7. Am I correct? Are you getting my point? So 14.07 is equal to 10 into 1 plus g power 7. 7 years ago 10 rupees was the dividend. Now it has grown to 14.07. We can find out what? Growth rate. So 1 plus g power 7 is equal to 1.407. 1.407. So future value factor for 7th year at the rate of 5% is given. The table is given to find out the growth rate. The future value factor. So this 1.407 is nothing but what? Future value factor. Okay, this 1.407 lies at 5%. And for 7 years, that means growth rate is equal to what? Growth rate is equal to what? 5%. G is equal to 5%. Are you getting this point? Growth rate is equal to what? 5%. Okay? Clear? Next. For suppose future value factor is not given in the question. Sometimes they may not give in the question. Then how can we find out this growth rate? By using the IRR method. So let us assume 10 rupees. What is IRR? It is a discount rate at which sum of a discounted cash inflows are equal to outflows. Let us assume 10 rupees is the initial cash outflow. Yes or no? So this 10 rupees. So in future you are getting what? 14.07 into PV factor at the rate of G, growth rate at the rate of IRR. So PV factor, you will be getting what? PV factor 10 divided by 14.07, you will get 0.7107. Now first trial, PVF at the rate of 10%, PVF at the rate of 10% for 7th year is equal to PVF at the rate of 10% for 7th year is equal to what? PVF at the rate of 10% for the 7th year is equal to PVF at the rate of 10% for 7th year is equal to, okay, 0.5133. How can we calculate this? 1 divided by 1.1 press equal to 7 times. The desired factor is 0.7107, but at 10% we got 0.5133. That means what? We should decrease the rate. If we decrease the rate, factor will increase. So that's why second trial I am taking at 5%. PVF at the rate of 5% for 7th year. PVF at the rate of 5% for 7th year is equal to 1 divided by 1.05 press equal to 7 times. So 0.7107. That means our answer is what? So therefore growth rate is equal to what? Growth rate is equal to what? 5%. Am I clear? If a future value factor is not given, you can find out the growth rate using what? IRR method. Clear? So before finding out cost of a weighted average cost of a capital, first we should find out what cost of equity KE. KE is equal to D1 by P naught plus C. D1 is already given in the question, 16 rupees, divided by P naught is already given 80 rupees plus growth rate 0.05. So KE is equal to 25%. Am I clear? Next, cost of a preference share. Cost of a preference share. So how do we get cost of preference share? Redeemability period is given, right? So this information is relevant for finding out cost of a preference share. Okay, so KP is equal to PD plus RV minus NP divided by N, all divided by RV plus NP divided by 2. So how do we get PD? So preference share 8%, face value 100. So 100 into 8%, 8 rupees preference dividend, yes or no? Redeemable at 6% premium after 5 years. 6% premium after 5 years means 106 is the redemption value. 106 is the redemption value, yes or no? Next, what? Current market price of a share is what? 104. The net proceeds 104. Clear? So 8 rupees preference dividend plus redemption value 106 minus net proceeds 104 divided by 5 whole divided by 106 plus 104 divided by 2. So the answer is 8%. Am I clear? Is there any complication in this part? No, because information is given in the question. Next, 12% debentures are redeemable at 20% premium after 10 years. Face value 100. Redeemable at 20% premium means redemption value 120. 12% debenture means interest amount 12 rupees. Flotation cost is rupees 5 per debenture. Flotation cost is given 5 rupees per debenture. What about issue price not given in the question? That means we can assume issue price as what? Face value. What is the face value? 100. 100 face value minus flotation cost 5. That means net proceeds 95. Simple. So 12 into, are you able to understand interest amount 12 rupees into 1 minus 0.4 plus 120 minus 95 divided by 10 whole divided by 120 plus 95 divided by 2. So the answer is 9.02%. The only special point in this question is finding out the growth rate. That's it. Everything is common. All points are being covered here. So what is the equity share capital amount book value? They are asking you to find out using the book value 30 lakhs, 10 lakhs and 10 lakhs. Proportions are 0.6, 0.2 and 0.2. KE is already calculated 25, 8 and 9.02. So the answer is 18.4%. There is an alternative presentation that is not relevant. You can ignore. Clear? So B part. What is the B part? You are going for an expansion. What is the additional amount you are procuring? 30 lakhs from bank, 15% long-term loan. 15% long-term loan from bank, 30 lakhs. So what is the tax rate? 40% is the tax rate. you will be saving tax 40% on 15%. That means what is the cost of a new debt? Cost of a new debt is equal to 15 into 1 minus 0.4, 9%. Clear? You are taking additional debt of a 30 lakhs. So what is the rate of interest? 15%. What is the tax saving on that? 40%. So 15 into 1 minus 0.4, 9%. So likewise we can find out revised KE. KE is getting revised. Expectation of equity shareholders getting increased. They are expecting 18 rupees on 72. Earlier they expected what? 16 on 80. Now they are expecting 18 on 72. Plus what? Growth rate 0.05. The revised KE is 30%. So earlier they expected 25%. Now their expectation has got increased to 30. So equity share capital amount. What is the equity share capital amount? 30 lakhs. Preference share capital 10 lakhs. Debenture 10 lakhs. Long term debt 30 lakhs. Now the KE has got increased to 30. KP will remain same 8%. Cost of a debenture will also remain same 9.02. But additional source. What is the source adding? One more source, long term debt. And what is the cost of long term source? Long term debt 9%. So the overall answer is 16.76%. So alternative presentation is not required. So the only special point in this question is what? Only special point, finding out the growth rate of a equity. Clear? Go through the solution, pause the video. So next question, illustration number 7. MR Limited is having the following capital structure, which is to be considered as a optimum, which is considered to be optimum. Optimum means best. So they are considering the present capital structure as a best. That means in future also they will follow the same capital structure. As on 31st March 2022, equity share capital 50,000 shares, 8 lakhs, 12% preference share capital 50,000 rupees, 15% debentures 1,50,000. The earnings per share of the company were rupees 2.5 in 2021. 2.5 in 2021 were. The expected growth in equity dividend is 10% per year. The next year's dividend per share is 50% of EPS of the year 2021. The current market price per share is rupees 25. The 15% new debenture can be issued by the company. The company's debenture are currently selling at rupees 96 per debenture. The new 12% preference share can be sold at a net price of rupees 91.5, face value rupees 100 each. The applicable tax rate is 30%. You are required to calculate after tax cost of a new debt, new preference share capital, and equity shares, assuming that new equity shares come from a retained earnings. Marginal cost of a capital, how much can be spent, and also how much can be spent for capital investment before sale of a new equity shares, assuming that retained earnings for the next year investment is 50% of 2021 earnings. Retained earnings for next year investment is 50% of a 2021. Okay. So what is the question? They are asking you to find out the after tax cost of a new debt. After tax cost of a new debt. The 15% new debentures can be issued by the company. The company's debentures are currently selling at rupees 96 per debenture. 96 per debenture. Okay. So redeemability period given in the question or not? Answer is no. So then what is the calculation? 15 into 1 minus tax rate, that is 0.3 divided by what? 96 rupees. So the answer is 10.94%. 10.94% after tax cost of a new debt. Next, after tax cost of a new preference share capital. After tax cost of a new preference share capital. Okay. So after tax cost of a new preference share capital, the new 12% preference share capitals can be sold at a net price of rupees 91.6. That means 12 divided by what? 91.5. So 12 divided by 91.5. So the answer is 13 percentage. Clear? Next, equity shares, assuming that new equity shares come from retained earnings. Equity shares, they are asking you to find out the cost of a equity shares. Cost of a equity shares. Okay. So first of all, what was the earnings per share? Earnings per share was 2.5 in 2021. So 50%, the next year's dividend per share is 50% of EPS of the year 2021, next year dividend. So next year dividend is equal to 50% of 2.5, that means 1.25 divided by what is the market price per share? 25 is the market price per share, plus what is the growth rate? Growth rate is equal to 10% per year. So that means what is the calculation? 1.25 divided by 25 plus 10%. So the answer is 15% is the answer. Okay, so this part is simple only. Next part, they are asking you to find out the marginal cost of a capital, not the existing cost of a capital. They are asking you to find out the marginal cost of a capital. So even for marginal cost of a capital, the weights will remain same. Why the weights will remain same? Here the important point in this question is the capital structure is considered to be optimum, best. Okay. So after tax cost of a equity shares, marginal cost of a capital. So type of a capital, proportions, specific cost and product. So what are the sources? Equity share capital, preference shares and debentures. Okay, clear? So the point here important is which is considered to be optimum. The capital structure considered to be optimum. That means weights will remain same. What are the existing weights? Existing weights is equal to 8 lakhs divided by 10 lakhs. So that is equal to what? 0.8. 50,000 divided by 1 lakh 50,000. That means 0.05 preference shares weight. What about the debentures weight? Debentures weight is equal to 1 lakh 50,000 divided by 10 lakhs. So weight is equal to 0.15. Clear? So already cost of equity is calculated 15%. Cost of preference, cost of a debt. So the overall cost of a capital is equal to 14.3%. Okay, clear? So in this question, the special point is the capital structure considered to be optimum. That means what? For additional cost of a capital also, the weights will be same for marginal cost of a capital. And C point is also important here. C point is also important here. What is the C point? How much can be spent for capital investment before sale of a new equity shares, assuming that retained earnings for next year investment is 50% of 2021. So first of all, understanding the question is very important. How much can be spent for capital investment before sale of a new equity shares, assuming that retained earnings for next year investment is 50% of a 2021. So tell me, so what is the earnings per share of a 2021? 2.5. How many shares are there? 50,000. So 50,000 into 2.5 is the earnings for 2021. In this we are paying 50% as a dividend. That means 50% will be what? Retained earnings. So 25 into 50,000 into 50%. So the retained earnings amount is equal to 62,500. Okay. Sir, what is this 62,500? 62,500 is the retained earnings available for reinvestment. So first, when are we going to issue a new equity? First we use this retained earnings. If these retained earnings are over, then we go for what? New issue of a equity shares, yes or no? So see the question again. How much can be spent for capital investment before sale of a new equity shares? Before sale of a new equity shares, before without selling new equity shares, how much amount can we spend on a capital investment? Simple question. What is the capital structure? 0.8, 0.05 and 0.15. What is the meaning of this? Equity weight is 0.8. That means if you are investing 1 rupee, the weight of equity is 0.8. Yes or no? Now, here my point is simple. So, if you have a 0.8, you can make an investment of a 1 rupee by adding 0.05 preference and 0.15 debt. Yes or no? Here I have a 62,500 rupees retained earnings, which is equal to what? 0.8. Which is equal to 0.8. Okay, 62,500 divided by 0.8. So the answer is 78,125. This is the amount we can spend on a capital investment before sale of a new equity shares. So this is simple. 78,125 into 78,125 into 0.8, you will get what? 62,500. This will be equity, yes or no? 78,125 into 0.05. This will be what? Preference share capital. So what is the amount? Preference share capital 3906. So what about debt? 78,125 into 0.15. This will be the debt. So 11,719. Clear? This is how the investment will be made. So this is the special part in this question. How much can be spent for capital investment before sale of a new equity shares? As we can spend 78,000 what? 125 rupees before sale of a new equity shares. Am I clear? Are you able to understand this? Next, let us move on to the next question. Illustration number 8. The capital structure of a Shine Limited as on 31st March 2024 is as under. Equity share capital 45 lakhs, 15% preference share capital 36 lakhs, retained earnings 32 lakhs, 13% convertible debenture of 100 rupees each 67 lakhs, 11% term loan 20 lakhs, total 2 crores. Additional information. Company issued 13% convertible debenture of rupees 100 each. Company issued 13% convertible debenture of rupees 100 each on 1/4/2023 with a maturity period of what? 6 years. At maturity, the debenture holder will have an option to convert the debenture into equity shares of the company in the ratio of 1:4. That means 4 shares of each debenture. That means one debenture can be converted into 4 equity shares. The market price of the equity share is rupees 25 each as on 31st March 2024. The growth rate of the share is 6% per annum. As on 31st March 2024, what is the price? 25 rupees. As of now, 25 rupees is the market price of a equity share. Okay. But what is the redeemability period? What is the maturity period? Maturity is equal to 6 years. That means in next 6 years, the share price is going to increase at the rate of 6% per annum. Are you getting my point? So you know the conversion option. So investor will be opting an option which is beneficial to him. Clear? So what is the face value? 100 rupees. That means redemption value is not given. That means what? At the end of 6 years, if he is not converting the debenture into equity shares, he will be receiving what? 100 rupees. Okay. But if he convert the debenture into equity shares, then he will be getting 4 into 25 into 1 plus growth rate power 6. Because equity share price is going to increase 6% every year. So this is the special point. Preferred stock redeemable after 80 years is currently selling at rupees 150 per share. The prevailing default risk-free interest rate on 10-year Government of India Treasury bond is 6%. The average market risk premium is 8%. The beta of the company is 1.54. Corporate tax rate is 25%. The rate of a personal income tax rate is 20%. You are required to calculate the cost of first one, equity share capital. They are asking you to find out the cost of a equity share capital. How can we find out the cost of equity share capital? 10-year Government of India Treasury bond is 6%. Okay, so that is risk free rate 6%. Market risk premium 8%. That means RM minus RF. Beta is given. What is beta here? 1.54. So that means what is the answer? 6 plus 1.4 into 8%, that is 18.32%. First part is simple, cost of equity. What is the second one? Preference share capital. Preference share capital redeemable after 80 years is currently selling at rupees 150 per share. Redemption value is not given. Then what? It is assumed to be redeemable at par value. What is the par value? 100. So what is the dividend rate? 15%. That means the answer is 15 plus, yes or no? Redemption value 100 minus net proceeds. Currently the preference share is selling at rupees what? 150. So 100 minus 150 divided by what? 8. All divided by. So here the calculation is little clumsy. Be careful. KP is equal to what? KP is equal to 15 plus 100 minus 150 divided by 8 whole divided by 100 plus 150 divided by 2. So the answer is 7%. So answer is what? 7%. This is the cost of a preference share capital. Am I clear? Okay. So alternative solution is given, but I feel it is illogical because it has been taken as reverse. Redemption value they are taken what? 150. But the sentence is what? Preferred stock redeemable after 8 years is currently selling at rupees 150 per share. Currently selling at. That should be considered as what? Net proceeds. Clear up? Next, convertible debenture. Convertible debenture is also same. Simple. Convertible debenture. First thing. So what is the cash redemption value? Cash redemption value is equal to 1 debenture can be redeemable at 100 rupees. At what? 100 rupees. Are you getting my point? Cash redemption value is equal to what? 100 rupees. For suppose, what is the value of a share after 5 years? Value of a share after 5 years is equal to, because it is redeemable after what? So on 1/4/2023, on 1/4/2023 having a maturity period of 6 years. But as of now, what is the date? 31st March 2024. 1/4/2023. From 1/4/2023, what is the maturity period? 6 years. But now the date is what? 31st March 2024. That means what is the remaining maturity period? 5 years. Remaining maturity period is 5 years. And what is the equity share price as on 31st March 2024? 25 rupees. So that means what is the calculation? 25 into 1.06 power 5. 1.06 power 5. So earlier I have told 6 but not correct, because the reason is, right, as of now, okay, from 1/4/2023 the maturity period is 6 years, but from 31st March 2024 what is the remaining maturity period? Only 5 years. So that's why 25 into 1.06 power 5. You know the calculation. First we take calculator. First we take in calculator 0.06 plus 1 into 25 press equal to 5 times 33.46. That means redemption value will be, if investor choose share redemption, what is the redemption value? 33.46 into 4, 133.82. 133.82. So now tell me, which option investor is going to choose. If he take the cash, he will get 100 rupees. If he convert the debt into equity shares, he will be getting 133.82. So redemption value 133.82, net proceeds 100, n is equal to 5, interest I is equal to what? 13, tax rate T is equal to 25%. Clear? Okay. If issue price is not given, then we assume it as issued at par value. Clear? Are you able to understand this question? So what is the calculation? 13 plus, so 13 into 1 minus tax rate. So what is the tax rate? 25% is the corporate tax rate. Okay. So 13 into 1 minus 0.25 plus 133.82 minus 100 divided by 5, whole divided by. So the answer is 14.13. Clear? Next, cost of a retained earnings. How do we get cost of a retained earnings? Cost of a retained earnings is equal to KE into 1 minus TP, personal tax rate. Yes or no? So what is the KE? KE is equal to 18.32. KE is equal to 18.32 into 1 minus personal tax rate 0.2. So the answer is 14.66%. Okay. So alternative is also given. The cost of equity can be taken as the same. Okay. But the right answer is 14.66%. Okay. Done. Next, cost of a term loan. What is the last part? Cost of a term loan. So how do we get cost of a term loan? What is the rate of interest? 11%. So 11 into 1 minus 0.25. We can save tax at the rate of 25%. 11 into 1 minus 0.25. So the answer is 8.25%. Okay, clear? So what is the special point in this question? The special point in this question is convertible debenture. Convertible debenture. So either investor can take cash or else what, he can convert the debt into equity shares. So equity share market price is growing at the rate of what? 5% or 6%? 6%. Growing at the rate of what? 6% per annum. What is the remaining maturity? Remaining maturity is 5 years, not 6 years. Okay. Am I clear? Done. Next, illustration number 9. The following information pertain to CMC Limited. Number of equity shares 20 lakhs. Book value of a 10% convertible debenture 1 crore. Book value of 12% bank term loan 25 lakhs. Market price of equity share 55. Market value of a 10% convertible debenture 108. Face value of a equity share 10. Face value of a 10% convertible debenture 100 rupees. Beta coefficient of a equity share of a CMC Limited 1.5. Risk free rate of a return 4.5. Equity risk premium 9%. Rate of a taxation 30%. The company expects the share price will rise at 6% per annum. Share price will rise at 6% per annum. The 10% convertible debentures will be converted in 6 years into equity in a ratio of 1:4. Market value of a 12% bank term loan is at par. You are required to calculate first one, cost of a equity share capital by CAPM. So simple, how to calculate RF plus RM minus RF into beta. So what is RF? 4.5 plus RM minus RF 9 into beta 1.5. Even though they have mentioned equity risk premium, that is considered as what? Market risk premium. Market risk premium. Okay. Second one, cost of a convertible debenture by approximation method. Cost of a convertible debenture by approximation method. So clear up. Now, so equity share. So one debenture can be converted into how many equity shares? 4 equity shares. Okay. So the company expects the share price will rise at 6% per annum. 6% per annum. Clear? What is the market price of equity share? Market price of equity share is equal to 55. 55. Okay. So now this 55. So and the convertible debentures will be converted in how many years? 6 years. So that means 55 into 1 plus 0.06 power 6. 78.018. So 78.018 into 4 overall 312.07. That means if debenture is converted into equity shares, he is going to get 312.07 on the maturity. So then obviously he will be choosing what? Equity option. Clear? Net proceeds, we take what? Current market value of a debenture. What is the current market value of a debenture? 108. So what is the rate of interest? 10%. So 10 rupees into 1 minus 0.3 plus 312.07 minus 108 divided by 6 all divided by 312.07 plus 108 divided by 2. So the answer is 19.52%. Am I clear? Done. So 19.52% is the answer. Next, cost of a bank term loan. 12% bank term loan is at par. So simple, 12 into tax rate. What is the tax rate? 0.3. 12 into 1 minus 0.3, that is 8.4% is the answer. So the last part of the question is they are asking you to find out the weighted average cost of a capital using what? Market value weights. So how many? We have a 3 number of. So we have a equity, 10% convertible debt and 12% bank term loan. How many equity shares are there? 20 lakhs. So 20 lakhs into what is the market price per share? 55. Clear? 20 lakhs into 55. 11 crores. Next what? Convertible debt. So we are taking the current market value. What is the current market value? 108 rupees. What is the face value? 100. That means 1 crore divided by 100 into 108. 1 crore divided by face value 100, then you will get number of debentures into what? 108. So that means 1 crore 8 lakhs. Next, 12% bank loan. 12% bank term loan. What is the 12% bank term loan? 25 lakhs. Overall, 12 crore 33 lakhs. So weights, and next what? Weighted average. So the answer is what? 18.03. Why it is given as 17.94? So 18.03. Okay, 17.94 is the correct answer, not 18.03. 17.94 will be the answer. So again in this question, what is the special point? Convertible debt. Okay, finding out the expected share price at the end of the maturity. Clear? Next, illustration number 10. Capital structure of a T Limited as on 1st April 2024 is as under. Equity share capital 50 lakhs, 10% debentures 40 lakhs, 12% preference share capital 10,000 shares of rupees 100 each, 10 lakhs. Only 3 sources are there. Additional information, the risk-free rate of a return is 10%, beta 1.75, the return on a market portfolio is 12%, that means RM is given. The equity share has a market price of rupees 70 per share. The debentures are trading at a market price of rupees 80 per debenture. The debentures are to be redeemable after 5 years at par. Preference shares are redeemable after 5 years at a premium of 5%, presently selling at 104 per share. So redeemable at a premium of 5%, that means 105. Presently selling at what? 104, that means net proceeds 104. The company pays a tax rate of 30%. The cost of a debentures are to be calculated on yield to maturity approach. This is the special point. Yield to maturity. Okay, not the approximation method, it is an yield to maturity. Cost of a debentures are to be calculated on a yield to maturity approach So this is the special point in this question. Okay. Next, the present value factors at 10% and 14% are, the factors are given. You are required to calculate weighted average cost of a capital after tax of a T limited using what? Market value weights. Using market value weights. Okay. So first we have to find out cost of equity K. That is simple. K is equal to RF plus what? RM minus RF into beta. That means 10 plus 2 into 1.75. You will get 13.5%. 13.5 percentage. Okay. So let me solve this question and you have to give the information. So first, what is the first one? Cost of equity. Question number 10. Huh? So question number 10. Working note 1, cost of equity. Working note 1, cost of equity. So cost of equity K is equal to RF plus RM minus RF into beta. What is RF? RF is equal to 10 plus RM 12 minus 10 into beta 1.75. So the answer is 13.5%. Next, working note 2, cost of a debt. Which method? Yield to maturity method. Yield to maturity method. So what is the current market price of a debenture? Current market price of a debenture is 80 rupees. Current market price of a debenture is 80 rupees. Okay. That means initial inflow is equal to rupees 80. So cost of a debt is nothing but the rate, the discount rate at which sum of a discounted cash outflows are equal to initial inflow. Okay. So first, trial 1 at the rate of 10%. Trial 1 at the rate of what? 10%. Okay. In that, take columns year, cash flow, PVAF slash PVF at the rate of 10% and discounted cash flow. Understand this. This is the advanced question, yield to maturity. Initial inflow is equal to rupees 80. So suppose if I issue debenture as of now, I will be receiving 80 rupees. I will receive 80, but for the next 1 to how many years? The debentures are trading at, it is redeemable after 5 years. That means after, for the next 5 years I have to pay interest. Okay. What is the interest amount? 10 rupees, but I can save tax at the rate of 30%. I can save tax at the rate of what? 30%. That means what is the amount? 7 rupees. 1 to 5 years, cash flow 10 into 1 minus 0.3, that is equal to 7. At the end of 5th year, it is redeemable at par. Are you getting my point? Initially we receive 80, fine. But the next 1 to 5 years, what is our outflow? 10 into 1 minus 0.3, that is 7 rupees, and at the end of 5th year, 100 rupees. So tell me the factor for 5 years. 3.79. 3.79. Are you getting my point? 3.79 and 0. This one is 0.621. 62.1. 7 into 3.79. 7 into 3.79. 26.53. Total. For suppose if I get 80 rupees, then straight away my cost of debt is what? 10% using yield to maturity method. But what is the amount? $88.63. 26.53 plus 62.1. 88.63. But if I discount, I should get what? If I discount the future outflow, I should get what? 80. IRR method, yield to maturity, is nothing but what? IRR method. It is the discount rate at which discounted cash outflows are equal to initial cash inflow. So that's why what? PV. Now I have to increase the rate or decrease. At 10% I got 88.63, but I should get 80. So that's why let us increase the rate. 15%. I am taking 15. But in examination, in question, they have given 14. That means cost of debt may lie between 10 and 14. But I am taking 15. Okay. So tell me the factors. $0.8687. What is that? I need PVA for 5 years and present value factor for 5th year. 1 divided by 1.15 press equal to 5 times. 1 divided by 1.15 press equal to 5 times. 0. 0. What? 497. Okay. So grand total. Then you will get PVAF. 3.352. So now 7 into 3.352. 7 into 3.352. 23.47. Next 100 into 0.497. 49.7. Total 49.7 plus 23.47. 73.17. So actually we need 80 rupees. That 80 rupees lies between what? 88.63 and 73.17. That means cost of a debt is equal to, this concept I have already discussed in time value for money. Cost of a debt is equal to, so 10% plus, at 10% what is the amount? 88.63 minus, what is the desired amount? 80. So desired change divided by change available, 88.63 minus 73.17 into 5. So 10% plus 88.63 minus 80 divided by 88.63 minus 73.17 into 5. So the answer is, So what is the answer? %79 is the answer. 12.79. Okay. If you want accurate answer, you should take 10 and 14. If you take 10 and 14, you will get more accurate answer. Okay, here in suggested answer 10 and 14 are taken, so that's why they are getting 12.72. Okay, clear? What about preference shares? So they haven't mentioned any specification with respect to what preference share. Then what? We use approximation method. Approximation method, preference dividend is equal to what? 12 rupees. Preference dividend is equal to 12 rupees plus redemption value 105, 12 plus 105 minus present is selling at 104. Okay, so 12 plus 105 minus 104 divided by redeemable after how many years? 5 years. So divided by 5, whole divided by 105 plus 104 divided by 2. So the answer is 11.67. 11.67%. Okay. So the only special point in this question is finding out the cost of a debt using yield to maturity method. If you know IRR concept, this will be easy. Next, calculation of a weighted average cost of a capital using market value weights. Using market value weights. They have specifically mentioned to use market value weights. How many equity shares are there? 50 lakhs divided by 10 into 70. Okay, 50 lakhs divided by 10 into what? 70. So 3 crore 50 lakhs is the market value. Next, 10% debentures. 40 lakhs divided by 100. So that is 40,000 into 80. 32 lakhs. Next, preference share. 10 lakhs divided, 10,000 shares. 10,000 shares into what? 104. 10 lakh 40,000. So overall, total market value 3 crore 92 lakh 40,000. We find out the weights. Already specific cost is there. We can find out what? Weighted average cost of a capital. So 13.39% is the answer. Am I clear? Done. Okay. Next, illustration number 11. The capital structure of a B Limited for the year ended 31st March 2025 are as follows. Equity share capital 14 lakhs, 10% preference share capital, debentures, bank loan. Risk-free rate of a return is 14%, market rate of a return is 19%, beta of a company is 1.2. 10% preference shares are redeemable at 106.4 after 3 years. So redeemability period 3 years, and it is redeemable at what? 1065.4. Interest on a bank loan is, here the special point is interest on a bank loan is 1.3 times of interest of debentures. Interest on a bank loan is 1.3 times of interest on a debentures. So debentures are redeemable at par after 5 years. Flotation cost is 4 rupees per debenture. Tax rate is 30%. Cost of a capital is 14%. Cost of a capital is already given in the question. Generally, we used to find out what cost of a capital, but in this question, cost of a capital is given. You are required to calculate the following. First one, cost of equity. How can we find out the cost of equity? Simple. Already RF is given 14 plus RM 19 minus RF into what? Beta. Clear? So 14 plus 19 minus 14 into 1.2. So the answer is 20%. Answer is what? 20%. Am I clear? Done. Next. So cost of a preference share using Yield to maturity method. Cost of a preference share using yield to maturity method. Now I am not writing yield to maturity method. Simple. 10% preference shares capital at the rate of 1000 each, 10 lakhs. So what is the face value? 1000. Okay. If a question is silent, we assume the net proceeds as 1000. I mean face value. Face value. So 10% preference shares, they are redeemable at rupees 1065.4. 1065.4. Are you getting my point? So that means as on today, so what is the inflow? 1000 rupees is the inflow. So what is the rate of a preference share? 10%. That means for the next 3 years we are going to pay 100 rupees preference dividend, and at the end of the third year we are going to pay 1065.4. If I discount these numbers, I should get what? 1000. So better write the answer in our method. So question number 11, B part. What is this B part? Cost of preference using yield to maturity method. Cost of preference using what? Yield to maturity method. Okay. Simple. What is the initial inflow? Current market price is not given. Okay. So that's why net proceeds assumed to be face value. That means what? 1000 rupees initial inflow. So if I discount the future cash outflow, that should be equal to what? 1000. That should be equal to what? 1000. Yes or no? So let's take a trial at the rate of, what is the preference share rate? 10%. Let's take a trial at the rate of 10%. Columns, year, cash flow, PVAF slash PVF at the rate of 10%, discounted cash flow. Okay, clear? Here also 10 and 14 are given. So that's why better we take trial at the rate of 10 and then not 14. 1, 2, 3. So what is the outflow? 100 rupees preference dividend. At the end of third year, 1065.4. Clear? So tell me, what is the 3 years annuity factor? 1 divided by 1.1 press equal to 3 times. 2.4. Okay, 0. Tell me the PV factor for the third year. 0.751. PVAF, you have to take the grand total. 2.487. So that means this is 248.7. 248.7. Next what? 1065.4 into 0.751. 800.11 total 1048.81. 1048.81. If I discount the future cash outflow, I should get 1000, but here I am getting what? 1048.81. So that means I should increase the rate. Yes or no? So that's why PVAF slash PVF at the rate of 14%. Discounted cash flow at the rate of 14%. Tell me the factors. PVAF 1 divided by 1.14 press equal to 3 times. Tell me the first factor. Tell first present value factor. 0.751. 1 divided by 1.14 plus equal to 3 times 0.675 plus grand total 2.322. Okay, so now 100 into 2.322, 232.2. Next 1065.4 into 0.675. 719 total 719 plus 232.2, 719 plus 232.2, so that is 951. So this 951.34 is the sum of a discounted cash outflow at the rate of 14%. So our sum of a discounted cash outflow must be equal to what? 1000, which lies between 10 and 14. So IRR, that is nothing but cost of a debt is equal to 10% plus 1048.41 minus 1000 divided by 1048.41 minus 951.34 into what? 4. So the answer is what is the answer? Final answer 12%. So what is the cost of a debt? 12% is the answer. Am I clear? Done. Okay. So now, so what else they are asking? Post tax cost of a debenture using approximation method. Post tax cost of a debenture using what? Approximation method. So here interest on a debenture is not given. Interest on a bank loan is 1.3 times of interest on a debenture. Okay. Debentures are redeemable at par after 5 years. Flotation cost is rupees 4 per debenture. Okay. So they are asking post tax cost of debenture. Simple. Here the cost of a capital is already given. What is the cost of a capital? 14%. We do not know what is the interest amount. Let the rate of interest on debentures be X. The rate of a debenture on X. The rate of interest on debentures be what? X. Okay. So then rate of interest on a bank loan will be, the rate of interest on a bank loan will be 1.3x. 1.3x. Yes or no? Are you getting my point? So cost of a debt KD is equal to I into 1 minus tax rate plus RV minus NP divided by N, all divided by RV plus NP divided by 2. We know the face value. What is the face value? 100 into what is the rate of interest? We assumed the rate of interest to be X. Okay, so that's why 100x into 1 minus 0.3 plus redemption value 100 minus net proceeds 96 divided by 5, all divided by 100 plus 96 divided by 2. Clear? You will be getting what? 70x plus 0.8 divided by 98. Clear? What about the cost of a term loan? Cost of a term loan will be 1.3x into what? 0.7, because tax saving 30%. So 1.3x into 0.7 is equal to what? 0.91x. Are you getting my point? because rate of interest on a bank loan is 1.3 times of a debenture. So that's why 1.3x into 0.7, only 0.7. Why only 0.7? Because we can save 30% tax. So now we take equity share capital. We know the equity share capital amount 14 lakhs. Find out what weights. Every time we first calculate specific cost and then what cost of a capital. But in this question, cost of a capital is given, but we have to find out what rate of a interest. Clear? So cost of equity we already know. Cost of preference is already known. But cost of a debenture is what? 70x plus 0.8 into 98. So 0.8 divided by 98. 70x plus 0.8 divided by 98. Clear? Okay. And what is the second one? 0.91x. 0.91x. Now tell me what is the equation? 0.14 is equal to 0.07. How we got 0.07? 0.35 into 0.2. 0.07 plus 0.25 into 0.12. 0.03 plus 16.8x plus 0.192 divided by 98. So this part is the complicated part, plus 0.16x into 0.16 into 0.91x. Are getting my point? 0.16 into, not x, 0.16 into 0.91x. After solving this, we are getting x 12%. X 12%. That means rate of interest on a debenture is 12%. And what about the bank loan? Bank loan will be 12 into 1.3. 12 into 1.3. So that means you will get 15.6. So interest on a bank loan will be 15.6. That is the fourth part they are asking. So what about the second part? Post-tax cost of a debenture using what? Approximation method. Now we know the rate of interest. What is the rate of interest? 12 into 1 minus tax rate 0.3 plus 100 minus 96 divided by 5 all divided by 100 plus 96 divided by 2. Here the number is missing. Be careful. 12 into 1 minus 0.3 plus 100 minus 96 divided by 5 whole divided by what? 100 plus 96 divided by 2. So the answer is 9.39%. So this part is a complicated one. So cost of a capital is given. So what is the assumption we have to take? We should assume that rate of interest on debenture is equal to x. Then obviously what happens? The rate of interest on a bank loan will be 1.3x. Clear? So almost we have covered each and every concept. Each and every almost advanced concept we are covering. A company issues, illustration number 12, May 2022, 10 marks question. A company issues 15% convertible debenture of rupees 100 each at a par with a maturity period of 6 years. On maturity, each debenture will be converted into 2 equity shares of the company. 2 equity shares of the company. The risk-free rate of a return is 10%. Market risk premium is 18%. The beta of the company is 1.25. The company has paid a dividend of rupees 12.76 per share. Paid. 5 years ago, it paid a dividend of 10 per share. 5 years ago, it paid a dividend of rupees 10 per share. So this information is given for you to find out the growth rate. So 5 years ago 10, now it is 12.76. We can find out the growth rate. Flotation cost is 5% of issue amount. 5% preference shares of rupees 100 each at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of issue amount. Assuming corporate tax rate is 40%. Assuming corporate tax rate is 40%, calculate the Cost of convertible debenture using the approximation method. Approximation method, first one. Second, use YTM method to calculate cost of a preference share. Cost of a preference share. Okay. So first 10 rupees has become what? 12.76. Okay, we can find out in two ways. A is equal to, that is 12.76 is equal to principal 10 into 1 plus g power 5. 1 plus g power 5 is equal to 12.76 divided by 10. You will get 1.276. So that means, so 1.276 future value factor lies at 5% for 5 years. That means the growth rate is what? 5%. What is the growth rate? 5% is the growth rate. Are you getting my point? Growth rate is what? 5%. Am I clear? Okay. So they are asking you to find out the cost of a convertible debenture. You have to be careful. First we can find out KE. KE is equal to RF plus market risk premium is given 18. Okay. RF 10 plus 18 into 1.25, that is KE is equal to what? 32.5. 32.5. Clear? So flotation cost is 5%. We can find out the growth rate. Growth rate is equal to what? 5%. How can we find out the growth rate? Simple. 12.76 divided by 10, 1.276. This is the future value factor lies at 5%. Or else what we can use? IRR method to find out the growth rate. Okay. Next, we can find out the price of a share after how many years? 6 years. Because debenture, this question is completely conceptual, because the convertible debenture with a maturity period of 6 years. 6 years. So we calculated KE. D naught is given. The company has just paid a dividend of 12.76 per share, that is D naught. So D naught. So here the concept is, so example number 5. If asset is giving a benefit for indefinite period with growth, then how can we get the value? So benefit divided by required return minus growth rate. So P naught is equal to D1 divided by KE minus G. Be careful here. It's a completely conceptual one. P naught is equal to D1 divided by KE minus G. No doubt in that. But we need P6. Why P6? Because debenture can be converted into what? Equity share after how many years? 6 years. That means we require P6. How can we get P6? P6 is equal to D7 divided by KE minus G. Clear? So that's why, how can we get D7? D7 is equal to D naught into 1 plus growth rate power 7 divided by KE minus growth rate. After solving this, P6 is equal to what? 65.28. 65.28. Clear? One debenture can be converted into 2 shares. That means what is the redemption value? 130.56. If debenture is converted into equity shares, they will be receiving 130.56. Otherwise, they will receive a cash of only 100. Investor will choose a better option. So that's why redemption value we should consider 130.56. Completely conceptual. You should know the time value for money. They are asking advanced questions which are linked with time value for money. You need utmost clarity. So now KD is equal to interest. So what is interest amount? 15 rupees into 1 minus tax rate 0.4 plus 130 plus what? 130.56 minus what? 95 divided by 6 whole divided by 130.56 plus, not minus, plus 95 divided by 2. So what is the answer? 13.24%. Clear? 13.24%. Am I clear? Clear? Next. So use YTM method to calculate cost of a preference share. 5% preference share of rupees 100 each at a premium of 10%. That means it is issued at 110. These shares are redeemable after 10 years at par. That means redemption value 100 after 10 years. Flotation cost is 6% of issue amount. That means 110 minus 6%. Ultimately we receive only 103.4. 103.4. Clear? If I discount the future cash outflow, that should be equal to what? If I discount the future cash outflow, that should be equal to 103.4. Okay. So 1 to 10 years, what is the preference share dividend rate? Dividend rate is 5%. That means we cannot take 10% or something, because the dividend rate is only just what? 5%. And present value factors are also given for what? 3% and 3% and what? 5%. Clear? So present value factors are given, and also what? Annuity factors are also given. Let us find out what. So question number 12. B part. What is this cost of preference yield to maturity? What is the initial inflow? Initial inflow is equal to 100 into 110% minus 110 into what? 6%. That means what is the initial inflow? 103.40 rupees. Next. Trial 1 at the rate of what? 3%. Here cash flow PVAF slash PVF at the rate of 3%. Discounted cash flow. Year column 1-10 and 10. So what is the cash flow? 5 rupees and 100. 1 to 10 years at the rate of 3%. PVF is already given. PVAF is already given in the question. Take the factors. PVAF at the rate of 3% for 10 years, 8.53. What is the present value factor for 10th year? 0.744. So 74.4. 5 into 8.53. 5 into 8.53. 42.65 total. 42.65 plus 74.4. 117.05. Clear? But we should get 103.4. That means rate has to be increased. PVAF slash PVF at the rate of, already factors are given. At which rate? 5%. So tell me the PVAF. 7.722. 7.722, yes or no? And 0.614 present value factor. Now the discounted cash flow. 100 into 7.722, 77.22, 5 into 0.614, 5 into, sorry, reverse, I have written reverse. So 7.722, 0.614, that means this is 61.4. 5 into 7.722, 5 into 7.722, 38.61 total, 90, sir, 100.01, okay. So but I should get 103.4, which lies between what, 3% and 5%. So that means cost of a preference is equal to, now I can do what, interpolation. Cost of preference is equal to 3% plus 117.05 minus 103.4 divided by 117.05 minus 100.01 into what, 3 minus 5, 2 into 2. So what is the answer? 4.6% is the answer. Cost of a preference is 4.6%. This question is what, next level concept for understanding the concept. Okay, clearer? You should know how to find out the P6. P6 is equal to D7 divided by KE minus G. Price at the end of the 6th year. P6 means price at the end of the 6th year. We are writing P0 is equal to D1 divided by P0. P0 means current. P6 means what? We should write D7. How can we get D7? D7 is equal to D0 into 1 plus G power 7. Clearer? So illustration number 12. Only one information we have ignored is what? Flotation cost 5% of issue amount for convertible debt. That amount is ignored. Sorry, that is considered. That is considered because redeemable. It is assumed to be issued at what? Par value 100 minus 5%, that is 95. So everything is considered. Clear? Done. So from my side I have completed cost of a capital. So from your end, so better you go through November 19 question. Here I am providing November 19 question. So that is already covered a concept. And November 19, significance of a cost of a capital. I have already discussed evaluation of investment options, performance appraisal, designing of optimum credit policy. Okay. So choosing the optimum source of fund. Illustration number 3, November 20. This also we have considered. This question we have already covered. You just go through. Illustration 4 also, that is May 19. And July 21 question also, you can go through it. So that means almost all the past questions for FM are being considered. Okay, clear? So January 2022, this question also already considered, already we have covered. You just go through these past questions and check yourself whether you are reaching examination standard for CA Inter or not. Okay. So study material questions, if time permits, go through the study material questions, otherwise no, because almost all the concepts we covered in was past papers. Clear? So meet you next class. Thank you all. So next topic, leverages. So leverage means an influence of a power. General meaning, leverage means an influence of a power. So any business faces generally two types of a risk. One is the business risk and the second one is finance risk. You should know the meaning of business risk and what of finance risk first. and only the all equity company, sorry, only the unlevered, only the levered company or a firm will face a finance risk, because the finance risk means the risk arising due to the usage of a debt fund. Okay. So first, leverage means influence of a power. So to do a business, we have to influence some power. So what is that power? Example, we use building to generate sales. Okay. So we use building means that means we have to pay rent on a building. So this rent is a leverage. Leverage means an influence of a power. Here in this chapter, it is very simple chapter. In this chapter, we have only three types of leverages: operating leverage, financial leverage, and combined leverage. Okay, leverage means influence of a power. But to understand this concept, we should remember the another sentence. Leverage means a relation between two interrelated variables. Leverage means relation between two or more interrelated variables. Two or more interrelated variables. Okay. So first, let me give an example. Let me give an example for leverage. General example. Let us discuss a general example. For suppose Amar, okay, he's a fitness freak. As you already know, he is a fitness freak. Now the point is he wanted to start a fitness center. He wanted to start a fitness center. See, he started a fitness center. He started fitness center with Rukmini Vasanta. Okay, with Rukmini Vasant, he started a fitness center. Okay. Now the question is, so one day, so Amar friend Amal, he went to a gym fitness center, and that fitness center was almost in four floors. Four floors. Okay. Amal has got shocked because the reason is huge investment. So it is a huge building and the capacity was around 400. Okay, at a time 400 people can do a gym. Okay. So now the Amal, so first question generally will be what? Is it a own building or a rented building? Amar told it is our own building. It is our. He is including Rukmini also. It is our own building. Okay. Now the point is, so we will be feeling like what? A Amar, yes or no? Why? Simple reason, because no rent. That is okay. Their own building. That is their own building. So that's why what? No operating risk. For suppose no one is coming to gym, but still fee collected zero, variable cost zero, contribution zero, fixed cost zero, EBIT will be zero. So there is no possibility of EBIT become negative. So that's why we are saying what A Amar, yes or no? Okay, next. Second question by Amal is, Amar, you invested a lot of money in this fitness center. So all equipments are nice, good. So now the question is what? How much amount you invested? He told 2 crores invested in this, okay, equipment and all. So is it your own money or a loan fund? Is it your own money or a loan fund? Okay, this is the question asked by Amal. Amar reply is, this is our own money, our, including what? Rukmini as well. It is our own money. Again we say what? Hey Amar, Rukmini, you and yes or no? Why? What is the reason? Because the reason is simple. They do not have a commitment to make a payment of a interest. It is their own fund, so that's a payment of a interest is not mandatory. Okay, so that means there is no finance risk. There is no finance risk. Okay, no gym trainer, because Amar is giving training to what? The male, okay, males, and Rukmini is giving what training to female. Now the point is what? There is no fixed cost. There is no fixed cost means there is no operating risk. No one is coming to fitness center. Fee collected zero. Okay. Variable cost zero. Contribution zero. Fixed cost is zero. EBIT zero. Interest is also zero. That means no business risk, no finance risk. No business risk and no finance risk. The risk arising due to the usage of a fixed cost, that is rentals. or any other fixed cost is known as a business risk or a operating risk. So business risk is an uncertainty about the future operating income. Whenever I say operating income means EBIT. Okay. So operating risk, it is an uncertainty about the future operating income. That is EBIT. It is measured using what? Operating leverage. So how this operating risk arises? Operating risk arises due to the fixed cost. Due to the fixed cost. Okay. Clear? So in finance, general meaning of leverage is what? Influence of a power. But in finance, leverage means use of a fixed expenses to increase the profitability of a business. We use two. One is the fixed cost other than interest, and the one is what? Interest. Okay. So not just the interest, you should know the meaning of a fixed financial charges also. First, financial charges. There are three financial charges. First one, equity dividend, because equity dividend is paid because we procured money from equity. Next, preference dividend is also a financial charge. And next, interest is also a financial charge. But equity dividend is a variable financial charge. But preference dividend is what? Preference dividend is fixed financial charge. Interest is a fixed financial charge. Okay, are you able to understand my point? So here the point is the business risk means operating risk arising due to the use of what? Fixed cost. Okay. So let me give an example. So let me give an example for what all operating leverage, financial leverage, and what combined leverage. Operating leverage means the leverage which is calculated to measure the operating risk. Financial leverage is calculated to measure finance risk. Combined leverage is calculated to measure the total risk. So why we are learning this chapter, and it comes under which side? It comes under what? Procurement of a fund side. Okay, nothing to do with utilization of a fund. Now here why we are learning this topic, and without learning this topic also, simple common sense. For suppose if we have already a fixed cost, we have taken a building on a rent. That means we have a monthly fixed expense. Okay. Now to procure money, can we go for a debt? No. Answer is no, because already you have an operating risk. If you take debt again, what happens? Finance risk will get added and overall risk will increase. Okay. But for suppose if it is your own fund, you have a own fund, then what you can do? Then you can go for what? Building. You can take a building on a rent, because you do not have an interest payment but fixed cost. You can manage. But already you have a huge amount of a rental cost, fixed cost, and you are taking what? A debt. Then what happens? By the end of the month, you have to make a payment of rent as well as what? Interest. So that will increase the possibility of a occurrence of a loss. Okay. So here first I will explain the formulas and then what logics. Operating leverage is equal to contribution divided by EBIT. So for the time being, logic is what? Contribution divided by EBIT. Why contribution divided by EBIT? Simple reason. The difference between the contribution and EBIT is fixed cost. And operating leverage, it measures operating risk which is arising due to the fixed cost. So that's why the difference between the numerator and denominator is fixed cost. Okay. Operating leverage, other formula, percentage change in EBIT divided by percentage change in sales. Why, sir? Because leverage denotes relationship between two or more interrelated variables. Here, operating leverage denotes the relationship between sales and EBIT. Okay. So for example, operating leverage is equal to 2. Operating leverage is equal to 2. What does it mean? For every 1% change in sales, EBIT changes by 2%. Operating leverage 4. For every 1% change in sales, EBIT changes by 4%. Higher the operating leverage, higher the operating risk. Higher the operating leverage, higher the operating risk. Are you getting my point? So operating leverage, other formula is percentage change in EBIT divided by percentage change in sales. Okay, for example, percentage change in EBIT 4, percentage change in sales 1. 4 divided by 1, you will get 4. Okay, so operating leverage 4. What does it mean? For every 1% change in sales, EBIT changes by 4%. High fixed cost result in higher operating leverage. Less fixed cost result in low operating leverage. No fixed cost means operating leverage is equal to 1. That indicates no operating risk. That indicates what? No operating risk. Are you getting my point? High fixed cost results in high operating leverage. Less fixed cost result in low operating leverage. No fixed cost means operating leverage is equal to 1, and that indicates no operating risk. I will tell you the logic later on. So first I am explaining the formula. Next, financial leverage. Financial leverage. It arises due to the usage of a debt funds. Debt funds. Be careful, not just the debenture. It includes what preference share capital as well. Okay. Why? Because it arises due to the usage of debt funds. Debt funds. Nothing but it arises due to the fixed financial charges. We pay fixed financial charges on debt as well as what preference share capital. On preference share capital also you have to pay fixed charges. So that's why it arises due to what debentures as well as preference share capital. So financial leverage is equal to EBIT divided by EBT. Sir, why EBIT divided by EBT? Because simple reason. What is the difference between the numerator and denominator? Numerator EBIT and denominator EBT. What is the difference? Interest. So finance risk, financial leverage measures finance risk arising due to the fixed financial charges. In most of the questions, fixed financial charges will be only interest. Only interest. So that's why the formula is EBIT divided by EBT, earnings before tax. Okay. Next, when there is a preference share capital, be careful. When there is a preference share capital, you have to be careful. Financial leverage is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Financial leverage is equal to EBIT divided by EBIT divided by EBT minus PD divided by 1 minus tax rate. So why this formula? As I have already told, financial leverage measures finance risk arising due to fixed financial charges. Fixed financial charges includes what? Interest. If there is only interest, then your formula is simple. EBIT divided by EBT. The difference between the numerator and denominator is interest. Simple logic to remember these formulas is what? The difference between the numerator and denominator must be the reason why the risk is being caused. Okay. So that's why second formula, EBIT divided by EBT. If you're taking only EBT, then what is the difference in interest? But the difference should be what? Preference dividend also. But the preference dividend is paid after payment of a tax. So that's why we are finding out what pre-tax preference dividend. Pre-tax preference dividend. So that's why formula is EBIT divided by EBT minus PD divided by 1 minus tax rate. Financial leverage is equal to percentage change in. Percentage change in, you better take only EPS. Percentage change in EPS. Percentage change in EPS. Of course, you can take EBT also. Okay, percentage change in EPS, earnings per share divided by percentage change in EBIT. For example, financial leverage is equal to 2. What is the meaning of this? For every 1% change in EBIT, earnings per share changes by 2%. Financial leverage is equal to 5. What is the meaning of this? For every 1% change in EBIT, earnings per share changes by 5%. Am I clear? Next, combined leverage. Combined leverage. Combined leverage, it measures the total risk. So combined leverage is equal to operating leverage into financial leverage over R. Over R. So what should be the formula? Contribution divided by EBT. Simple. Combined leverage measures total risk arising due to fixed cost and interest. So that's the difference between the numerator and denominator is interest and fixed cost. Contribution divided by EBT, earnings before tax. So what is the other formula? Percentage change in EPS. Percentage change in EPS divided by what? Percentage change in sales. So why percentage change in EPS divided by percentage change in sales? Simple. Operating leverage denotes the relationship between what? Sales and EBIT. Financial leverage denotes the relationship between EBIT and EPS. But combined leverage denotes directly the relationship between sales and EPS. So what is the other formula? Contribution divided by EBT minus PD divided by 1 minus tax. This formula we apply when there is a preference share capital. Be careful, when there is a preference share capital, we have to use the second formula. I mean, contribution divided by EBT minus PD divided by 1 minus tax rate. Clear? Simple. What is an operating leverage? It measures operating risk arises due to fixed cost. So that's why the difference between the numerator and denominator in operating leverage is fixed cost. Okay. Financial leverage measures finance risk which arises due to fixed financial charges. So that's why the difference between the numerator and denominator is what? Fixed financial charges. Combined leverage. Combined leverage. So in combined leverage, so it measures total risk arising due to what? Fixed cost as well as fixed financial charges. So that's why. So what is the formula? Simple. The difference between the numerator and denominator is what? Fixed cost and fixed financial charges. Clear? Are you getting my point? Clear? So it is very simple. I need not take any example or nothing, but still I'm taking case 1. Particular amount. For example, so sales 0. Okay, then what about your variable cost? Variable cost will also be 0. As I have already told, risk means what? Possibility of occurrence of a loss. Business risk means possibility of occurrence of loss in operating income, EBIT. Uncertainty about the future operating income. Right now we are earning EBIT, but in future we may or may not earn that EBIT. That uncertainty may or may not is called as a business risk. So business risk depends upon the nature of a business. Example, in cinema industry, business risk is too high. The possibility of occurrence of loss is too high. Okay, timing of release of film is also very important. Promotions are also very important. Okay, not just the product. Okay, so that's why if you see the cinema industry, business risk is high when compared to real estate. Yes or no? So here case 1, sales for example 0 minus what? Variable cost 0. What about contribution? Your contribution will also be equal to what? 0 minus fixed cost. For example, fixed cost is 0. Example, fixed cost 0. Then what is the possibility of EBIT? In worst case scenario, EBIT will be 0. Worst case, that can be the worst case. That means what? It cannot be negative. That means there is no possibility of occurrence of a loss. So what does it? What this indicates? This indicates there is no operating risk. There is no operating risk. Okay, there is no business risk. Next, minus interest example 0. Then earnings before tax will be 0. Minus tax example 0. because earnings before tax 0 means tax will also be 0. What about earnings after tax? Earnings after tax will be 0. Minus preference dividend, example 0. What about earnings available to equity shareholders? 0. Yes or no? So what is your EPS? Earnings per share will also be equal to 0. Okay, clear? So here operating risk arises due to what? Fixed cost. Clear? What about the finance risk? Finance risk arises due to finance risk arises due to fixed financial charges. What are the fixed financial charges? Interest and preference dividend. Clear? So what about total risk? Total risk arises due to what? Total risk arises due to fixed cost, interest, and preference dividend. Okay. If you see the formula also, operating risk is equal to, operating leverage is equal to contribution divided by EBIT. Why, sir? Because of the reason operating leverage measures operating risk, which arises due to fixed cost. So that's why difference between the numerator and denominator is fixed cost. Am I clear? What about the next one? Finance risk. So finance risk means financial leverage. It measures what? Finance risk, which arises due to what? Fixed financial charges. Generally, in every equation, you will find interest as a fixed financial charge. So that's why what is the formula for financial leverage? EBIT divided by EBT. Okay. But when there is a preference dividend, then your formula will be EBIT divided by EBT minus PD divided by 1 minus tax. Why? Because preference dividend is paid after payment of a tax. That's why. Clear? Okay. But combined leverage is equal to what? Directly contribution divided by EBT. Am I clear? Okay. Now, clear? So high fixed cost results in high operating leverage. High interest results in high financial leverage. High fixed cost and high interest results in what? High combined leverage. Simple chapter. Okay. Now let us see the second formula. What is the second formula? Percentage change in. So I'm just deriving the operating leverage formula, but this is waste of a time. Percentage change in EB divided by percentage change in sales. This you have to learn. Formula. Derivation is not required. So operating leverage denotes the relationship between sales and EBIT. Financial leverage denotes the relationship between EBIT and EPS. Combined leverage directly denote relationship between sales and EPS. So percentage change in EBIT. How do we calculate the percentage change in EBIT? Change in, first we take what? Change. Change in what? EBIT divided by the base EBIT. Base EBIT. So how do I get change in EBIT? Sales minus variable cost minus what? Fixed cost divided by sales minus variable cost minus fixed cost. Clear? Percentage change in. How do I calculate the percentage change in EBIT? First I take change divided by base 1. Whole divided by percentage change in sales. Change in sales divided by what? Base sales. So that is equal to. You are taking change in EBIT. In both the cases, fixed cost will be same. In both the cases, fixed cost will be same. Yes or no? In both the cases, fixed cost will be same. Okay, so that's why change in sales minus variable cost divided by sales minus variable cost minus fixed cost is what EBIT into change in sales divided by what? Sorry, divided by what? Sales divided by change in sales. Okay, so now the change in sales and change in sales will get cancelled. Yes or no? Change in sales will get cancelled. And what is left? The sales minus variable cost. Sales minus variable cost is nothing but what? Contribution divided by what? EB. So this is the derivation. It is waste of our time completely because the reason is simply we can remember the formula. Operating leverage measures operating risk which arises due to fixed cost. So that should be the difference between the numerator and denominator. Contribution divided by EB. Am I clear? Done. Now, one more point. You know the break-even point concept. Break-even point is equal to fixed cost divided by contribution per unit. The next, margin of safety. Total sales minus break-even sales. Okay. So why? Simple. If a fixed cost increases, your break-even point will also increase. If a fixed cost increase, break-even point will also increase. Yes or no? Okay. Am I correct? So that means operating leverage, operating leverage will also increase. For fixed cost increases, fixed cost increase, break-even point increases. Obviously, simple reason. Okay, if I open a store in Nujividu, less fixed cost. If I open a store in Vijayawada, high fixed cost. So my break-even point will increase. My break-even point will increase. Yes or no? If I open the store in Vijayawada. Okay. Next, margin of safety. See, if a fixed cost increases, break-even point increases. If break-even point increases, margin of safety decreases. Yes or no? Because margin of safety is equal to total sales minus break-even sales, and if a break-even sales increases, margin of safety margin will decrease. Safety margin. Sir, what is this margin of safety? For example, my total sales 20 lakhs. Break-even sales as of now 10 lakhs. That means I have a safety margin of a 10 lakhs. Even if my sales decreases by 10 lakhs, still I am safe. No possibility of a loss. Okay. But if a break-even point increases to 15 lakhs, then what is my margin of safety? 5 lakhs is my margin of a safety. Clear? Done? So are you able to understand this relationship between the operating leverage and fixed cost, break-even point, and margin of a safety? Is it clear? Now let us start the questions, okay? So here I am completely discussing the concepts examination point of view. I'm focusing on practical questions. I'm not focusing on theory questions. I'm completely focusing on what? Practical questions, okay? So let us start the questions. Illustration number 1, January 2025, 1B. So following the balance sheet of E Limited as on 31st March 2024. Additional information, fixed cost per annum exclusive interest, exclusive of interest, variable operating cost ratio, total asset turnover ratio, income tax rate 30%. Here the special point in this question is total asset turnover ratio. This is the special point. Sir, total asset turnover ratio. Whenever they ask you any turnover ratio, these turnover ratios are calculated to find out how efficiently are we using the resources. So asset is a resource. So whether we are using this asset efficiently or not, inventory is an asset. Inventory is a resource. Whether we are using the inventory efficiently or not, further we find out inventory turnover ratio, capital turnover ratio, working capital turnover ratio. For that matter, any turnover ratio, numerator will be the turnover. Always the numerator will be turnover. That means in the present case, total asset turnover ratio means turnover sales divided by total assets. But remember one point, not every case, in every case, sales is not the turnover. In every case, sales cannot be the turnover. That point you have to remember. But always the numerator will be what? Turnover only. Okay, clear? So in this case, what is the turnover ratio 2.5? What is the meaning of this? By investing 1 rupee in total assets, we are able to generate a sales of a 2.5. 2.5. Higher the asset turnover ratio, better it is. Clear? So one point is clear. Numerator will be the turnover in every case, turnover ratio, but in every case, turnover doesn't mean sales. Example, creditors turnover ratio. So there is no relationship between the sales and creditors. So in case of a creditors turnover ratio, turnover means credit purchases. Likewise, debtors turnover ratio. There is no relationship between the cash sales and debtors. So that's why in case of a debtors turnover ratio, we should take credit sales. In case of raw material inventory turnover ratio, there is no direct relationship between the raw material inventory and sales. So that's why we take raw material consumption. Raw material consumption. Okay. So income tax rate is given. You are required to calculate earnings per share. So the starting point, simple point is we should start with total asset turnover ratio. That is, what is the total assets? 80 lakhs. 80 lakhs into 80 lakhs into what? 2.5. 80 lakhs into what? 2.5. Okay, so what is the sales amount? 200 lakhs. So this starting point is important and rest is simple only. So they are asking you to find out the earnings per share. So this question is not for practice. You feel like practicing this question. General psychology of a student is, so they will feel like practicing the easy questions. They feel like referring the hard questions. It has to be reversed. Okay. So sales we already know, minus variable cost ratio already given 70%, contribution minus fixed cost EBIT minus interest on debentures. In balance sheet you can see the debenture 12.5%. So 40 lakhs into 12.5. Profit before tax minus tax, profit after tax. Divide by number of equity shares. Number of equity shares you can find it in balance sheet. 20 lakhs divided by 100. So 20,000 is the number of our shares. So 27 lakh 30,000 divided by 20,000. So earnings per share 136.5. Next, operating leverage is equal to contribution divided by EBIT 1.363. Financial leverage EBIT divided by EBT 1.128. Combined leverage, operating leverage into financial leverage, the answer is 1.538. Clear? Now come to the next question. So details of a company for the year ended 31st March 2022 are given below. Sales amount is given, PV ratio is given, profit volume ratio, nothing but contribution ratio is given 35%. Fixed cost excluding interest expense is given, 10% debt is given, equity share capital is given, income tax rate is given. So determine company's return on a capital employed pre-tax. Pre-tax. They are asking you to find out the pre-tax return on a capital employed and also what? EPS. Does the company have a favorable financial leverage? Favorable financial leverage. Calculate the operating and combined leverage of a company. Calculate the percentage change in EBIT if a sales increases by 10%. And next, at what level of a sales the earnings before tax of the company will be equal to 0. Simple question. Return on a capital employed. I think I have already discussed this return on a capital employed, that to pre-tax. Pre-tax, before payment of a tax. So what is the formula? EBIT divided by capital employed. EBIT divided by capital employed. How do we get capital employed? Capital employed is equal to equity plus debt. Equity plus what? Debt. Okay. So now first to find out the return on capital employed and EPS, we should take income statement. 86 lakhs minus variable cost 65%, because contribution ratio 35 means variable cost ratio 65. Contribution minus what? Fixed cost. EBIT minus interest, earnings before tax minus tax, profit after tax. Clear? So profit after tax 8,76,000. Now return on a capital employed pre-tax. How do we get return on a capital employed? EBIT divided by capital employed. So what is the EBIT amount? 20 lakh 10,000 divided by capital employed. How do I get capital employed? Equity 75 lakhs plus debt 55 lakhs. 15.46%. 15.46% is the return on a capital employed. Next, earnings per share. How do we get earnings per share? Profit after tax 8,76,000 divided by 8,76,000 divided by what? Okay, how many shares are there? 75 lakhs divided by 10. So 7 lakh 50,000. Okay, so answer 1.168. Clear first part. Next, we have a concept of favorable financial leverage. So what is this favorable financial leverage? So actually I wanted to discuss in capital structure. Now in this question we have a point, favorable financial leverage. Financial leverage is said to be favorable if return on a investment is greater than a rate of a interest. Return on investment is greater than what? Rate of a interest. Okay. So what is the rate of interest here? Rate of interest is equal to favorable financial leverage. Favorable financial leverage. Favorable financial leverage. This concept is relevant for capital structure. So what is a favorable financial leverage? Financial leverage is said to be favorable if return on investment is greater than rate of interest. Sir, why it is relevant? So why we are learning this point? Simple here, this the return on investment is, in this question the return on investment is 15.46%, which is greater than the rate of interest 10%. The financial leverage is said to be favorable. Sir, what is this? Leverage means what? Influence of a power. Financial leverage means what? Influence of a debt power. Influence of a debt power. So favorable financial leverage. Influence of a debt power is favorable. Influence of a debt power is favorable. Why it is favorable? Because the reason is, on every 1 rupee you take from the venture holder, you will be paying only 10%. But whereas on every rupee invested in a business, you will be able to generate 15.46%. Are you getting my point? I'm the equity shareholders. If I take the money from the debt holder and if I invest, I will get 15.46, but I will pay only 10% to the debenture holder. So influence of a debt power is favorable. Why it is favorable? The balance of 5.46% will be enjoyed by the equity shareholder. The concept here is if you increase the debt proportion in capital structure, when the financial leverage is favorable, if you increase the debt proportion in capital structure, the return on equity will increase. Simple common sense. On every 1 rupee invested, for suppose 100% equity, I will get return on investment 15.46. So assume there are no taxes, then return on equity will also be what? 15.46%. Simple. But if I add the debt which is having a rate of interest 10%, then what happens? Return on equity will increase. Why the return on equity will increase? Simple concept. On every 1 rupee invested, I will get 15.46, but I will pay only 10% to the debenture holder. The balance will be enjoyed by the equity shareholder. So that's why this concept is called as favorable financial leverage. So financial leverage is said to be favorable if return on investment is greater than what? Rate of interest. So next question, next part of the question is what they are asking. They are asking you to find out the operating leverage and combined leverages. Simple operating leverage, EBIT contribution divided by EBIT. Financial leverage, EBIT divided by EBT. EBIT divided by what? EBT. Next, combined leverage, contribution divided by EBT. Contribution divided by what? EBT. So, okay. So, final answer 2.06. Next part of the question. What is the next part of the question? Next part of the question is calculate the percentage change in EBIT if sales increases by 10%. For suppose if sales increases by 10%, calculate the percentage change in EBIT. You can take again the income statement. Increase your sales by 10%. Right now 86 lakhs. Increase your sales by what? 10%. Increase your variable cost by 10%. Then you will get contribution. But fixed cost will remain same. You will get new EBIT. New EBIT. But the question is what? Calculate the percentage change. They are asking you to find out what? Percentage change in EBIT. If a sales increases by 10%. So what is the leverage that denotes the relationship between sales and EBIT? Operating leverage. So what is the operating leverage? Answer 1.497. 1.497. Okay. So that means for every 1% change in sales, EBIT changes by 1.497. Here, if a sales increases by 10%, EBIT increases by what? 14.97%. Clear? Okay. So getting my point. Next, third one. At what level of a sales, the earnings before tax of the company will be equal to 0. So this also you can go work back. Take EBT 0. At what level of a sales, the earnings before tax of the company will be equal to 0. So this is simple. So one thing you can do is do working back. Do working back. Okay. Fifth part. Fifth part of the question. Do working back. So working back means you take earnings before tax what? 0. Earnings before tax 0. So first you can take what? Income statement. Sales. So we do not have an idea about sales, yes or no? Minus what? Variable cost. Contribution, no idea. Minus fixed cost. Then you will get EBIT. Minus what? Interest. You can go for what? Working back. You can go for what? Working back. So what is interest amount? What is interest amount in the question? Interest is equal to 5,50,000. So that means earnings before tax has to become 0. That means EBIT must be what? 5,50,000. So what is the fixed cost? Fixed cost is equal to 10 lakhs. That means contribution must be equal to 15 lakh 50,000. Okay. So what is the variable cost ratio? Contribution ratio is 35%. That means variable cost is equal to what? Variable cost is equal to 65. So contribution. So for 15 lakh 50, for 35, 15 lakh 50 amount. We should find out what for 65 what is the amount. So 15 lakh 50,000 divided by 35 into 65. 15 lakh 50,000 divided by 35 into 65. What is the answer? 2 lakh 28 lakh 78,571. Sales amount is equal to 44 lakhs 28,571. This is one way of calculating. So what is the answer? 44 lakh what? 70 44 lakh 28,571. Clear? What is the other way of a calculation? Completely conceptual, using the combined leverage. Combined leverage denotes the relationship directly between the sales and EPS. Of course, sales and EAT and sales and EBT also, earnings before tax also. Clear? Combined leverage denotes direct relationship between what? Sales and EBT or EAT or EPS, earnings per share. So what is the combined leverage here? 2.062. What is the meaning of this? If a sales changes by 1%, earnings before tax changes by 2.062. Okay. If a sales changes by 1%, earnings before tax changes by what? 2.062%. But here, earnings before tax has to become 0. That means earnings before tax should change by 100%. That means what is the percentage change in sales required? You're getting my point. So combined leverage 2.062. What does it denote? For every 1% change in sales, EBT, earnings before tax changes by 2.062%. But suppose if earnings before tax has to become 0, that means it has to decrease 100%. That means sales should decrease by 100 divided by 2.062, that is 48.5. That means the new sales will be 86 lakhs into 1 minus 0.485. Yes or no? So the answer is 44 lakh 29,000. You will get the same answer. So there is a slight difference because of a decimals. Here we have not considered decimals. Okay. Done. Am I clear? Clear? Next, illustration number 3. Following information relates to A Limited for the year ended 31st March 2025. Profit volume ratio 24%, operating leverage 2, financial leverage 1.5, interest expense 12,000, tax rate 30%, number of equity shares 1000. You are required to prepare income statement for the year ended 31st March 2025. Calculate earnings per share. Calculate the percentage change in earnings per share if sales increases by 5%. Calculate percentage change in EPS if a sales increases by 5%. For this, we can use what? We can use combined leverage directly, because combined leverage. Calculate percentage change in earnings per share if sales increases by 5%. You know that sales and earnings per share. So combined leverage denotes the relationship between what? Sales and EPS. We can use that. Okay. So prepare income statement. So this question is simple. Following information relates to A Limited for the year ended 31st March 2025. PV ratio is given 24%, operating leverage and financial leverage. So in this question, the special point is we should start with this is like finding out the missing figures. You should know maths, ratio analysis, marginal costing kind of thing. So financial leverage is equal to EBIT divided by EBT, earnings before tax. So this earnings before tax can be written as EBIT minus interest. This is the thought you should get in examination. Simple. EBIT divided by EBT, that EBT can be written as EBIT minus interest, or else in denominator take EBT, in numerator take EBT plus interest. EBT plus interest, because by using one equation we cannot find out two variables. Okay. Now EBIT minus what? Interest. So we know the interest amount. So by solving this we can get EBIT 36 lakhs. Clearer? So the only one point is you should write EBT as a EBIT minus interest, or else what? EBIT as EBT plus interest. Done? Now operating leverage. What is the operating leverage formula? Contribution divided by EBIT. So we already know EBIT. So we can find out what? Contribution. So contribution 72,000. So we have a PV ratio 24%. We know contribution amount 72,000 and also what? PV ratio. So 72,000 contribution divided by PV ratio, you will get sales amount. What is the sales amount? 3 lakhs. Okay, clear? So now we can start income statement. Income statement, sales minus variable cost contribution. We know EBIT and contribution difference is equal to fixed cost minus interest, earnings before tax minus tax at the rate of 30%, earnings after tax. First part of the question is income statement, simple. Next EPS, earnings per share is equal to earnings available to equity shareholders divided by number of equity shares. Number of equity shares already given in the question. Done. Third part is calculate the percentage change in EPS if sales increases by 5%. So for that, first we should find out the combined leverage. How do we get combined leverage? Contribution divided by earnings before tax is equal to 3. Okay, or else operating leverage into financial leverage. So what is the combined leverage? Answer, combined leverage is equal to 3. Combined leverage is equal to what? 3. Okay. So it denotes what? For every 1% change in sales, EPS changes by 3%. Here sales changes by 5%. That means EPS changes by 15%. Simple question. Okay. Done. Next, illustration number 4. Alpha Limited has provided following information: equity share capital, 15% debenture, sales, variable cost, fixed cost. Due to recent policy changes and entry of a foreign competitors in the sector, Alpha Limited expects the sales may decline by 15 to 20%. Sales may decline by 15 to 20%. However, selling price and other costs will remain same. Corporate taxes will continue at the rate of 20%. You are required to calculate the decrease in earnings per share, degree of operating leverage, financial leverage separately for sales declined by 15% and 20%. Simple. So, simple question. First, income statement. We need income statement to find out the earnings per share. Decrease in earnings per share. Decrease in earnings per share means first we should find out the present earnings per share. So that's why we take particulars and 3 columns. Existing, sales declined by 15%, sales declined by 20%. So what is the present sales amount? 50 lakh units at the rate of 20. 50 lakh units at the rate of 20. Okay. So second, sales declined by 15%. That means 42 lakh 50,000. Third, sales declined by 20%. 40 lakh units. Selling price per unit and variable cost per unit will remain same. So contribution per unit is 7.5. We are finding out the contribution. minus fixed expenses already given in the question, EBIT minus debenture interest, earnings before tax minus tax, profit after tax. Number of our shares. So number of our shares will remain same, yes or no, in all the cases. So earnings per share. First case, what is the earnings per share? 604. Second, 424. Third, 364. So this is a simple common sense question, yes or no? Okay. So the first part of the question is they are asking you to find out the percentage decrease in EPS. So what is the percentage decrease in EPS from 604 to it has got decreased to 424. 424. Yes or no? So that means 180 is the difference. Yes or no? So 180 divided by, they are asking you to find out the decrease in EPS. So whether it is amount or a percentage, no clarity. If it is amount, what is the answer? 180. If it is percentage, 180 divided by 604. 180 divided by 604, not 100. 180 divided by 604. Okay. The next second one. Second one. From 604 it decreased to 364. That means that the decrease in earnings per share is equal to 240. The decrease in earnings per share is equal to rupees 240. What is the percentage decrease in EPS? Percentage decrease in EPS is equal to 240 divided by 604. But in question there is no clarity whether they are asking about the decrease in amount or a percentage. So that's why both are calculated. Next, what they were asking you to find out operating leverage and financial leverage in the two cases. In the new two cases, simple. Operating leverage contribution divided by EBIT. Financial leverage EBIT divided by EBT. Am I clear? Simple. So no complication. Next, illustration number 5. Financial information for the year 2023-24 of two companies, N Limited and C Limited, are as under. Details: N Limited, C Limited. Equity share capital 10 lakhs and 8 lakhs. Debt 5 lakhs at the rate of 10%, 7 lakhs at the rate of 8%. Fixed cost is given, combined leverage is given, and financial leverage is given. You are required to calculate. Contribution for N Limited and C Limited. Margin of a safety in percentage for N Limited and C Limited. And also what sales of a C Limited. So here you should start with combined leverage and financial leverage. What is the combined leverage? 8. Financial leverage 2. We can find out operating leverage. How do we get operating leverage? Combined leverage divided by financial leverage, that is equal to 4. Okay. So operating leverage 4. What is the formula for operating leverage? Contribution divided by EBIT. Contribution divided by what? EBIT. Okay. So how can we write this EBIT? How can we write this EBIT? EBIT can be written as what? How do we get EBIT? Contribution minus fixed cost. Yes or no? Contribution minus fixed cost. We already know what fixed cost. We already know fixed cost. What is the fixed cost amount? 3 lakhs. Are you getting my point? So you can find out using any method. Okay. Contribution divided by contribution minus fixed cost is equal to what? 4. We already know the fixed cost. We can find out what contribution. So what is the other way of finding out? Debt amount is given and rate of interest is also given. So what is the interest amount? 5 lakhs into 10%, 50,000. We know the financial leverage formula, EBIT divided by EBT. That can be written as EBIT divided by EBIT minus interest. So likewise we can find out what? EBIT. First case EBIT 1 lakh. Earnings before tax 50,000. Okay. So in combined leverage formula, what is the combined leverage formula? Contribution divided by EBT. Contribution divided by EBT. We already know EBT. By substituting, we will get contribution 4 lakhs. But this is a lengthy process. But the simple process is what? Find out the operating leverage 4. So what is the operating leverage formula? Contribution divided by EBIT. EBIT can be written as contribution minus fixed cost. So this is simple one, because contribution is equal to 4 contribution minus 4 into 3 lakhs. Okay, so 3 contribution is equal to 12 lakhs. Contribution is equal to 12 lakhs divided by 3, that is equal to what? 4 lakhs. Simple. This is simple way of a calculation. Okay. Next, margin of a safety. Margin of a safety. So margin of a safety percentage. Margin of a safety percentage. How do we get margin of a safety? Margin of a safety is equal to 1 divided by operating leverage. Remember this. This is the shortcut. Margin of a safety is equal to 1 divided by what? Operating leverage. 1 divided by operating leverage. Okay. So the answer is 25%. Answer is what? 25%. First case. Second case what? 33.33%. Nothing but margin of safety is equal to EBIT divided by contribution. EBIT divided by what? Contribution. Margin of safety. Okay. So margin of safety is equal to contribution minus fixed cost divided by what? Contribution. Okay. So what is the reason behind this? Simple. You know the margin of safety formula. Profit divided by what? PV ratio. How can we write profit? Sales into PV ratio minus what? Fixed cost divided by what? PV ratio. Sales into PV ratio minus fixed cost divided by what? PV ratio. Am I correct? Profit is equal to sales into PV ratio. Contribution minus what? Fixed cost. So profit divided by PV ratio. Okay. Clear? Nothing but contribution minus fixed cost. Contribution minus fixed cost. I think here formula is. So margin of safety percentage is equal to 1 divided by operating leverage. 1 divided by what? Operating leverage. You might forget this one. See this margin of safety is equal to 1 divided by what? Operating leverage. Nothing but what is the formula? Formula is equal to EBIT divided by contribution. EBIT divided by contribution. So what is the logic for this? So there is a relationship between what? Fixed cost and operating leverage and fixed cost and margin of a safety. Yes or no? As we have already discussed earlier, if a fixed cost increases, operating leverage increases, margin of safety decreases. Okay. So first of all, how do I get margin of safety percentage? Margin of safety percentage. Margin of safety percentage is equal to total sales minus what? Break even sales. If I want in percentage, then what? Total sales minus break even sales divided by what? Sales. Are you getting my point? Okay. So margin of safety percentage, total sales minus break even sales. If it is amount, okay, fine. Sales minus break even sales. But if I want in percentage, then what? Sales minus break even sales divided by sales. So let us multiply with PV ratio in numerator and denominator. Effect will be 0 because we are multiplying PV ratio in the numerator as well as what? Denominator. So then what is the next one? Sales into PV ratio minus break even sales into PV ratio divided by what? Sales into PV ratio. Okay. So this sales into PV ratio can be written as contribution minus break even sales into PV ratio can be written as what? Fixed cost. because break even point is equal to fixed cost divided by PV ratio. Fixed cost divided by PV ratio. So that means fixed cost is equal to break even sales into PV ratio divided by what? Contribution. That means what is the final formula? EBIT divided by contribution. Clear? So what is the operating leverage formula? Operating leverage is equal to contribution divided by EBIT, but margin of safety is equal to EBIT divided by contribution. So this we have already discussed. Fixed cost, if it increases, break even point increases, operating leverage increases, but margin of safety decreases. Clear? Done? Okay. Now let us come back. So margin of safety is equal to 1 divided by what? Operating leverage. So the answer is 25% and 33.33%. Clear? Next, what they are asking, sales of a C limited. Sales of a C limited. Okay. So we have a calculated what? Contribution. So we calculated what? Contribution. Okay. So sales of a C limited. Let us assume that PV ratio is what? 40%. We are assuming here what? PV ratio as 40%. So not like that. So margin of safety. So use the another formula. What is the PV ratio? PV ratio is equal to, margin of safety is equal to what? Margin of safety percentage. We got margin of safety percentage. So here we cannot proceed because the reason is what? Because the reason is here in examination they have taken a percentage. Let us assume that PV ratio is equal to what? 40%. We know the contribution. So contribution divided by 40%, you can find out what? Sales amount. Okay. So what is the contribution? 4 lakhs. So 4 lakhs divided by 40%. You will get 10 lakhs. 10 lakhs as the sales amount. 10 lakhs is the sales amount. Okay. Am I clear? Done. Clear? So in this question, the special point is the third part, sales of a C limited. Okay. It is completely unreasonable to expect from student to assume PV ratio as a 40% because there is no way to find out what sales. There is no way to find out the sales amount. But here they are assuming what? PV ratio as a 40%. For N limited, contribution is 4 lakhs. That's why what is the sales amount? 4 lakhs divided by 40%, 10 lakhs. But for C limited, what is the contribution? 5 lakh 4,000. So 5 lakh 4,000 divided by 40%. 5 lakh 4,000 divided by what? 40%. You will get 12 lakh 60,000. So in this question, the special point is 40%. Even though you know the concept, you may get stuck at third part because we have to assume the PV ratio to be 40%. Next, illustration number 6. Information of A limited is given below. Earnings after tax 5% on sales, income tax rate 50%, degree of operating leverage 4 times. Degree of operating leverage 4 times. 10% debenture in capital structure 3 lakhs, variable cost 6 lakhs. Required from the given data, complete the following statement. Complete the following statement. So sales. Okay, they are asking you to complete the income statement. So they have given operating leverage. What is the operating leverage? 4 times. Operating leverage is equal to 4 times. Earnings after tax 5% on sales, income tax 50%, variable cost is given 6. Variable cost is given 6 lakhs. 10% debenture in capital structure 3 lakhs. Second part of the question, they are asking you to find out what? Calculate financial leverage and combined leverage. Financial leverage and what? Combined leverage. And also what? Calculate the percentage change in earnings per share if a sales increased by 5 Clear? Now, so this is a question which is completely conceptual and tricky. Earnings after tax 5% on sales, yes or no? What is the income tax rate? 50%. So that means earnings before tax, if it is 100, income tax is 50, earnings after tax will be 100. Sorry, earnings after tax will be 50. 50. Okay. So that means, can we say earnings before tax is equal to 10% on sales? Earnings after tax is 5% on sales, income tax rate is 50%. So we can say what? Earnings before tax will be 10% on sales. Am I correct? Clear? Can I tell or not? Yes. So that means earnings before tax is equal to 10% on sales. So what is the interest amount? Interest amount is equal to 10% debenture in capital structure 3 lakhs. So 30,000 is the interest amount. Now, how can I write EBIT? EBIT is equal to 10% on sales plus 30,000. So this is equation number 1. EBIT can be written as what? 10% on sales, that is earnings before tax plus interest expense 30,000. Clear? Are you getting my point? Now, the second equation. So this is completely tricky question, conceptual one. Operating leverage. We know the operating leverage formula, contribution divided by EBIT, that is equal to 4. So that means contribution is equal to what? 4 EBIT. Contribution can be written as what? Sales minus variable cost. Sales minus variable cost, that is equal to what? 4 EBIT. We know variable cost, sales minus 6 lakhs is equal to 4 EBIT. Okay. Nothing but in place of EBIT we can substitute what? 10% of sales plus 30,000. Yes or no? Sales minus 6 lakhs is equal to 4 into EBIT. Okay, EBIT can be written as what? 10% of a sales plus rupees 30,000. Clear? On solving this, you will get what? Sales is equal to 12 lakhs. So extremely tricky question. So first we started with what? Earnings after tax is 5% on sales. That means earnings before tax is equal to 10% on sales. Earnings before interest and tax is equal to EBT, 10% on sales plus interest 30,000. So that we are substituting in what? Operating leverage formula. What is operating leverage? Operating leverage is equal to contribution divided by EBIT. Clear? Done. So sales, find 12 lakhs. So if you know the sales, then you can find out what contribution. 12 lakhs minus 6 lakhs. 6 lakhs is the contribution. We can find out EBIT. EBIT is equal to what? Contribution divided by operating leverage 4. So EBIT 1,50,000. We can find out fixed cost. How do we get fixed cost? Fixed cost is equal to contribution minus EBIT, 4,50,000. We can find out earnings before tax. EBIT 1,50,000 minus interest 30,000, 1,20,000. You can find out EAT, 50% of EBT. Clear? So we can find out the income statement. Clear? Next, financial leverage. EBIT divided by EBT. Combined leverage, operating leverage into financial leverage. Okay, done. Next, what is the last part? Calculate the percentage change in EPS if sales increased by 5%. Simple. So combined leverage denotes the relationship between what? Sales and EPS. If a sales increases by 5%, so what is the combined leverage? 5. That means EPS increases by 25. 5 into 5. 25. Clear? Simple. So in previous question, the point is margin of safety is equal to 1 divided by operating leverage. Okay, and also what in last part we assumed PV ratio to be 40%, otherwise we cannot continue. Okay, In this question, the special point is we started with what? EAT 5% on a sales. Done. Next. Illustration number 7. PV ratio 30%, operating leverage 2, financial leverage 150, loan 1,25,000, post-tax interest rate. What is the post-tax interest rate? 5.6%. Tax rate is given. Market price per share is given. Price earning ratio is given. Price earning ratio is equal to nothing but price divided by earnings per share. Market price per share divided by earnings per share. That is a ratio. So 10. P ratio 10. P ratio 10 means what? If earnings are 1 rupee, that means market pays 10 times of earnings. Here market price is given and PE ratio is given. PE ratio is equal to MPS by EPS. That means EPS is equal to what? MPS divided by PE ratio. 140 divided by 10. So that means EPS is equal to what? 14 rupees. Prepare the profit loss statement of a SS Limited. Profit loss statement. Find out the number of equity shares. Clear? So loan is given. So start from the loan. What is the loan amount? 1,25,000. What is the tax rate? 30%. Post-tax interest rate is given. Post-tax, after-tax interest rate 5.6. So what might be the pre-tax interest rate? 5.6 divided by 70%. 5.6 divided by 70%. I think you will get 8%. Are you getting my point? So what is the loan amount? 1,25,000. That means interest amount is equal to 1,25,000 into 10,000. In this question, the special point is post-tax interest rate. Post-tax, after-tax interest rate. First, you should find out the pre-tax interest rate so that you can find out the interest amount. Now, the financial leverage. How can you write the financial leverage? Financial leverage is equal to EBIT divided by EBT. Okay? And EBIT divided by EBT can be written as EBIT minus interest. So we can find out EBIT by using the financial leverage. This concept we have already discussed. Later on we can find out earnings before tax. By using operating leverage we can find out what? Contribution. Clearer? And we can find out fixed cost. Contribution minus EBIT. Contribution minus EBIT. We can find out sales because PV ratio is given. So what is the PV ratio? 30%. So we know the contribution. So contribution 60,000 divided by what? 30%. So sales is equal to 2 lakhs. We can find out variable cost. Sales into 70%. So that is 1,40,000. So now income statement. Sales minus variable cost, contribution minus fixed cost. The only special point in this question is what? Post-tax interest rate. Okay. So EAT is equal to 14,000. Generally, we find out earnings after tax. Okay. So number of equity shares will be given in the question. We find out what? EPS. But in this question, what? They are asking you to find out the number of equity shares. This is also a simple question only. First for that, you should know what? PE ratio is equal to MPS divided by EPS. That means EPS is equal to what? MPS divided by PE ratio. What is earnings per share? 14 rupees. What is the earnings after tax? 14,000. Overall earnings 14,000. Earnings per share is equal to 14. That means number of equity shares might be equal to 1,000. Clear? So PE ratio 10 times means market is paying 10 times of earnings. Market price per share is 10 times of earnings per share. Am I clear? Done. Now come to the next question. Operating leverage, financial leverage, fixed costs excluding interest, sales, 12% debentures of 10 each, equity share capital, income tax rate. Calculate PV ratio and earnings per share. They are asking you to find out the PV ratio and also what? Earnings per share. Okay, if the company belongs to an industry whose assets turnover is 1.5, does it have a high or a low asset turnover? And last part is financial leverage. Last part financial leverage is simple. Combined leverage is already given. Operating leverage is given. So combined leverage divided by operating leverage 2. Financial leverage will be 2. First part is what they are asking you to find out the PV ratio and also what earnings per share. So interest amount is also there, fixed cost is also there. So operating leverage can be written as what? Contribution divided by EBIT. EBIT can be written as contribution minus fixed cost. We already know fixed cost. We can find out what? We can find out what? Contribution. So contribution is 7,14,000. Sales amount is already given in the question. What is the sales amount? 30 lakhs. So PV ratio, profit volume ratio is equal to PV ratio is equal to contribution divided by sales. So the answer is 23.8% PV ratio. Am I clear? Next, they are asking you to find out the earnings per share. How can we get earnings per share? Simple, income statement. So let us start with contribution minus fixed cost minus interest. You will get earnings before tax into 1 month's tax rate. 1,78,500 will be the profit after tax. Better you take income statement. Contribution minus fixed cost minus interest minus tax. You will get what? Profit after tax divided by number of equity shares already given in the question. Number of equity shares 17 lakhs divided by what? 10 rupees each. 1,70,000. So what is earnings per share? 1.05. Clear? Next, industry asset turnover ratio is 1.5. Let us find out our turnover ratio. What is our turnover ratio? Sales 30 lakhs divided by total assets. Total assets is equal to total liabilities. So what is the total liability here? 12% debenture 21.25 plus equity share capital 17. So 0.7843. So our company is having a asset turnover ratio which is lower than industry. So financial leverage is equal to 2. Combined leverage divided by what? Operating leverage. Done. Is it clear? Next, following information is given for X Limited. Total contribution is given. Operating leverage is given. 15% preference shares. Number of equity shares. Tax rate. Be careful in this question. 15% preference shares are given. You have to be careful. So number of equity shares are given, tax rate is given. Calculate EPS of X Limited if 40% decrease in sale will result in EPS to 0. Extreme level conceptual question. Calculate EPS of X Limited if 40% decrease in sales will result in EPS to 0. 40% decrease in sales will result in EPS to 0. Okay. So combined leverage denotes the relationship between what? Sales and EPS. That means if sales decreases by 40, your EPS decreases by 100%. EPS decreases by 100%. Okay, so how do I get combined leverage? Combined leverage is equal to percentage change in EPS divided by percentage change in sales. That means 100% divided by 40%. I will get combined leverage 2.5. I already have an operating leverage that is 3.125. Okay, how can I find out financial leverage? Financial leverage is equal to combined leverage 2.5 divided by operating leverage 3.125. So answer is 0.8. Okay, so your earnings before tax. So this question is not framed properly. How can I say like that? Simple. If you see the D part, financial leverage is equal to EBIT divided by EBT. No doubt in that. We already know the financial leverage. We already know what EBIT also. How can I find out EBIT? Because contribution is given. By using operating leverage formula, I am finding out what EBIT, 1,36,000. So what is the financial leverage formula? 1,36,000 divided by EBT. That is equal to what? 0.8. So earnings before tax is equal to how much? 1,70,000. Why this question is not framed properly? Because the reason is, how come earnings before tax can be greater than EBIT? So financial leverage cannot be less than 1. For that matter, any leverage cannot be less than 1. Why? Simple. EBIT what? Cannot be greater than contribution. EBT cannot be greater than what? EBIT. So that means what? We are not paying interest. Someone else is paying interest to us. So completely what? This question was not framed properly. Next, what they are asking you to find out what? Earnings per share. EBT is equal to 1,70,000 minus tax at the rate of 50%. Tax rate is given, yes or no? So earnings after tax minus preference dividend. Preference share capital is given. So number of preference shares 1000 into 100 into 15%. 15,000. Earnings available for equity shareholders 70,000. Number of equity shares 2 lakh. Number of equity shares 2,500. Earnings per share 28, which is what? Completely illogical question, okay? But in examination we cannot, okay, fight for logics. Clear? Huh? Next, 10th question. 10th question is completely a theory question, okay? The total risk of any business is a combination of a degree of operating and finance risk. Yes, obviously. Okay. In the light of the above statement, you are required to consider the first two columns of the given table and give your comments in the third column. Your comments should depict the total risk profile by using the most appropriate among the following three words only. You have to use only following three words. You cannot write what? Yeah, okay, fine. Okay. Lower, higher, and moderate. Also select the best combination of degree of operating leverage and degree of financial leverage from the given table. So in comment section, either you should write what? Lower, higher, moderate. Degree of operating leverage is low and degree of financial leverage is high. That means what? Moderate total risk. Operating leverage is low, but degree of financial leverage is what? High. So moderate total risk. Best combination. Okay. Higher financial risk is balanced by lower total business risk. Degree of operating leverage is high. Financial leverage is low. Okay, simple common sense. Degree of operating leverage is low means what? Example, our building is owned, no rents. Degree of financial leverage is high. You are taking debt and paying interest. This is a moderate total risk and best combination. Higher financial risk is balanced by what? Lower total business risk, because we are not paying any rent. Our fixed cost is too low. But reverse case, moderate total risk but not a good combination. Because why it is not a good combination? Lower EBIT due to higher degree of operating leverage. Already your EBIT will be eaten by what? Fixed cost. And lower advantage of trading on equity due to low degree of a financial leverage. What does it mean? Trading on equity means we have discussed the concept called favorable financial leverage. A financial leverage is said to be favorable if return on investment is greater than rate of interest. Okay. So financial leverage means influence of a debt power. Influence of debt power is said to be favorable if return on investment is greater than rate of interest, no doubt. But in that case, what I told is, if you increase the debt proportion in capital structure, your earnings per share will increase and return on equity will also increase. This concept is called as a trading on equity. Trading on equity. That means you will be keeping your equity, okay, constant. You will be keeping equity constant, but what you will be keep on increasing what debt proportion. If you keep on increasing the debt proportion, that means you are trading on equity. Equity will remain same. Okay, you will be increasing the debt proportion. Then what happens? Your earnings per share and return on equity will increase. But here, lower EBIT due to higher degree of operating leverage and lower advantage of a trading on a equity due to low degree financial leverage. Your financial leverage is also low. That means you are not using high amount for debt. So that's why there is low advantage due to trading on a equity. High operating leverage, high financial leverage, that means what? Higher total risk, very risky combination. Okay. But the people who do not have a financial background, no option. They will be having what? High degree of operating leverage and also what? High degree of a financial leverage. No other option. So higher total risk and very risky combination. Done. So with this we have completed what leverages chapter. So November 19 question, you can go through it. November 19 question. The only special point is total asset turnover ratio. You know how to find out total asset, how to use the total asset turnover ratio. By using total asset turnover ratio, we can find out what sales. Next, illustration number 2. Again, this question we have already discussed. I mean, similar kind of a questions. Next, May 19. You can go through these questions, okay? Clear? Done? So next concept, dividend decisions. Dividend decisions, okay? Financial management, as we already know, there are two aspects: procurement of fund and effective utilization of a fund. Objective is wealth maximization and profit maximization. Superior objective is what? Wealth maximization. Here, so there are three types of decisions in financial management. Yes or no? First one, financing decision, how to procure money. So financing decision includes what? Cost of a capital chapter and capital structure chapter. Sources of a finance. Sources of finance, completely a theory topic. Completely a theory topic. And earlier one, that is leverages chapter. Why we have learned the leverages chapter? To find out to measure the operating risk, financing risk and combined risk. So why the risk calculated? Because if you have gone through the last question, in that last question, low operating risk, high finance risk. Okay, so it is moderate risk and good combination. But whereas high operating risk and low finance risk means what? Moderate risk, but it is not a good combination. Yes or no? That means why we have learned that topic. Simple. If you have already having a higher fixed cost, then you should not go for a higher interest and preference dividend. So that's why last option is what? High risk, high operating leverage, high financial leverage. What is it? That indicates what? Extremely high risk. Okay. Now we are going to discuss what. So there are three types of decision: financing decision, investing decision. Investing decisions not yet started we. So there are two chapters, that is investment decision chapter, capital bursting, and second working capital management. Now we are going to discuss what? Dividend decision, whether to declare a dividend or not. So dividend means what? Nothing but profit after tax which is distributed among the shareholders is called as what? Dividend. Okay. So we have a dividend decisions theories. There are irrelevance theories and relevance theories. There is only one irrelevance theory, that is Modi-Gilani-Miller approach. Modi-Gilani-Miller. Okay. So all other methods are relevance theories. All other theories are relevance theories. Relevance theories means what? The dividend decision is going to affect the market price of a share, wealth of a shareholder. Wealth of a shareholder. Okay. So but whereas approach, irrelevance theory means what? Dividend decision is not going to affect the wealth of a shareholder. So these are simple methods and easy chapter. You can easily score marks in this chapter, dividend decisions chapter. Okay. So first method, Walter method, it is a relevance theory. It is a relevance theory, common sense method. So we already know how to find out the KE, cost of equity KE. Cost of equity KE, for example, it is 15%. What is the meaning of this 15%? To meet the expectation of the investors, company should earn minimum 15%. Minimum 15%. Here R means a return on equity. R means return on equity, but in questions they might give return on investment. Sometimes we assume the return on investment as a return on equity if there is no scope to find out the return on equity. Okay. So what Walter says is dividend decision will affect the market price of a share. No doubt in that. Dividend decision will affect the market price of a share. It is a relevance theory. Okay. And once again I'm reminding, I'm discussing only the concepts which are relevant to solve the practical questions. I'm not discussing the concept which are required to answer the theory question. Okay, I'm straight away diving into the concepts which are relevant for the practical questions solving. Okay, this is exam oriented batch, that's why. So dividend decision will affect the market price of a share. So the simple concept is, if R is greater than K, return on equity. How do we get return on equity? Return on equity is equal to earnings available to equity shareholders divided by what? Equity. So for example, return on equity is equal to 12%. Return on equity is equal to 12%. Okay, but our equity shareholder Amar, okay, so he is expecting what? 15%. So to meet his expectation, the company should earn 15, but the company is able to generate a return on equity of only 12%. So tell me, will the company be able to meet the expectation of a investor or not? Answer is no. So that means if R is less than K, then you do not retain your profits. Instead of paying dividend, if you retain the profits, so why do we retain the profits? For reinvestment, yes or no? We retain profits and we reinvest. If we reinvest, if we can generate only 12%, okay, which is less than the expectation of equity shareholder, better you what? Do not retain, pay out 100%. Optimum payout ratio is equal to 100%. Then your price will be maximum. The market price per share will be maximum. If optimum, I mean, if you are paying out 100% dividend. Okay. For suppose if R is greater than K, you are retaining the profits and reinvesting, and if you could generate 20% which is greater than the KE 15%, then optimum payout ratio is equal to 0. Okay, so now we say equity shareholder, okay, keep your mouth shut. So we are going to reinvest retained earnings because your expectation is what? 15, but we can generate what? 20%. So optimum payout ratio is equal to 0. But if R is equal to KE, then indifferent whether you pay dividend or not, it does not make any difference. It is not going to affect the price of a share. Clear? So Walter has also given a formula for price. So Walter has also given a formula for price. Price P is equal to, price per share P is equal to D plus R by K into E minus D all divided by K. Okay, sir, what is the logic there for this formula? Simple logic. Price per share is equal to D dividend per share plus R return on equity divided by KE cost of equity into E earnings per share minus D dividend per share all divided by KE. Sir, what is this formula? What is the logic for this? In time value for money, I have discussed valuation of asset 5 examples. In those 5 examples, fourth example, try to recall the fourth example. What is that fourth example? If an asset is going to give a benefit for indefinite period, if asset is going to give a equal benefit for indefinite period, then how do we get value? Value is equal to benefit divided by required return. If you see this formula, price per share is equal to, in the denominator we are taking KE. What is this KE? Cost of equity, required return on equity. As I have already discussed in fourth example, benefit divided by required return. In denominator, what I am taking is required return. What about the numerator? In the numerator, there are two components. Be careful, there are two components. One is dividend. Indefinite period, equity shareholder is going to get a dividend. Indefinite period, equity shareholder is going to get a dividend. Apart from the dividend, for suppose earnings per share is equal to 10, dividend per share is equal to 4 rupees. Okay, so entire 10 rupees belongs to what? Equity shareholder, no doubt in that. Okay, but out of 10, only 4 rupees is paid as a dividend. You are taking 4, yes or no? But what is the other component? Earnings per share 10 minus dividend of 4, 6 rupees. What you are going to do with this 6 rupees? You are retaining and reinvesting. That means on that 6 rupees, you will be generating a return of R, return on a equity. So that's why D, dividend, that is the benefit going to received by the equity shareholder, plus what is the additional one? R into E minus D. R into E minus D. Clear? So 6 rupees also belongs to the equity shareholder, plus return on a 6 rupees also belongs to what? Equity shareholders. Again in that return generated on 6, again some portion will be retained, again reinvested, right? So that's why we are doing a double discounting for that R into E minus D. Okay, so D divided by K, benefit divided by required return, plus R into E minus D divided by K, all divided by what? K. So you have to understand the logic. Okay, clear? So this is simple, it is similar to fourth example. We are bringing the future benefit to the present value. That's it. So what this is what Walters model, simple one, Walters model. Let us see the illustration number 1, Walters model. Following details are related to H Limited, May 2025 question 2B. EPS 3 rupees, return on investment is 20%, cost of equity is 15%. As per Walters model, what would be the maximum and minimum price of a share? So what is the return on investment? Here, even though they have mentioned it as a return on investment, we should consider this return on investment as a return on a equity, 20%. Cost of equity, 15%. Okay. So R is greater than KE or not? Yes, R is greater than KE. R is greater than KE means as per the Walters model, the price will be maximum. Price will be maximum at a payout ratio of 0. Optimum payout ratio should be 0. Price will be maximum when the company retains all the earnings. When the company retains all the earnings. Yes or no? Okay, so that means dividend must be equal to 0. So price per share P is equal to 0 plus R 0.2 divided by K 0.15 into earnings per share 3 minus 0 divided by 0.15. So what is the answer? We are getting 26.67. Okay. Sir, but I don't want maximum price per share. Already I am very happy. I want sorrowness in my life. So price should be minimum. Then what optimum? Then what? You should not follow the optimum payout ratio. You should follow worst payout ratio. So what is the worst payout ratio? Payoff 100%. Payoff 100%. Then what is the market price per share? 3 divided by 0.15. Because the second component will be 0. E minus D. Earnings 3 rupees. Dividend is also 3 rupees. Yes or no? So what is the price? Minimum price? 20 rupees is the minimum price. Clear? Done. So this is the Walters model. Are you able to understand? Next. Following information are given for the company. May 23 question. Following information are given for a company. Earnings per share 10. PE ratio 12.5. Rate of a return on investment is 12%. Market price per share as per Walters model 130. You are required to calculate dividend payout ratio. First we have to find out what? Dividend payout ratio. So generally we find out the price as per Walters model, but in this question price is already given. What is the price? 130. Price as per Walters model is already given 130. Clear? Okay. Now here the special point in this question is PE ratio is given. What is the PE ratio? 12.5. PE ratio is equal to what? 12.5. Okay. So here we have to learn the new point. What is the new point? New point. PE ratio is equal to what? MPS divided by EPS. Am I correct? Nothing but P naught divided by E1. P naught means current market price divided by E1. E1 means earnings per share. Am I correct? PE ratio. KE formula. We have learned KE formulas. Yes or no in cost of a capital chapter. KE is equal to what? KE is equal to E1 by P naught. This we have learnt. Yes or no? KE is equal to E1 by P naught. In cost of a capital chapter, earnings model. Okay. So are you able to figure out the relationship between KE and PE ratio? PE ratio is equal to what? PE ratio is equal to P naught divided by E1. MPS by EPS. KE is equal to what? EPS by MPS. That means cost of equity K is equal to what? We can write 1 divided by PE ratio. Can we write like this or not? Cost of equity K is equal to 1 divided by what? PE ratio. Am I correct? Cost of equity K is equal to 1 divided by PE ratio. Done? Are you getting my point? So this is a special point in this question. So dividend payout ratio. They are asking you to find out the dividend payout ratio. We know the market price as per Walters model. That is 130 is equal to 130 is equal to. We do not know the dividend. Okay. No idea about dividend. So 130 is equal to what? D plus 130 is equal to what? D plus R 12% divided by KE. How do we get KE? 1 divided by PE ratio. That means 1 divided by 12.5. 8%. So D plus 12% divided by 8% into earnings per share. Already we have an idea. So 10 minus D divided by 8%. On solving this, we get a dividend per share 9.2. That means dividend payout ratio. How do we get dividend payout ratio? Dividend payout ratio is equal to earnings per share. So dividend per share divided by payout ratio is equal to dividend per share divided by earnings per share. Payout ratio is equal to dividend per share divided by what? Earnings per share. Am I clear? Are you getting my point? So in this question, the only special point is what? K is equal to 1 divided by PE ratio. Done? Okay. Let us move on to the next part. Market price of a share at optimum dividend payout ratio. Tell me what is the optimum dividend payout ratio? R is equal to 12%, K is equal to 8%. That means R is greater than KE. R is greater than KE means optimum payout ratio 0. Okay, if R is greater than KE, the firm, since the rate of return on the firm is 12%, rate of return of the firm is 12%. And it is more than KE of 8%. Therefore, by distributing 92% of earnings, the firm is not following an optimum dividend policy. The optimal dividend policy for the firm would be to pay zero dividend. In such a situation, market price will be equal to dividend 0 plus R 12% divided by KE 8% into 10 minus 0 divided by 8%. So what is the answer? 187.5. Earlier it was 130, now it is what? 187.5. Okay. So theoretically, what do we say? The market price of the share can be increased by adopting a zero payout. If you are paying zero dividend, the market price per share will increase as per Walter's model. Clear? Now come to the C part. What is C part? PE ratio at which the dividend policy will have a no effect on the price of a share. The dividend policy should not have an effect on the price of a share. You should know the concepts. Under Walter's model, the dividend policy will not have any effect on the price of a share if R is equal to KE. Yes or no? If R is equal to KE, then dividend policy will have no effect on the price of a share. Whether you pay dividend or not, the price will remain same. Okay. So that means what? R must be equal to KE. R is equal to 12%. It is not going to change. Yes or no? They are asking you to find out P ratio, not KE also. So first we should find out KE. R should be equal to KE. What is R here? 12%. That means KE must be equal to 12%. KE must be equal to 12%. KE must be equal to 12% means P ratio must be equal to 1 divided by 12. 8.33. 8.33. Clear? So therefore at a P ratio of 8.33, the dividend policy would have a no effect on the value of the share. Clear? Done? Is it clear? Okay. Now the next part. Market price of a share at this PE ratio. They are asking you to find out the market price of a share at this PE ratio. So what is the market price of a share? How can we find out? Again, so we start with what? 9.2. What is this 9.2? Earlier dividend plus 0.12 divided by 0.12 into 10 minus 9.2 divided by 0.12. You will get 83.33. Clear? But suppose if you are paying entire amount as a dividend, then 10 divided by what? 0.12. Then also you will get 83.33. Clear? But suppose if you are retaining the entire amount, then 10 into 0.12 divide by 0.12 divide by 0.12, then also you will get 83.33. That means dividend policy will not have any effect. Clear? Done. Next, what they are asking you to find out the market price of a share using what? Dividend growth model. Dividend growth model. What is this dividend growth model? Dividend growth model D1 divided by D1 divided by KE minus C. This is similar to fifth example. P naught is equal to D1 divided by KE minus G. So what is KE? KE 8%, yes or no? KE 8%. R is equal to what? 12%. D naught is equal to what is D naught? 9.2. Already given in the question. Okay. So payout ratio 92%. First part we calculated payout ratio 92%. That means the retention ratio is equal to what? 8%. So using dividend growth model, how can we find out the price? D1 divided by KE minus G. So already we know the dividend amount 9.2, that is D naught. Okay, KE is already given, KE is already calculated in first part 8%. So we need growth. So growth, how can we find out growth? Growth depends on two factors as we already discussed, B into R. retention ratio into what? Return on a investment. What is the retention ratio? 8% into return on investment 12%. 8 into 12. 9.6%. 9.6% is 0.96. Sorry. Be careful. 0.96% is the growth rate. Okay. So now what is the calculation? P naught is equal to 9.2 is the current dividend. 9.2 into 1 plus 0.96%. 0.96% means 0.0096. 9.2 into 1 plus 0.0096 divided by KE. What is KE here? 0.08 minus 0.0096. So what is the answer? P naught is equal to 131.936. Clear? So you can take an alternative also. For sometimes students might get a doubt. Sir, the given dividend is D naught or a D1. You can assume it as a D naught or else what? D1. Anything is fine. So if it is assumed as a D1 directly, then what is your answer? 9.2 divided by 0.08 minus 0.0096. Then you will get 130.68. Clear? Done? Am I clear? Okay, so nothing but we are indirectly discussing Gordon's growth model. Dividend growth model and Gordon's growth model are both same. So I have not yet discussed the concept. So I will discuss, okay? Next, illustration number 3. Jan 25. Profit before tax 40 lakhs, tax rate 30%, equity share capital 40, return on investment 18%, cost of equity 15%, dividend payout ratio 50%. You are required to determine the price of equity share of the company as per Walters model. As per what? Walters model. To determine the price of equity share of a company as per Walters model. Okay. Cost of equity is given. Return on investment is also given. So first the profit before tax. What do we do? Profit before tax 40 lakhs minus tax rate 30%. So that means what is the profit after tax? 28 lakhs. Divided by number of shares. How many shares are there? 40 lakhs divided by face value 10, 4 lakhs. Earnings per share is equal to 7. Earnings per share is equal to 7. What is the payout ratio? 50%. They are asking you to find out the price as per Walters model. Okay. So 3.5 is the dividend per share. So price per share is equal to 3.5 plus R 0.18 divided by K 0.15 into 7 minus 3.5 divided by 0.15. So what is the answer? 51.33. Now tell me, is it a optimum payout ratio or not? Answer is no. Generally in Walters model, optimum payout ratio either it can be 100 or 0. Okay, if R is greater than KE, if R is greater than KE, then what? Optimum payout ratio 0. If R is less than KE, optimum payout ratio 100%. So second part, to determine the dividend payout ratio by applying Walters model, assuming the price of equity share of the company is 48. Price is given, they are asking you to find out the payout ratio. Let us find out the dividend. 48 is equal to D plus 48 is equal to D plus R 0.18 divided by KE 0.15 into earnings 7 minus D divided by 0.15. On solving this, you will get dividend 6 rupees, and dividend payout ratio is equal to 6 divided by 7, 85.714 percentage. Clear? Are you getting my point? So both are not optimum payout ratio. What should be the optimum payout ratio? Optimum payout ratio should be 0. At 0 payout ratio, market price will be maximum. Example, price is equal to dividend 0 plus R 0.18 divided by K 0.15 into 7 minus 0 divided by what? 0.15. 0.15. So what is the answer? Seven into 0.18, 56 rupees. So this will be the maximum market price per share. This should be the maximum market price per share. Okay, am I clear? Done. Clear? Clear? Next method, Gordon's method. So Gordon's method is also a simple method. He has given a different formula. Price per share is equal to D1 divided by KE minus G. How do we get D naught? D1 is equal to D naught into 1 plus G, or. So see the another formula. Price P is equal to E, earnings per share, into 1 minus B. B means retention ratio. So P is equal to E into 1 minus B divided by KE minus BR. Growth rate is equal to B into R. Retention ratio into return on investment. So this is a Gordon's method. So Gordon is also advocating the same. If R is greater than KE, if you decrease the optimum if you decrease the payout ratio, market price will increase. If R is less than KE, increase the payout ratio, then your market price will increase. So Gordon method is also advocating the same. It is also a relevance theory. Okay. So let us see the illustration number 4. Info Limited is a listed company having share capital of rupees 2400 crores of rupees 5 each. During the year 2020 to 23, dividend distributed 1000%. Expected annual growth rate in dividend 14%. Expected rate of a return on its equity capital 18%. So growth rate G is given, K is also given. Required, calculate the price of a share applying Gordon's growth model. Next, what will be the price of a share if the annual growth in dividend is only 10%? According to Gordon's growth model, if IRR is 25%, then what should be the optimum payout ratio in case of a growing stage of a company? Comment. According to Gordon's growth model, if IRR is 25%, okay, then what should be the optimum dividend payout ratio in case of a growing stage of a company? And comment. Okay, so the only difference between the Walters model and Gordon's model is mainly the way of calculating the price per share, but both are advocating the same. If R is greater than KE, optimum payout ratio is equal to what? 0. But if you see the formulas, in case of Walters model, we need R, return on equity, to find out what? Price per share. Okay, but whereas for Gordon's model, so if a growth rate is already given, then we need not require what? Return on equity. But if a growth rate is not given, then what? So how can we find out growth rate? B into R, retention ratio into return on equity. Okay, so simple. First see this. Dividend distributed is equal to how much percentage? 1000%. Dividend distributed. Some students might get doubt, sir, how can the company pay 1000%? How can the payout ratio can be 1000%? This is not a payout ratio. Payout ratio can be between 0 to 100. Yes or no? How can we pay 1000% of earnings? This is 1000% of a face value. Dividend distributed 1000%, not the payout ratio. 1000% of what? Face value. What is the face value? 5 rupees. 1000% means 5 into 1000%, you will get 50. 10 times. Clear? So, what is the answer? 50 into 1 plus 50 into 1 plus growth rate. What is the growth rate? 0.14 divided by K 0.18 minus 0.14. So the answer is 1425. Clear? Okay. Next. First, suppose if the growth rate is only 10%, then what? Simple. 50 into 1 plus 0.1 divided by 0.18 minus 0.1. Then what is the answer? 687.5. Okay, clear? Next, according to Gordon's growth, Gordon is also saying the same. If IRR is 25%, then what should be the optimum dividend payout ratio in case of a growing stage of a company? If R is greater than K, then what is the optimum payout ratio as per Gordon's model? 0. They are not asking you to find out the market price. As per Gordon's model, when R is greater than K, optimum payout ratio is 0. When IRR is greater than cost of a capital, the price per share increases and dividend payout ratio decreases. Nothing but price per share increases with the decrease in payout ratio. Clear? Done? Next, let us move on to the next question. Question number 5. Saraswati Limited has started its business a year back with a paid up equity capital of rupees 50 lakhs. Earnings of the company is given 5 lakhs. Market price per share using Gordon's model. Market price per share is given using Gordon's model. Cost of a capital, IRR, number of shares. You are required to calculate the dividend price per share, dividend paid per share using Gordon's model. Here the price is given. They are asking reverse question. They are asking you to find out the dividend paid per share. So what is the formula? Price P naught is equal to price P naught. Let me write the answer. So September 25 2B. So what is given in the question? So price as per Gordon's model. Price as per Gordon's model. Okay. So I'm not focusing on presentation. 159.09. 159.09 is equal to what? Formula. Earnings per share into 1 minus B divided by what? K minus G. So what is given in the question? Earnings of the company. What is the earnings of the company? 5 lakhs. So what is the paid up capital? 50 lakhs. So they are asking you to find out the dividend paid per share. Okay, IRR is given. Internal rate of a return is given. Cost of a capital is also given. Cost of a capital is also given. Cost of a capital is also given. Yes or no? Are you getting my point? Okay. So 159.09 into equal to E into 1 minus B divided by K minus B. So 159.09 is equal to earnings. We can find out earnings. How can we find out earnings? Earnings of the company is equal to 5 lakhs. What is the paid up equity capital? Paid up equity capital is equal to 50 lakhs. Number of shares 50,000 is already given. So earnings per share is equal to 5 lakhs divided by 50,000, that is equal to what? 10 rupees. 10 into 1 minus B. Retention ratio is not given. Retention ratio is not given. K is given. What is K? K is equal to 0.08 minus growth rate is not given, but what is the formula for growth rate? B into R. B into retention ratio not known, but we know IRR. What is IRR? 12.12. On solving this, we will be getting a retention ratio B, okay, 0.3. Retention ratio 0.3 means payout ratio will be 0.7. That means dividend paid per share is equal to 10 into 0.7, that is equal to what? 7 rupees. Second, simple question, okay? Next, second, what will be the optimum dividend payout ratio according to Gordon's model when R is equal to KE? Simple, when R is equal to KE, optimum payout ratio, there is no optimum payout ratio when R is equal to KE. Walter is also saying the same thing. When R is equal to KE, then what? There is no optimum payout ratio. Next, illustration number 6, May 25 question. Y Limited produces energy drink in different flavors due to high demand of its product. The rate of a return on its earnings is 25%, IRR 25%. Currently, the company retains 60% of its earnings and distribute the rest. That means growth rate will be 60% into 25%. You will get growth rate 15%. The current PE ratio is 8 and the earnings per share is 10. According to Gordon's model, what will be the retention ratio if the company wants to maintain its PE ratio to 12 in current year, given that the expected rate of a return for an investor is 20%? What will be the expected price per share after 1 year if a Y Limited achieves above mentioned target PE ratio? Next, will there be any change in retention ratio if the company wants to maintain its PE ratio to 10 in current year, given that the expected rate of a return for the investor is 17.6%? Okay, so let us start this question. This is a little complicated question. So what is the return on investment? What is the rate of a return on investment? 25%. What is the present retention ratio? 60%. So that means 40% payout ratio. The current PE ratio is 8 and earnings per share is equal to 10. So what will be the retention ratio if the company wants its PE ratio to 12 in current year? Okay, they want PE ratio to be 12 in current year. Right now it is 8, but they want PE ratio to be 12. What will be the retention ratio given that the expected rate of a return for an investor is 20%? What is the expected rate of a return for an investor? 20%. So P ratio is equal to 1 minus B divided by KE minus BR. Sir, what is this formula? So let me write this. Price earning ratio. Price earning ratio. So what is the price earning ratio formula? May 25 question, right? Okay, what is the price earning ratio formula? So this is a complicated question. P ratio is equal to market price per share divided by earnings per share. Yes or no? So that is equal to, as per Gordon's model, tell me what is the formula for market price per share? E into 1 minus B divided by K minus BR. Yes or no? E into 1 minus B divided by KE minus BR is the formula for market price per share as per Gordon's model. So now what happens? E and EPS will get cancelled, yes or no? E means EPS. EPS will get cancelled, yes or no? That means PE ratio is equal to 1 minus B divided by what? KE minus BR. Clear? So this is what written here. So 1 minus B into what? KE minus BR. The question is they want a PE ratio for 12. Then what should be the retention ratio? 1 minus retention ratio. We have to find out retention ratio B divided by KE is given. What is KE? KE is equal to what? Expected rate of a return. Given that the expected rate of a return for an investor is 20 or 17.5. First part. Expected rate of a return. What will be the retention ratio if the company wants to maintain its PE ratio to 12% in current year? Given that the expected rate of a return for an investor is 20%, we should take 20. So solve this one. 12 is equal to 1 minus B divided by 0.20 minus R. What is R here? IRR is equal to what? 25%. 0.25 into what? B. Okay. So 12 into 0.2. You will get 2.4 minus 12 into 0.25B. You will get 3B is equal to what? 1 minus B. Clear? Done. Next step. Okay, 2B is equal to what? 1.4. B is equal to what? 0.7. So that means what is the retention ratio? 70% should be the retention ratio. Okay. But whereas in this question, what? They have taken 17.5. Given that the expected rate of return of an investor is what? 20%. Okay. Are you getting my point? But in the answer they have taken what? 17.5, which is not correct. You should take what? 20%. Okay. Next, they are asking you to find out what? Next one. What will be the expected price per share after 1 year if a Y Limited achieves above mentioned target PE ratio? What is above mentioned target PE ratio? 12. If it achieves above mentioned target PE ratio 12. So what is earnings per share? Earnings per share is equal to 10. So the market price per share will be PE ratio into earnings per share, that is equal to 120. Okay. So again here the correct answer is given. Retention ratio is 70% when PE ratio is 12. So return on earnings is 25%. Okay. The other way of calculating is new growth rate is equal to 70% into 0.25, that is 17.5% new growth rate. So expected price after 1 year is equal to 120 into 1 plus 17.5, that is 141. So final answer is 141. This 120 is the current market price per share, but they are asking expected price after 1 year. So we are finding out the growth rate. How can we find out the growth rate? Retention ratio into return on equity. Retention ratio 0.7, return on investment 0.25. Okay. So here in first case there is a mistake in side answer. The answer should be what? 0.7. Clear? So once check side answer also, you can go through the side answer. Next, will there be change in the retention ratio if the company wants to maintain its PE ratio 10? and expected rate of return 17.5. Again same process. 10 is equal to 1 minus b divided by 0.175 minus 0.25. So the answer is 50%. Clear? I think our team might have done wrong copy paste, or else the answer might be wrong in suggested answer. Let me check once. So here correct the answer. Our department has done a mistake. So but I have explained it correctly only. Retention ratio is equal to 0.7. Clear? Done. So in this question, what is the special point? P ratio is equal to 1 minus b divided by k minus br. I hope you understood how we derived this formula. Next, Graham and Dodd. Next, Graham and Dodd model. So Graham and Dodd has given a formula. Price is equal to m. M means multiplier into d plus e by 3. D plus what? E by 3. Okay. So here the drawback of this method is they have given a multiplier. The multiplier is always subjective. I can take 2, you might take 4. Okay. So m is m into d plus e by 3. So what is the logic? This person has given a more weight for dividend. More weight for dividend. Because if you see this d plus e by 3, if you take LCM, 3d plus E, earnings per share can be written as dividend plus retained earnings. Dividend plus retained earnings. That means what? 3D plus D, 4D plus R. That means dividend is given 4 times more weight than the retained earnings. So that is the logic for this Graham and Dodd. So it was asked long back in November 23. Okay, Graham and Dodd model. Okay, and also what? Next one, a small one, Lintner's model. Lintner's model D1. Lintner has not given a formula for price per share, but he has given a formula for what? D1. How do we get D1? D1 is equal to D naught plus EPS into target payout ratio minus D naught into AF. AF means adjustment factor. Adjustment factor. Again in this question, adjustment factor is subjective. Adjustment factor is subjective. I might take 0.5, you might take 2. So D1 is equal to D naught, current dividend plus EPS into target payout ratio minus D naught into adjustment factor. So see the November 23 question. It was asked only once. EPS of the company 60, dividend payout ratio 60%, multiplier 5. Dividend payout ratio 60% means what is the dividend? 60 into 60%, 36. Determined price per share as per Graham and Dodd model. Price per share as per Graham and Dodd model. So 60 into 60%, 36. 36 plus what is the earnings? 60 divided by 3. That means 20. You will get 36 plus 20. What is the multiplier? 5. So 5 into 56, the answer is what? 280. Clear? Okay. So simple formula. What is the formula? Price per share is equal to m into d plus e by 3. Okay. The more weight is given to what? The more weight is given to dividend per share. Clear? Done. Next. Last year dividend is 6.34, that is D naught. Adjustment factor is 45%. Target payout ratio 60%. Current year EPS is 12. Compute the current year dividend using what? Lintner's model. They are asking you to find out D1. How do we get D1? D1 is equal to D naught plus, what is the D naught? 6.34 plus EPS, earnings per share 12 into target payout ratio 60% minus D naught into what? Adjustment factor. So this theory is depending upon a formal, I mean depending upon a concept like every company will have a target payout ratio. Every company will have a target payout ratio. They wanted to meet the target payout ratio. So based on that, he gave a formula for what D1. D1 is equal to D naught plus EPS into target payout ratio minus D naught into adjustment factor. Simple, 6.727. Clear up? Next, question number 8. Vista Limited's retained earnings per share for the year ending 31st March 2023 being 40%. Being 40% is 3.6 per share. Retained earnings 3.6 per share and it is 40%. Company is foreseeing a growth rate of 10% per annum in the next 2 years. After that, the growth rate is expected to stabilize at 8% per annum. Company will maintain its existing payout ratio. Company will maintain its existing payout ratio. If the investor's required rate of return is 15%, compute the intrinsic value per share of as of date using dividend discount model. May 2024 question. Simple question. So value of any asset, we should bring the future benefit to the present value. We should bring the future benefit to the present value. So that is what we are going to do it. So what is the retained earnings here? 3.6 per share is the retained earnings and it is 40%. It is 40%. That means payout ratio is 60%. So 3.6 divided by 40 into 60, you will get dividend per share. So what is the dividend per share? Dividend per share is equal to 5.4. This is for the year ending 31st March 2023. D naught. This is not D1. This is D naught. D naught is equal to what? 5.4. Clear? So if a growth rate is constant from the beginning, for suppose if the growth rate is constant from the beginning, then I will be applying the formula P naught is equal to D1 divided by K minus G. Then what is my answer? My answer will be 5.4 into 1 plus growth rate divided by KE. What is KE here? 15%. So 0.15 minus growth rate. So this will be the formula. So this can be applied when growth rate is constant. But here the growth rate is constant after how many years? 2 years. Growth rate is constant after 2 years. In this case, so May 24. May 24. Calculation of value of a share. Calculation of value of a share. Okay. Now, calculation of value of a share. Let me take columns. Here, cash flow, PVF. What is the required return? Required return 15% and discounted cash flow. Value of any asset. How can we get value of any asset? By bringing the future benefit to the present value. For suppose if investor buy that equity share, he will be getting a benefit at the end of a first year. What is the benefit he is going to get at the end of the first year? 5.4 into 1.1, because the growth rate is 10% for the first 2 years. Growth rate is 10% for the first 2 years. So 5.4 into 1.1, 5.94. Second year, 5.94 into 1.1. This is the benefit investor is going to get. 6.534. Okay. But after second year, growth rate is constant. After second year, growth rate is constant means I can find out P2. I cannot find out P naught directly, but I can find out P2 because growth rate is constant after 2 years. Growth rate is constant after 2 years. Okay. So how can I find out P2? P2 is equal to, D3 divided by KE minus C. That is equal to, how do I get D3? 6.534 into 1 plus, what is the growth rate? 0.08. After 2 years, growth rate is 0.08 divided by KE 0.15 minus growth rate 0.08. In this question, so this is one of the frequently asked question concept. P2 is equal to D3 divided by KE minus C. So what is the number? What is the number you are getting? 6.534 into 1 plus 0.08 divided by 0.15 minus 0.08. 6.534 100.8. Okay, understand the concept, do not by heart. Okay, please do not by heart. 100.8. Value of any asset. How can we find out value of any asset? We should bring the future benefit to the present value. So what is the future benefit? What is the future benefit? If I purchase the equity share as on today, I will receive a benefit of 5.94 first year, 6.534 second year, and at the end of second year, if I sell the share, I can get 100.8. Tell me the factors. 1 divided by 1.15. Present value factor. 0.870. Next 0.756, and next also 0.57756. So students might take third year factor. Do not take third year factor. If I purchase this share, what is the benefit I am going to get is D1, D2, P2. Okay, 5.94 at the end of first year, 6.534 plus 100.8 at the end of the second year. Be careful. I have seen many certified copies. Students are doing mistake here. They are taking a third year factor for 100.8. Okay. So tell me the number. 5.94 into 0.87. So 5.1678. 6.534 into 0.756. 4.94. Next 100.8 into 0.756. 76.21. What is the total? 5.1678 plus 4.94 plus 76.21. 86.31 is the answer. Clear? 86.31 is the answer. I have taken table, but instead of taking table, what they have taken is what? Equation directly. But the answer is simple. Clear? Done. Next, X Limited is a multinational company. Current market price per share is 2185. Current market price per share is 2185. During the financial year 2021, the company paid 140 as a dividend per share. Last year, 140 was paid as a dividend per share. In previous question, dividend per share is not directly given. We calculated. The company is expected to grow at the rate of 12% per annum. It is expected to grow at the rate of 12% per annum for the next 4 years. In previous question, 10% for the next 2 years. Then 5% per annum for an indefinite period. Thereafter, 5% per annum for an indefinite period. What is expected rate of a return? 18% per annum. In previous question, 15%. Expected rate of a return. Find out the intrinsic value per share. How do I get intrinsic value per share? I should bring the future benefit to the present value. Again simple. So in previous question D1, D2, P2. In this question D1, D2, D3, D4, P4. Because growth is constant after what? 4th year. So let me write the answer. So December 21. December 21 question, okay? A part. So this concept I have already discussed in time value for money. Value of any asset that can be shared, debenture, plant and machinery, building. We should bring the future benefit to the present value. So columns year, cash flow, PV factor at the rate of, what is the expected rate of return on equity? 18%. Required return 18%. Value of any asset is equal to, we should bring the future benefit to the present value using the required rate of a return. So that is what we are doing. 1, 2, 3, 4 and 4. Cash flow. What is the dividend for the last year? 140 into what is the growth rate for the next 4 years? 12%. So 140 into 1.12. 140 into 1.12. 156.8. Next 156.8 into 1.12. 175.6. Next 175.6 into 1.12. 196.7. Next 196.7 into 1.12, that is equal to what? 220. Again second 4 is for what? P4. How can I get P4? P4 is equal to what? P4 is equal to D5 divided by Ke minus G. How do I get D5? D4 into 1 plus, what is the growth rate? 5% thereafter. After 5 years, growth rate is 5%. Divided by 0.18 minus 0.05. Are you able to understand this calculation? 220 into 1 plus 0.05 divided by 0.18 minus 0.05. So what is the answer? So tell me this calculation, 220 into 1 plus 0.05 divided by 0.13. We cannot take 140. P4 is equal to D5 divided by Ke minus G. It's lunchtime. Your brain may not work. Be careful. 220 into 1 plus 0.05. I think 231 divided by 13%. What is the number? 177 7. Okay. Now we should bring this to the present value. So tell me the present value factors. 1 divided by 1.18 first year. Already factors are given, right? 0.847, 0.718, 0.608, 0.515. Again 0.15. Again 0.515. చూసారా వీడు డబుల్ యాక్షన్ 0.436 ఇచ్చాడు ఫిఫ్త్ ఇయర్ టు మేక్ యూ కమిట్ మిస్టేక్. దే గేవ్ అ ఫిఫ్త్ ఇయర్ ఫ్యాక్టర్ ఆల్సో. Okay, so if you bring this to the present value, you will be getting around 1408. 1408. You will get 1408. But what is the current market price? In the market, the price is 2185. We got 1408. What is the meaning of this 1408? In our perception, the market price of a share must be equal to 1408. But in the market, the price per share is 2185. That means in the market, the share is overpriced, overvalued. Yes or no? Are you getting my point? Okay. A newly qualified CA should get a package of 26 lakhs per annum in our perception. But he is getting 12 lakhs. Undervalued or overvalued? Undervalued in the market. So clear? Done. Second part also, is it clear? So they might ask theory question also. Briefly explain the assumption of Walter's model. That can be the question. List any 4 assumptions. So but right now I am not focusing on theory, as I have already told. Clear? But one thing they have not asked in examination, but we have to cover now, is Modi-Gilani Miller approach, which is an irrelevance theory. Irrelevance theory. In last 10 attempts, they have not asked any question from what? Modi-Gilani Miller. Okay. I think before that also this question was not Modi-Gilani Miller. It was not tested, Modi-Gilani Miller. Not tested, okay, in the past, Modi-Gilani Miller, but still let us discuss irrelevance theory. Irrelevance theory, Modi-Gilani Miller. So let me choose the question. So the last concept in dividend decision chapter, Modi-Gilani Miller approach. Modi-Gilani Miller approach. Okay. So this is also a simple concept. Modi-Gilani Miller says that dividend decision is not going to affect the price of a share. He has proven that. He gave a formula. So Akash Limited has a 10 lakh equity shares outstanding at the start of the accounting year. How many shares are there? 10 lakh equity shares. The existing market price per share is rupees 150. Expected dividend is rupees 8 per share. The rate of a capitalization appropriate to the risk class to which the company belongs is 10%. Calculate the market price per share when expected dividends are declared and not declared based on a Modi-Gilani Miller approach. Calculate number of shares to be issued by the company at the end of the accounting year on the assumption that net income for the year is rupees 3 crores, investment budget is rupees 6 crores, when dividends are declared and when dividends are not declared. Proof that market value of a shares at the end of the accounting year will remain unchanged irrespective of whether dividends are declared and dividends are not declared. Dividends are declared and dividends are not declared. Okay. Clear? Done. Let us start this. Question number 9. So illustration number 9 is for Modi-Gilani Miller approach. First part of the question is they are asking you to find out what market price per share when dividends are declared and not declared. Okay. A. They are asking market price per share. Market price per share. So in this what? Dividend example declared, and next one what? Dividend not declared. Two cases, dividend declared and what? Dividend not declared. What is the existing market price per share? 150 P naught. Expected dividend is 8 rupees per share. So what is the rate of a capitalization? 10%. Nothing but KE is equal to 10%. KE is equal to 10%. So first of all, P naught is equal to P1 plus D1 divided by 1 plus KE. Understand this formula. So this is similar to what? P is equal to A divided by 1 plus I. If I purchase one share at current market price P naught, what is the benefit I am going to receive? I am going to receive dividend at the end of the first year and price at the end of the first year. Okay. So P1 plus D1. So this is the benefit at the end of first year. Bring it to the present value. To bring it to the present value, I will take 1 plus KE power 1. Yes or no? First, suppose if a dividend is declared. If dividend is declared. First of all, what is the current market price? Current market price is equal to 150. 150 is equal to P1. We have to find out the price. We have to find out the market price per share. We have to find out the market price per share at the end of first year if dividend is declared and if dividend is not declared. Plus dividend. What is the dividend? 8 rupees. Divided by what? 1 plus 0.1. You will get P1 is equal to P1 is equal to what? 157. Second case, dividend is not declared, then 150 is equal to P1 plus dividend 0 divided by 1 plus 0.1. Then you will get P1 is equal to what? 165. Clear? So Modi Gilani Miller says that whether you declare dividend or not, the wealth of a shareholders will remain same. For example, if you are declaring dividend 8 rupees, then price at the end of first year will be 157. If you are not declaring a dividend at the end of first year, then price will be 165. In both the cases, investor will be having a 165 rupees at the end of the first year. First case 157 price plus 8 rupees dividend, the overall 165 rupees at the end of first year. Second case also 165. So his intention, his advocacy is, he is advocating that whether you pay dividend or not, his wealth is going to remain same. Shareholder wealth is going to remain same. So this is the theory of a Modi Gilani Miller. First part is completed. Next part is what they are asking you to find out. Number of shares to be issued by the company at the end of the accounting year on the assumption that the net income for the year is 3 crores and investment budget is 6 crores. Dividends are declared and dividends are not declared. So second part is they are asking you to find out number of new shares to be issued. B part. Number of new shares to be issued. In that first one, what is the first one? Dividend declared. Dividend declared. Okay. But suppose if dividend is declared, so they are asking number of new shares to be issued. So tell me what is the net income? Net income is equal to 3 crores minus dividend. What is the dividend? 8 rupees per share. How many shares are there? Already 10 lakh shares are there, right? 80 lakhs will be the dividend amount. Net income is 3 crores minus dividend is equal to 80 lakhs. What is the balance amount? 2.2 crores. What is this 2.2 crores? We have overall 3 crores earnings. Out of this, we pay 80 lakhs as a dividend. That means 2.2 crores balance is available for investment. So, balance available for investment. 10 more minutes, be patient. Okay, balance available for what? Investment. Balance available for investment 2.2 crores. Done. Balance available for investment 2.2 crores. But what is the investment? What is the investment? Investment is equal to, what is investment? 6 crores. Overall investment is 6 crores, but earnings available for investment is what? 2.2 crores. That means balance. What do we do for balance? We issue new equity. Balance to be raised. Balance to be raised from new equity. What is the balance to be raised from new equity? 3.8 crores. Clear? Huh? So number of new shares. Number of new shares to be issued is equal to 3.8 crores divided by, what is the price at the end of the first year? 157. How many shares? Clear? Huh? How many shares? 2.42. What is 2.42 lakhs? 2.42 lakh shares. Done. Am I clear? Clear? So likewise, what when dividend is not declared? If a dividend is not declared, then what net income will be? 3 crores minus dividend 0. Balance available for investment 3 crores. What is the balance to be raised from new equity? 3 crores. So 3 crores divided by number of new shares. 3 crores divided by 165. Clear? In that case, what? What is the number? 1.82. Am I clear? 1.82. Now, third part of the question is, they're asking you to find out, prove that market value of a shares at the end of the accounting year, not as on today. They are asking at the end of the account year will remain unchanged. So let us discuss. What are the existing number of a shares? Existing number of a shares is equal to 10. When dividend are declared, new shares is equal to 2.42. When dividend is declared, overall number of a shares 12.42 into what is the market price per share? 157. The overall market value of a share at the end of first year is equal to 1950. Clear? Done. If dividends are not declared, then what? 10 lakhs present shares, new shares 1.82, overall 11.82 into what? 165, 1950. That means whether you declare dividend or not, the market value of a shares at the end of the year will remain same. Hence proved. The total market value for shares remain unchanged irrespective of whether dividends are declared or not declared. Clear? But they might ask you to find out the present value of a market value of a share. Present value of a market value of a share. You have to be careful. In that case, NP naught is equal to NP naught is equal to N plus delta N into P1 minus I plus E divided by 1 plus KE. This formula we apply. NP naught means N means number of shares as on today. P naught means current market price. First let us find out NP naught. NP naught is equal to how many shares are there? 10 lakhs into what is the current market price? 150. That means 1500 lakhs is the market value of a shares as on today. Clear? 150. Current market price is 150. Existing market price per share is 150. P naught means current market price. 10 lakhs into 150, 1500 lakhs. Next, so let us find out NP naught if a dividend is declared. If dividend is declared, so see the formula. So what is the formula we are applying? NP naught is equal to, try to understand, N plus, what is N? 10 lakh shares as on today. 10 lakh shares as on today plus delta N, new shares to be issued at the end of the first year. What are the new shares to be issued at the end of the first year? First case 3.8 crores divided by 3.8 crores divided by what? 150. Sorry, 157. Are you getting my point? Number of shares as on today 10 lakhs plus delta N. What is delta N? Number of new shares to be issued 380, so 3.84 crores divided by 157 into 157. What is this 157? Price at the end of the first year. Nothing but this entire amount will be the value of a shares at the end of the first year. That is 1950 something you will get. Okay. Minus what is the investment? Investment is equal to 6 crores plus what? 3 crores is the earnings, net income available. What is the net income? 3 crores divided by 1 plus 0.1 divided by what? 1 plus 0.1. Why 1 plus 0.1? Because I am bringing at the end of the first year value to the present value. So this tab has got, okay, it is not listening to me. 1 plus what? 0.1. So tell me what is the final value? You will get 1500 lakhs. So Modi Gilani Miller says whether you declare a dividend or not, the value will remain same. Clear? But be careful, this 1500 lakhs is the value of a firm as on today. But whereas in the previous question, they have asked what value of a market value of a shares at the end of the year. At the end of the year. That means nothing but, so in previous they have asked only this part. Clear? Okay. Next, dividend not declared. Dividend not declared. For suppose if dividend is not declared. If dividend is not declared, then what? NP naught is equal to 10 lakhs plus 3.8 or 3 na? 3 divided by 165 into 165 minus 6 plus 3 divided by 1 plus zero point 0.1. In this case also you will get 1500 lakhs. Clear? In this case also you will get what? 1500 lakhs. Are you getting my point? So what Modi Gilani Miller says is simple. What Modi Gilani Miller says? Modi Gilani Miller says that okay, the price of a share may get affected, but overall wealth of a equity shareholder will not get affected whether you pay dividend or not. He gave two formulas. One is P naught. P naught is equal to what? P1 plus D1 divided by 1 plus KE. And he gave another formula. NP naught is equal to N plus delta N into P1 minus I plus earnings divided by what? 1 plus K. Understand the logic of this also. At the end of first year, what will be the value of a firm? Value of equity? Number of existing shares as on today plus new shares issued, total number of shares into P1. Okay, no doubt in that. Minus investment. Why investment? Because there will be an outflow. Plus earnings because there is an inflow. So that's why overall value at the end of the year will be N plus delta N into P1 minus I plus E divided by 1 plus KE. Clear? So with this we have completed what Modi Gilani Miller approach. Till now they have not asked in examination, but this is CA Inter. Please do not ignore. Clear? Thank you. Thank you so much.